did. The United States ultimately wants stability and cares a lot about getting this war over cleaner and more quickly. Israel wants an end to Iran's nuclear capabilities, an end to their ballistic missile capabilities, and doesn't care all that much about how much damage is done to the Iranian population or to whether or not Iran has a functional government when all is said and done. In other words, I mean, the Gazification of Iran is a plausible outcome for many Israelis, where that would not be acceptable for the United States. And so I do think there's a gap. The Israelis right now are pushing very hard to get the Americans to send commandos to Esfahan, which is where a lot of enriched uranium is presently stored, because Israel wants to make sure that Iran doesn't have access to that. Now, the American military commanders so far have said, no, it's too dangerous. The troops that would be exposed to all of these, very toxic materials, and the actual exercise itself would be hard to pull off. So that's an argument, too, between the U.S. and Israel. So these two countries, they're fighting together. But, as we've seen over the last year, the Americans and the Israelis don't trust each other completely at the top leadership, and they aren't fully aligned in what they're trying to accomplish in the region.
Well, let's talk about the region then. Ian, where does this leave Qatar, UAE? And we've seen those statements coming in, some from billionaires in the UAE, talking about the fact that they got dragged into a conflict that was not of their making, not of their choice either. How do you see the Gulf countries now engaging with the U.S., perhaps even attempting to push back? Many have invoked force measures. Many are threatening to invoke force measures. Significant investments in the U.S., significant U.S. exposure to this region. How do you see the region now attempting to engage with the U.S. in light of what has happened?
Well, obviously, they're very unhappy. I mean, this was not the case with the 12-day war. You didn't see that kind of public pushback. And in this case, the United States did not in any way coordinate with the Gulf in advance. They also have much more expansive war aims. It's not just about containing Iran's military and nuclear capabilities. It was about decapitating the regime. And that has led to a much more unrestrained Iranian response, including a decentralization of war-making authority to local commanders who are now engaging with drone strikes to hit any target they can find, including civilian apartments and five-star hotels and port facilities and airports in these developed Gulf countries. So they're clearly very unhappy about that. Now, a lot of this has to do with Iranian capabilities, as you said before. Iran's Navy has been mostly destroyed. Their Air Force has been mostly destroyed. Much of their ballistic missile capacity, if not the stockpiles, certainly the launchers have been destroyed, but not the drones. The drones are still there in very large number. They're very cheap, and it's very hard to prevent the Iranians from continuing to engage in drone strikes if they want. This is how warfighting has changed over the last few years. The Ukrainians are very, very aware of that. So, I mean, for the Gulf states, it's a question of what can be accomplished as a
Iran's supreme leader issues his first statement since father's assassination, says country will fight on and keep the Strait of Hormuz shut, even as Donald Trump remarks that the war is going very well. Israeli Prime Minister Netanyahu issues veiled threats to kill the new supreme leader. Iraq has shut oil port operations. Brent crude prices rise for the third straight session after Mojtaba Khamenei pledges to keep the Strait of Hormuz effectively shut. Meanwhile, gold prices have risen following a two-day drop as the markets weigh the geopolitical risk premium against the inflationary impact of surging oil prices. Wall Street indices closed the session sharply lower as crude prices surge, further exacerbating the inflation fears. Markets in Asia follow suit, opening lower. The GIFT Nifty is also indicating a gap down start for our own markets. India's inflation accelerates to 3.21% in February, slightly higher than expectations. However, the inflation remained well within the Reserve Bank's tolerance band of 2 to 6%. The margin rise was largely driven by food prices. The impact of the Gulf War will be captured in the data for March. And India's largest stock exchange, NSE, gets ready to go public. Sources say that it is eyeing a valuation of more than 5 lakh crore rupees. The size of the IPO is likely to be around 20,000 crore. It's the final trading day of the week. We are here with Power Breakfast right here on CNBC TV 18 in the Mumbai News Centre. I'm Hormas Fatakia. Let's first take a look at how the Asian markets have started off this morning. And well, just on similar lines to how Wall Street left off last night, it's an equally red start, if not more, across the Asia Pacific. The Hang Seng is down 0.7%. The Taiwanese index is down 0.6%. The losses are coming in from the Nikkei and from the Kospi as well in South Korea. The Nikkei is down 2% and the Kospi too is down almost 3% in South Korea. So the indices across the Asia Pacific are not showing any semblance of relief whatsoever, moving in line with how Wall Street performed last night. Pull up the GIFT Nifty, they give you an idea of how our own markets are likely to start off. And after yesterday's pain, there is some more in the offing. At least that is what the implied open is currently suggesting. 160 points lower is where we are likely to start off, and at this pace, if this holds on, most probably opening around that 23,500 mark on the index. So not good going for the Asian markets, and a projected not so good start for our own markets as well. And that is courtesy our top story, where we continue the updates from West Asia. Iran's supreme leader Mojtaba Khamenei released his first remarks since succeeding his slain father. He said that Iran will avenge the blood of its martyrs, keep the Strait of Hormuz closed, and attack US bases. Meanwhile, Israeli Prime Minister Benjamin Netanyahu issued a veiled threat to kill Iran's new supreme leader. He said that he has added another goal to create the conditions for the Iranian people to overthrow the terrible tyrannical regime. Now, in the meanwhile, Israel and Iran continued to launch strikes at each other, targeting key cities in both countries. And here's what US Energy Secretary Chris Wright had to say on the possibility of the US Navy escorts for ships in the Strait of Hormuz.
It'll happen relatively soon, but it can't happen now. We're simply not ready. All of our military assets right now are focused on destroying Iran's offensive capabilities and the manufacturing industry that supplies their offensive capabilities.
Do you think by the end of this month, the U.S. Navy will be escorting some of those ships through the strait?
I think that, yes, I think that is quite likely the case. But again, I mean, I'll be over at the Pentagon later today, but that is what the military is working on.
And continuing on our developments from the White House as well, Vinny is here in our special segment, Trump Watch. Vinny.
Hi, morning. Thanks so much for that. Now, some updates coming in from President Trump. President Trump said that the situation with Iran is moving along very rapidly and doing very well. The military is unsurpassed, is what he's saying for the U.S. military, with nothing like it that they've seen before. He said that Iran as a nation is a nation of terror and hate, and a big price is something that they are paying right now because of that. Listen in.
The situation with Iran is moving along very rapidly. It's doing very well. Our military is unsurpassed. There's never been anything like it. Nobody's ever seen anything like it. And we're doing what has to be done. Should have been done during a 47-year period. Could have been done by a lot of different people. They chose not to do it. But they really are a nation of terror and hate. And they're paying a big price right now.
Moving on, President Trump speaking to Fox News on some of the difficulties that they're facing in terms of vessels wanting to pass through the Strait of Hormuz. He's suggested that they should go through the Strait of Hormuz and show some guts. He adds that there is nothing to be afraid of. They have no navy and we have sunk their ships, is what President Trump said and commented. Moving on to the last commentary that's come in, U.S. President Donald Trump also is saying on a Truth Social post, where he pressed Federal Reserve Chair Jerome Powell to cut interest rates immediately rather than wait for the next policy meeting. The comments come in ahead of the Federal Open Market Committee's March 17th meeting that will be there, when the Fed's 12-member rate setting panel will decide whether key changes are to be made to the interest rate as well. So again, one more post coming in where he's taking a hit at Jerome Powell.
Vinny, thank you for that update there. And continuing with our updates from West Asia, the developments have led to oil prices continuing to remain above the mark of $100, especially for Brent. It closed above 100 for the first time after 2022. Manisha Gupta is now joining in with all the updates from the commodity space. Manisha, good morning. No let-off in oil prices, at least for now.
Oh, well, absolutely. And with the kind of statements that we have heard coming in, and as you have been telling our viewers as well, so the Iran's new official premier is now saying that the Strait of Hormuz is not going to be open, and the U.S. president saying that oil price is a small price to pay for what they are looking at to change in Middle East. Well, that has led to premium staying in case of prices, with markets believing that a near floor now is at 90 and at 85, and the prices can go much higher from here on, depending on how long this conflict is prolonged. But you know, Hormuz, it's not just about the crude oil prices. The heating oil, the gasoline prices have gained up as well. And that exactly is the case with metals. Take a look at the steel prices, multi-month highs onto that one. Iron ore prices have surged as well. Aluminum is trading at a new 4-year highs, as nearly 9% of aluminum comes in from Middle East. And we do understand that some major smelters in Qatar and Bahrain have shut down. And that really seems to be supporting the aluminum prices as well. So whether some of these metals and energy, I mean, these two are the sectors that have continued to surge in the day-to-day as well.
Manisha, thank you for that update. And the recovery has already been seen in oil prices after that brief dip that we saw earlier this morning. Take a short break. On the other side, we set you up for the day's trade with our research team. Stay tuned. Welcome back on to action from Wall Street, where the indices closed sharply lower on Thursday and led by rising oil prices and the escalating conflict with Iran, rattling investor sentiment. The Dow Jones was down nearly 750 points. The S&P 500 and the Nasdaq also ended the session with cuts of over 1.5%. Worries over global oil supply disruptions have triggered a broad sell-off. CNBC's Peepa Stephens gets us a wrap of all the action on Wall Street.
Markets were down sharply across the major indexes in Thursday trading after oil prices spiked again and settled above $100 per barrel. The Dow dropped by 739 points, the S&P fell 103, and the tech-heavy Nasdaq was down 404. A rarely bipartisan Senate on Thursday passed new legislation aimed at boosting housing supply and bringing down prices. Sponsored by Democrat Elizabeth Warren and Republican Tim Scott, it passed with 89 votes. The legislation creates grants and pilot programs for construction, cuts some red tape, and prevents Wall Street from buying large numbers of single-family homes. It faces an uncertain future in the House, though, and President Trump has signaled he's more interested in passing new voting legislation than the housing bill. And Google is overhauling its Map app to rely more heavily on AI. A new feature called Ask Maps will give suggestions to users looking for things like places to charge their devices or cafes with short lines. And a new tool through Gemini dubbed Immersive Navigation will show a 3D perspective to make directions more intuitive.
And after this global market action, let's set you up for today's trade. Our research team is here with the trade setup, the stocks that should be on your radar, and of course the setup on the F&O side of things as well. Firstly, Gaurav joins in to get all the market cues we need to watch out for. Gaurav, good morning.
Well, yes. First, let's talk about the West Asia war. If you look at the comments which have come overnight, first is that from Iran, it is clearly indication that the Strait of Hormuz must remain closed. But on the other side, if you look at the commentary from President Mr. Donald Trump, he says that there shouldn't be any worry for any transit from Strait of Hormuz. In fact, US Energy Secretary also said that the escorts for the ships will be quite likely be ready by the end of this month. So US seems to be showing some support, but at the same time, Iran is not showing the same signs. On the other hand, we also saw Iraq shut down its port operation, oil port operation, and that is also something which triggered the crude oil prices and LPG prices as well. If you look at Nifty, yesterday we also saw Nifty actually declining. It settled around 23,600. Now, implied GIFT Nifty suggests there will be some downside as well. But if you look at the support level, 23,500 still looks like a promising support, while on the upside, 24,000 looks like a resistance level. On the sector-wise indices, if you look at Nifty Autos, it was a biggest seller. In fact, in this month itself, we are seeing it has lost almost by 11%. On the other hand, Nifty Energy was a big gainer. So let's watch out if these sectors continue to remain in the same trajectory that were there yesterday as well. If you look at some of the other action, now the big news is that NSE's IPO is getting ready. As per sources, they are going to eye on valuation up to 5 lakh crores, and the IPO size is likely to be somewhere in the range of 20,000 crores. Now, let's watch out for that as well, because this will also have some impact on BSE. Let's also not forget about Swiggy and Zomato. These companies will be in focus because Oil Ministries has said that 20% of the average monthly commercial LPG will be allocated to restaurants and eateries. So let's also watch out for these stocks and see how they perform in trade today.
Gaurav, thank you for that update. Over to Upasana now, who will list out some other stocks that should be on your radar today. Upasana, good morning.
Good morning, Hormaz. First up, let me start with Max Financial Services. Board has approved fundraising worth 2,000 crore via QIP or other methods. The proposed fundraising is to meet the funding requirement of Axis Max Life Insurance. Next up is Balaji Amines. It faces a logistics disruption in ammonia procurement due to West Asia war, and some of the plants of the company have seen a temporarily non-operational amid ammonia shortage. Next up is JK Lakshmi Cement. It has declared as the preferred bidder for the mining lease for limestone block in Assam. Biocon also in focus as the company's wholly owned subsidiary, that is Biocon Pharma, has received US FDA approval for liraglutide injection, which is used for type 2 diabetes. Kalpataru is the next one on our radar. It has signed a redevelopment project in Andheri, and the project spans across 3 acres of land, and the GDV for this project is around 1,400 crore is what the company has indicated. Godrej Properties also in focus as it has announced an acquisition of 44-acre land parcel in Coimbatore with an estimated revenue potential of 450 crore. Gravita India is the next one. It has signed a definitive agreement for acquisition of 98.9% stake in Rashtriya Metal Industries for a total consideration of nearly about 559 crore. KPI Energy also in focus on the capacity expansion. It has expanded solar capacity by nearly about 35 megawatt peak. And lastly, coming to Keynes Technology, the stock remains in focus on the back of a block deal. BofA buys 1.16 lakh shares at 3,614 with a discount of 3% as compared to yesterday's closing, via block deal worth 42 crore is the overall value. So all in all, we'll be watching out for all these stocks in today's trading session.
Upasna, thank you for that update. Over to Sudarshan now for the FNO setup. Sudarshan, good morning. Well, every recovery on the Nifty got sold into yesterday, and the GIFT Nifty is indicating some more pain.
Good morning, Harma. So it's Friday the 13th, and the key question is, will we get some respite from the continued fall that we have been seeing in the market? Well, the data does not indicate to us that. And also the another negative cues, and it's been there for the last few days, is the crude, and it continues to hold the levels of $100 per barrel. Now, 25,000 for Nifty is gone, 24,000 is gone. Now the key question is, will Nifty manage to hold levels about 23,000? Because yesterday, the put options below 23,000 have become very active. So I've taken some of the levels. So yesterday's low for Nifty was 23,556. Last low, and it's Nifty is now at 1 year low. April 17, 2025, the low was 23,300. If we breach that, next support comes around 21,744, and that was on April 7, 2025. So we'll have to see how market behaves, and it all depends which direction West Asia war takes. Now coming to the options data. Put option. There was a tug of war between put writers and call writers for 23,600. This put option and the call option was very active. On the put side, it added 26 lakh shares in the open interest, with premium rising to 221. On the call side, added 17 lakh shares, and premium has fallen to 290. And after 23,600, another put option was active, was 23,000, and after that 22,950. So support, immediate support would be 23,300, and immediate resistance for Nifty would be 24,300. Now talking about the FI's flow, they continue to be on the sell side. In the index future, yesterday also they have sold more than 3,000 crore. In the stock future, they have sold more than 11,000 crore. They have reduced long position by 1,100 contracts, and for the second straight day on the short side, addition was more than 18,000 contracts. Two stocks remain in the band. Those stocks, you know, Sale and Saman Capital. Some of the stocks keep an eye, and these stocks have seen fresh short additions: Amba Enterprises, Eicher Motors, Godrej Consumer, and Colgate.
21,745, the April 7 tariff low, the most important level to watch on the index. Take a short break. Sudarshan, thank you for that. On the other side, get you all the updates from the world of AI. Stay tuned. Welcome back. On to the latest offerings now from the world of tech in our new segment, the AI Pulse. Rachna is joining in with more on this. Rachna.
Well, the biggest flashpoint is unfolding in Washington days after labeling Anthropic a supply chain risk. Pentagon CTO Emil Michael told CNBC that Anthropic's Claude models could pollute the defense ecosystem because of policy guardrails embedded in the system. Those guardrails restrict assistance for lethal autonomous strikes and certain surveillance uses. Now, Anthropic argues that what exactly military AI should be, what a responsible military AI should include. At the same time, the Pentagon has acknowledged that it cannot simply remove Claude overnight, despite calling it a polluted version now. Now, with Palantir CEO Alex Karp confirming that his company still uses the technology in some workflows, even as the dispute unfolds, Anthropic is also exploring new commercial partnerships. Reports suggest that the company is in talks with private equity firms, including Blackstone, to create a joint venture that would deploy its Claude AI systems across portfolio companies. Meanwhile, OpenAI CEO Sam Altman has been in Washington too, facing questions from lawmakers about the role of artificial intelligence in warfare. Senator Mark Kelly, a former astronaut and a combat pilot, said he raised concerns about how AI could be used inside military kill chains. Now, Altman says OpenAI's Pentagon contract includes safeguards, including bans on domestic mass surveillance and requirements that humans remain responsible for lethal decisions, and added that the company disagrees with the Pentagon's decision to label Anthropic a supply chain risk for raising those exact red lines. Now, beyond defense, the competition among big tech AI labs is also heating up. Meta, according to reports, has delayed its next-gen AI model, codenamed Avocado, after it fell short of Google's Gemini 3.0. Reports also suggest that Meta is even considering temporarily licensing Gemini to power some of its AI products. This is an unusual step for a company that has positioned open-source models like Llama as its core strategy. Google, meanwhile, is also expanding Gemini deeper into its products with a new Ask Maps feature that allows conversational queries inside Google Maps, alongside what it calls the biggest navigation update in more than a decade, rolling out in the US and India. There's also a major leadership transition underway in the creative software world. Adobe CEO Shantanu Narayan says he will step down after nearly 2 decades, though he will remain chair of the board as the company now navigates growing competition from Gen AI tools. AI is also reshaping the battlefield, as we've known in the last couple of days. Ukraine now says it will open access to its vast drone combat data set, including millions of annotated images from real missions to allied countries and defense companies to train artificial intelligence systems. Kyiv has also sent anti-drone specialists to several Middle Eastern countries facing Iranian Shahed drone attacks that have been in the news as the US-Israel-Iran conflict has been going on. Back to you.
Well, all the developments there from the world of tech and AI. Rachna, thank you for those updates there. Take your leave on this edition of Power Breakfast. We leave you with the GIFT Nifty still down 160 points as we speak. Bazaar morning call on the other side sets you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Muthoot Oswal studios. I'm Prashant. With me, my colleagues Reema and Mangalam. Guys, good morning.
Hi, good morning. All I can say is thank God it's Friday, right? Yeah. It's been a tough couple of days for the markets. In a span of the last 2 days, the Nifty itself has fallen more than 650 points and the Sensex is down more than 2,000 points.
You know, it's that kind of a week where if you ask a technical analyst where the resistance and the support lies for the market, they say that the resistance is at 9:15 in the morning and the support is at 3:30 in the evening when the market shuts. But that's clearly been the case. You know, every once in a while where the market does see some signs of recovery, that recovery has been vehemently sold into, and every morning we come with a big gash. And this morning as well, the GIFT Nifty indicating a cut of over 150 points. But Prashant, no relief coming in whatsoever.
Well, no relief, Mangalam, and I think that is absolutely the case, and that's the headline, right? West Asia war, no relief, oil at $100 a barrel, and it kind of sort of tells you everything you need to know. I was sometimes wondering, and maybe we'll talk more about this during the course of the day, whether, you know, the markets at some point will just get tired of all the selling, right? On the upside, sometimes the market just loses momentum because it gets too weighty, and we've not been in that kind of a phase for a long while, and sometimes things happen in the same way on the downside as well. That's, of course, a conversation we'll have. But for now, it's, of course, negative. Oil prices closed above $100 for the first time since 2022. You know, and you had Iran the new supreme leader, who essentially said that Iran would keep the Strait of Hormuz closed. So that was basically his first communication to the outside world. You had the Treasury Secretary, Scott Bessent, who said that he believes U.S. Navy will be escorting vessels through the Strait, commercial ships and oil vessels through the Strait of Hormuz as soon as it is militarily possible, which basically means that it is not militarily possible or feasible right now. That's the point here. You know, the other point, and I just wanted to highlight, not getting too much attention, but I think it's important. Yesterday, Reuters reported while we were trading that Iran has, and they cited sources and said that Iran has laid about a dozen mines in the Strait of Hormuz. You know, the reason it's important is because if it was confirmed, I mean, and they had laid mines, from whatever I read, it's not easily reversible. But thankfully, last night, and if we go by, of course, we'll have to go by and take everyone at their face value. Last night, Iran's deputy finance minister said that they're not laying mines in the Strait. So that is, you know, I just wanted to sort of highlight that. Iran's new supreme leader essentially also said that it will look to open other fronts in the war if US and Israel persist with their attacks. Also, you had Benjamin Netanyahu, the Prime Minister of Israel, who essentially said, and this is getting a fair bit of press, that Iran regime change is not guaranteed after the war. So lots of stuff being said from both sides, but I think the basic message is that it doesn't look like anyone is backing off. I mean, Trump, of course, tried to walk back some comments, and he said this a few times, that it'll be over soon, I can end it, and there's nothing left to bomb in Iran. But Iran and, of course, Israel, as we've heard from both sides, I mean, I think there is no letting up as of yet. So that's said. Now, let's just look at the price action, right? This is the S&P 500, NASDAQ, and the Russell 2000, all deep down in the red, 1.5, 1 3/4, and the Russell down 2%. Oil prices, you know, 9.9 higher. This was the close, $101, and we're at about 100 right now, 100.5, so around there. You know, the benchmark bond yields continue to move higher, 3 basis points, and I think in the last 3 days, we've seen about, 16, 17 basis points moving up. And of course, I mean, this is fears of energy inflation pushing out expectations for Fed easing, which actually came through. By the way, President Trump last night called out Fed Chair Powell and essentially said that he must cut rates now. So he basically repeated some of those demands. Adobe shares were down 6%, the reported numbers, and I think the CEO is leaving. Banks in the US fell because all the focus has been on Iran and oil markets. I think people have kind of sort of forgotten about the private credit concerns. We've spoken about this a few times in the last 1 month. There were fresh reports, and we'll detail these out, flesh these out in a bit from now. Redemption requests from private credit funds forcing Morgan Stanley and Cliffwater LLC to cap withdrawals. By the way, a group of these stocks, right, which is you can broadly put them in the bucket of alternate asset managers in the US. They're down 33% in 2026 so far. So I thought I should just highlight that. As I said, we'll talk more in a bit from now. Now, I'll just leave you with levels. We are already at about 23,600. Unless and until something changes the margin, the slide, there's nothing to stop that slide. I began by saying sometimes just markets get tired of selling off and on the other side rallying non-stop. Letting that aside, I mean, you need something to turn, something to change. Otherwise, that slide, we're in a bit of a one-way slide here. Buying will come at some point. These things are cyclical, but for now, it's another gap down open. Immediate resistance, very immediate resistance, above which things will start to look a little better. Some hope, maybe longs come in. 24,305 is that level. Because there have been so many large gaps, right? You're suddenly looking at 25, 24, 23 all happening within 5-6 days. Just those big handles moving around. GIFT Nifty up on your screen. It's down another 180 odd points lower to begin. That's the implied open. The positioning and the stats, Mangalam has got all of that as always. Mangalam, take it away.
Take that point, Prashant. At some point there will be some recovery, but those are just hopes, and hope, unfortunately, not a data point right now. The Nifty Bank, the mid-cap index, all of them sold off in yesterday's trading session. It was volatile. The mid-cap index did not fall as much as the frontline indices. But then again, every time there is a bit of a relief rally at higher levels, selling resumes with a lot more force. For yesterday, the range of the market was fairly wide as against what we've seen earlier. The low was 23,556, the high was 23,833. On either side, if there is a breach, the market would decide the next course of action. And as of now, given the GIFT Nifty's opening, it does indicate that it would be below yesterday's low as well. So in this week itself, we would have then made 3 panic lows, one on Monday, one on Wednesday, and the other one will be today. One on Thursday, and the other one will be today. The FII selling, that continues unabated. Yesterday as well, there was 7,000 crores worth selling. Net flows were just around 450 crores. The DI has bought about 450 crores. The important part, however, is that day before yesterday's selling was on lower volumes. Yesterday, gross volumes were also very high. 15,373 crores on the buy side, 24,000 crores on the sell side. That's a good 15 to 20% higher than what we've seen in the average of March. And then comes the selling in index futures. That also continues unabated. In the last 4 sessions, they've sold on 3 occasions over 3,000 crores. It was just one day where they actually bought 1,100 crores, and that was the day where the market did see some sort of relief rally, where the oil prices were at the lower end of the range that they were trading at. The FIs continue to sell shorts in the index futures, 19,000 short contracts added yesterday as well. And with that, their net contracts are now at 2.26 lakh negative, and the long exposure has dropped to 10.6%. That's the lowest that we've seen in a very long time. All trades are on the short side. At some point, the market reverses. There would be a big, powerful short covering rally, but as of now, doesn't seem like. What are the option writers doing? 23,600 seems like the fulcrum, where the 23,600 call and the 23,600 put have been fairly active. 23,600 put writers would hope for some support to come by around 23,380 to 23,400. Whereas, the 600 call writers would expect supply to emanate at around 23,900 to 24,000. So the broad range today, 23,380 to 23,900 thereabouts.
Well, already we've seen a fall of 3.5% so far this week and more than 6% in March. That's the start of the conflict. Let's get you some equity calls then. It's Mahesh Nandarkar of Jefferies who says their analyst bottom-up top ideas refresh has 23 buys and 18 underperform calls out of a total coverage of 247 stocks. The fresh inclusions to the buys are SBI, Star Health, Grow, Bharat Forge, JSW Steel, Eternal and Max Healthcare. The new underperform call ideas are Hyundai, Cipla and Wipro. 2 of their previous underperform ideas, Delivery and Loris, have now been upgraded to a buy and hold respectively. Meanwhile, on the Nifty, Lawrence Belanco of CLSA says the continued weakness below 24,300, 24,500 area has now seen market break below the February and March highs at 23,700 to 23,800 area, provided by the upper boundary of the March-April double bottom pattern. Basically, what he's trying to say is that this leaves the market vulnerable to a further weakness, with the next chart support coming in at 21,777 to 21,800, all the way down to 21,800. He also says that 24,300 to 24,500 area is now seen as resistance, with the 50-day and the 200-day moving average coinciding around 25,340, 25,380. That will be the next support for our markets. All right, let's move on then and get to some global calls on the way we should approach markets. US and Israeli strikes on Iran and the subsequent response from Tehran have widened the tensions. But as a result, shipping continues to remain paralyzed through the Strait of Hormuz, disrupting crucial oil and gas flows and sending oil prices higher. Amid this, US Treasury Secretary has said that US Navy, with an international coalition, is to escort vehicles through the strait once it is militarily possible. Listen in.
That was always in our planning, that there's the chance that U.S. Navy or perhaps an international coalition will be escorting oil tankers through. There are, in fact, tankers coming through now, Iranian tankers, I believe some Chinese flag tankers have come through. So we know that they have not mined the straits. Words not mine. But again, it is my belief that as soon as it is militarily possible, the U.S. Navy, perhaps with an international coalition, will be escorting vessels through. We've been planning. We have complete control of the skies and are degrading their. They have no air force. The Navy is sunk, literally and figuratively, and the munitions factories, the rebuilding capabilities for the missiles, the completely degraded. So as soon as it is possible for to ensure safe passage, we will do it.
Okay, that's important statements coming in from Scott Besson. For now, Asia is down, mirroring the fall that we had on Wall Street. Kospi, Taiwan, Nikkei, all down close to about 1%. And investors see, okay, there's been a recovery in Hang Seng and Taiwan, but if you pull up a Kospi and the Japanese market, you can see a fall of more than 1%. But in a nutshell, investors seem to be bracing themselves for a prolonged war in Middle East. And the latest statements from Washington and Tehran are suggesting both leaders perhaps are doubling down, with Iran saying that the Strait of Hormuz will remain closed as a tool to pressure the enemy, while Trump on Truth Social said that preventing Iran from having a nuclear weapon and threatening the Middle East is of far greater interest and importance to me than the cost of oil. Drew Pettit, Director of U.S. Equity Strategy, ETF Analysis and Strategy Research at Citi, is now joining in. Thank you very much for joining in. Now, you've been bullish on the U.S. markets, the economy, but at what point does the war, the rise in Brent crude prices, perhaps what's happening with the private credit market, break that bullish narrative for you?
So fundamentally, we're not there yet. We actually still think our street high 320 in earnings might actually be conservative still. Look, the growth side of the market, the secular trends are still in place. That's a big driver, not just to multiples, but also to fundamentals. But what breaks the narrative here is if interest rates stay higher and oil volatility stays high, I think against that backdrop, it's hard to put a 24 times multiple on the market. And we're seeing that today. Really, markets are taking their cues from oil volatility, and the longer that stays elevated, the harder it is to remain bullish.
So now rate cut expectations from the Fed in 2026 have pretty much been dented. We started the year with 2, it came down to 1 about a week back, and now increasingly people are saying there's a possibility we will not have a rate cut by the Fed. Now, you said if interest rates remain high, if there is no rate cut, does that challenge the bullish narrative for you and crude prices stay around 100?
It does, but I would say when we really think about the Fed and what they focus on, it's core inflation. And I think they would look through oil shocks. At least that's our City House view, especially if we see weakness in the labor market. So to us, House view is rates at the front end still come down. It's just the stickiness of CPI and I would say input costs that might hit the 10-year point of the curve, which we focus on more for equities, might keep that a little bit higher and stickier. Again, rates lower is more supportive of a higher equity multiple. I think at 425, it's really going to be hard to justify higher multiples from here.
Got that. Drew, what's the city view in that sense? How long does this war go on?
So this is a really tough one to handicap. And look, I don't probably have any more incremental insight than anyone else that's sitting outside of Washington or outside of the conflict. But what we're seeing is Brent crude around 85, 90 bucks. To us, the market in that sense is pricing in 4 to 6 weeks for conflict. The fact that Brent's broken above that to 100 is you're starting to see the market's pricing in a more prolonged conflict, potentially outside of that 6-week window. So again, I don't have insight, but we think market pricing probably in that kind of 6-week range right now.
Right. So you have no insight, but I'm sure you guys did a scenario analysis. And in that, what are the bear case estimates and what are the base case estimates?
So look, earnings from here, I would say the biggest pressure is that inflation differential on cyclicals. That's where you can honestly see something more like maybe 300 on earnings. In that case, market probably wants to trade down to, I would say, like 20, 22 times. That's our ultimate bear case for the year. But thinking about this from a relative sense, it's places like Europe and Japan that might actually get hurt more than the United States in a prolonged higher oil rate environment. US, in a sense, acts relatively defensive in this case. And I would say positioning in large cap isn't as extended as it was 6 months ago.
What's your view on India right now?
So look, we're neutral. We haven't adjusted any of our EM ratings. Really, India had a good growth story, good cyclical story before we got into the conflict. We were just a little bit kind of worried about valuation, but a lot of things have derated here. We're still overweight EM. A lot of the EM trade to us ties to AI. And again, that's where positioning's been really aggressive and we've seen the most pullback in the last few weeks.
Good chat, Drew. Always thank you for joining us here on CNBC TV 18. A quick one, but provide some idea about, of course, I mean, everyone is a little uncertain about how this plays out from here and tough to build out firm kind of ideas, projections, because things are so fluid. Thank you once again. We'll take a break. We are back with more in just a bit, but here's what's coming up over the next 2.5 hours. 8:35, the management of Borosil joins us to discuss the impact in production due to LPG cuts. So Shrivar Keruka will be with us. 9 o'clock, Digant Haria of Green Edge Wealth Services. And of course, banks and the weakness in banks has been a big one. Private versus PSUs. You heard from Sridhar Sivaram yesterday. 9:20, Nilesh Shah of Envision Capital will be our market master of the day. 9:30, PG Electro Plus Management. Impact of LPG shortage. They, of course, told the exchanges that it is actually hurting. 9:40, Dilip Bilcon Management comes on after a long time. Jal Jeevan Mission and the implications for the company in focus. And towards the end of the program, Latha discusses the impact of surging crude and falling rupee on India's macro. Samiran Chakrabarti and Abhishek Upadhyay will be her guests.
Welcome back. Let's talk stocks now. Our research team is standing by with CNBC TV 18's list of top stocks for the day. Manglam, you go first.
Well, over the last couple of days, the big news was that restaurants are running out of LPG, gas, and then there were a lot of pictures doing the rounds where the most complex South Indian dosa chains were impacted by a small little, dent in the Strait of Hormuz. And that exactly is now coming undone because of the narrative that was there and because of the fear mongering and perhaps, fears of black marketing or hoarding of LPG cylinders. The government has gone ahead and they said that Centre will also release commercial LPG cylinders on priority to curb panic-driven bookings and restaurant shutdown risks. And as a result of which, 20% will now be allocated to this, to this sector, restaurants and eateries. So expect some sort of relief coming in on all the quick service restaurants, on Zomato, as a result of which Eternal and Swiggy as well. These stocks have been beaten down over the last few trading sessions because of fears of shutdown and low volume sales.
Absolutely. Well, Eternal Swiggy up on your screens right now. More stocks with news flow. Upasana is here with that list. Upasana, good morning.
Good morning. First up, let me start with Max Financial Services. The board has approved fundraising worth 2,000 crores via QIP or other methods. The proposed fundraise is to meet the funding requirement of the company's material subsidiary, that is Axis Max Life Insurance, and this is mainly for supporting the business growth and expansion plans of the company. Next up is Kalpataru. It has signed a redevelopment project in Andheri, and the project spans over 3 acres of land, and the gross development value here is around 1,400 crore is what the company has indicated. Godrej Properties is the next one on our radar. It has announced acquisition of 44 acres of land parcel in Coimbatore. Through an outright purchase, the company plans to develop a premium plotted residential project with 1.1 million square feet, and estimated revenue potential here is around 450 crore is what the company has indicated. And lastly, coming to Balaji Amines, it faces a logistic disruption in ammonia procurement due to West Asia war, and some of the plants of the company have seen a temporary non-operational because of the ammonia shortage is what the company has also indicated. So all in all, we'll be watching out for all these stocks in today's trading session.
Right, and a bunch of other stocks that would be on our radar. Vinny joins in with that list this Friday morning. Vinny.
Hi, morning Mangalam. So first up, we have Gravita India. Some positive news flow here after the company has actually signed a deal to acquire 98.9% stake in Russia Metal Industries. 560 crores approximately is the price that they'll be paying. And this move is actually going to help them in strengthening their recycling portfolio. The acquisition will be closed by the end of the month as well. So keep an eye out on that one. JK Lakshmi Cements, that's the next one. Again, some positive news flow after the company has been declared as a preferred bidder for a massive 405-hectare limestone block in Assam. Apart from that, there's additional news flow that the board has approved an acquisition of 77.9% stake in NSE Cements, which is going to help them expand their footprint in the northeast region. Lastly, Shelly Engineering also positive news after small cap World Funds has bought additional 2% stake in the company, but that is around 6.4 lakh shares. Previously, as on December 2025, small cap World Fund held around 5% stake. Now it will go up to around 7%. So again, keep an eye out on this one.
Thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are Eternal, Swiggy, some relief for QSR companies, Max Financials with the QIP news, Kalpataru, Godrej Properties, Gravita India, JK Lakshmi Cement, Shelly Engineering. Balaji Amines could be the only stock, at least on the back of news, or at least where there is negative news. But the markets per se might open lower. That's what the Gift Nifty is suggesting. But let's talk about commodities. It's not just Brent, which is at $100 per barrel, but Manisha, even the other commodities like aluminium, iron ore are all surging today.
Oh, well, absolutely. I mean, look at the markets and you're looking at all those commodities surging higher, which have some or the other connection with the Middle East as of now. So, well, yes, while the crude oil prices are holding or liking that 3-digit number there, it also has to do with the kind of statements that we seem to be hearing from all sides. Iran's new premier now says that come what may, the Strait of Hormuz is not going to be opened. The U.S. president, in the meanwhile, has said that oil price is a small price to pay for what he's out to do. So these kind of statements will continue to support the premium in crude prices. But well, yes, as you mentioned, it is the metal prices also surging. You have steel prices now gaining nearly 9% in the last 1 month, the major of those gains coming in the matter of last 1 week itself. Iron ore prices have continued to run as well, as the movement of the raw materials within Middle East almost seems to be getting constrained. And most of the stuff that cannot come out or go into Middle East seems to be getting delivered into China. So that is what the street is watching out for. And aluminum clearly is the outperformer in the overnight market. We've seen another 3% of gains. It's trading at a 4-year high. $3,500 a ton has been taken off. Major smelters in Qatar and Bahrain seems to be getting shut. And with China, Indonesia issues in sense of production, you perhaps are looking at aluminum continuing to outperform the overall metal sector.
All right, Manisha, thanks a lot for that. So everything is higher on the commodities front. So to that extent, obviously, the upstream companies for both metal and oil would be on our radar. Let's see how that pans out for the users of those commodities. So far, we've seen fears of margin compression or perhaps, higher raw material prices, and as a result of which production cuts as well. In fact, that's the exact conversation that we will have with the management of Borosil after this short break, where we discuss impact on production due to the LPG crisis. Shrivar Kheruka joins in. Hi, welcome back. You're watching us here on Bazaar Morning Call. One of the most awaited IPOs of the last many years, and now is NSE. It's got an IPO ready. Nimesh joins in with more details on who the bankers are, what the valuations could be, what the numbers are. Nimesh, it's an exciting time from the IPO market purely because of the talk around NSE's IPO?
Oh, absolutely, Mangalam. This is going to be a landmark and one of the biggest IPOs to track in the very near future. So big IPO, and in fact, NSE is the number of retail shareholders is the highest in the unlisted space, and that is the NSE IPO. So a big IPO in the waiting for a very long time. Finally, looks like it's going to have a reality. So yesterday, NSE has announced appointing 20 investment bankers and 8 law firms. So that was an official announcement which came from the NSE side. And after that, my colleague has put out some further details as far as the IPO regarding to the IPO of NSE. In terms of the valuations, given the unlisted stock price and the current valuations, looks like NSE will come out with an IPO of with a valuation of close to 5 lakh crores or upwards. So that's something to watch out for. It's going to be a complete OFS. They don't need any money, and basically it will be a dilution of close to 4 to 5% via an OFS. The way this will work is now NSE will ask all the existing shareholders, including the institutional shareholders and retail shareholders, if they want to tender in the OFS. So first those shares will be received, and then the IPO process will go through. The IPO size could be in the range of 20,000 crores. That's the exclusive details that we picked up. And also, while there are no official comments from the NSE right now, this is something to watch out for. Nearly 20,000 crore IPO, a valuation of close to 5 lakh crores, as and when NSE comes with an IPO. And officially, it was announced last evening that they've already appointed 20 investment bankers and 8 law firms.
Thank you very much for that. That's the big one to track. Before now, let's get going with the corporates then on Bazaar. The first one is Borosil. Yesterday, shares were under pressure. Stock was down close to about 6-7%. Shrivar Kheruka, MD and CEO at Borosil, is now joining in because the company's production has been impacted on account of OMC cutting the supply of LPG to some of the facilities for Borosil. So we'll talk more about it. We'll talk about the production impact, if there has been any surge in induction cooktop sales and the company's expansion plans. Thank you very much, Shrivar, for joining in. So now you've intimated to the exchanges that production at the borosilicate glass furnace in Jaipur has been completely temporarily suspended, while at the opal glass furnace that is operating at lower capacity. So the first question is, what is the production volume loss and the estimated daily revenue loss on account of this?
Well, thanks for having me. At the moment we have 3 furnaces in Jaipur. 2 are operating and 1 is currently suspended. The challenge we have is we use electricity as well as LPG. Of course, electricity supply is fine, but the LPG part is being impacted because of the ongoing issues of LPG supply. The current, from a percentage perspective, we're about 1/3 down at the moment, but it's a dynamic situation, and we are really trying to work out how we could get supply restored, without which we'd have to go to 100% off in the next couple of days. So I think is a force majeure kind of situation, and we're trying very hard to see what we can do to get out of it.
So you're saying as of now, 1/3 of your production has been impacted, and there is a possibility that that becomes 100%.
That's right.
In how many days? What is your own internal assessment?
So if we don't get resupply, then it's in the next couple of days that we'll have to. Yeah.
Do you have inventory right now, or will this show up in your Q4 numbers?
No, so as a consumer products company, we do have sufficient inventory to sustain sales. There will be no sales loss, if it's a temporary situation. So I don't see a challenge on the sales part, but obviously production costs have gone up substantially because of this impact.
To what extent have production costs risen?
Well, if you think about it, glass manufacturing is a very high fixed cost business. All our fixed costs are on, and if the production is not on, then the costs have gone up. It's doubling, tripling the costs. Obviously, it's only a temporary period, we hope. So we do anticipate that at some point it'll get restored and then costs will come back down. But at the moment, it's pretty dramatic increase in costs.
Would you be able to share a number?
It's hard. It's hard. Like I said, it's maybe doubling our costs, maybe even tripling our costs if we have to pay, for operating at much lower capacity utilization, owing to the high fixed cost nature, and it's kind of reverse operating leverage you have right now.
So for Q4, is it fair to say your top line will not be impacted despite the production cut because you have sufficient inventory? So Q4 should be fine, but margins in Q4 will show the impact of higher costs?
Yeah, I mean, look, it's happened at the fag end of Q4. So as far as revenues are concerned, there's no impact at all. And we have enough stock to sustain us for the next couple of months even. But as far as the margins are concerned, yeah, there'll be some minor impact in Q4 because it's happened in the last, say, 15 days.
Right. Production aside, how has demand been? Because on the one hand, we've seen a big surge in sales of induction cooktops, microwave. A lot of the products that you make are, safe for usage on induction cooktops or microwavable items that you're making. Has there been any increased demand for those products in the marketplace? Have you noticed any of that? Or is it just business as usual?
So I think there has, firstly, yes, to answer your question, there has been a substantial increase. I'm getting calls every 15 minutes from friends and relatives saying, I want an induction cooktop. So I guess anecdotally, I have experience with that. But also in general, I think we're all out of stock on the key, say, induction cookers that we have. I think the government has done a pretty good job in increasing LPG supply. So I do think it's a bit of panic overreaction to what we read in the news. But the other thing I'd like to say is actually induction does a fantastic job of replacing LPG. And learning from this crisis, I think we do need to see policy going forward to replace, I would say 80% of what LPG does can be replaced by induction. And I think that's a good kind of policy initiative. Maybe the government will consider post this, which will help us in the future for sure, as a manufacturer of induction cooktop.
Sorry, Shrivar, morning, Prashant here. You said, what will be replaced? I missed that.
I said induction can replace LPG. So your gas stoves can be totally replaced by induction in the future. So learning, and the oil marketing companies, they subsidize LPG for the households a lot. Rather than subsidize that, it could be just easier for them to maybe even gift induction cooktops to their consumers, and then they will stop the subsidy altogether. So I think that's a massive opportunity, but the government has to take a decision on that. But I'm sure they will do that considering this crisis that we are in at the moment.
Just one final word. You've also approved setting up of a new manufacturing facility at Bharuch in Gujarat. And it's about 42 crore of capex that you've outlined as of now. When does this come on stream? How will you fund it? What will be the incremental revenues?
Yeah, so the incremental revenues of this facility are actually, there's again a lot of operating leverage here. So we get about 200 crores of incremental revenues from this. So there's a massive, let's say, leverage there. As far as funding, it's all internal accruals. And the facility should be up and running by the second half of the next financial year. That is 26-27 financial.
All right, take that point. Wish you good luck for, getting out of this situation unscathed and, maybe demand continue for products that you sell. We'll obviously touch base once situation improves and then get a better handle on the numbers, etc. This was a conversation which is more qualitative just to get a sense on what's taking place on the ground. So thank you so much, Shrivar, for joining in and giving us an update on what's actually taking place. We'll take a short break, come back on the other side. Siddharth Khemka of Motilal Oswal Financial Services joins in for some fundamental stock talk.
Okay, welcome back. GIF Nifty will come up on your screen. I think we are lower. And we'll just see if we're low by how much, right? I mean, 240. I think at 8 o'clock when I started, that number was about 180, 190 points. If anything, that is picked up a little bit. I think you can just quickly pull up the price of oil, Brent, and if that is moved up, because nowadays, intraday spikes and sell-offs, etc., the market's very, very sensitive, and those spikes and sell-offs have been very large, 101. So not very much by way of change. I think $1 higher, right, as compared to where we were at about 8 o'clock. Siddharth Khemka is with our Head of Research, Wealth Management and Borosil Financial Services. Sid, good morning. Good to have you here. Thanks for joining us. I mean, just give us some feedback, Sid, and we'll get to the market in a bit, but across clients, etc., and you have a large retail base, you have the MTF book, and you've got everything, right? So what are you hearing from the other side, from people who are investing with you or using you as an intermediary? What kind of activity are you seeing?
Hi, good morning. Yeah, Prashant. So we definitely have a lot of interactions with the customers. A lot of customers have come back to us asking about the views, how things will pan out. We're not seeing that much of panic. People are asking about restructuring their portfolios to move away from stocks, sectors, which could get impacted because of the war or a prolonged war. And even a lot of them are asking us what would be the right time to put additional money if they have. So I think it's varied discussion that we are having, but we are not seeing that kind of panic so far in any of our conversations.
Siddharth, hi. Morning. VATech Vabag, that's a company that you'll study very closely, and it has fairly high linkages to Middle East. So overseas projects contribute about 50% to their revenues, and of that, 60 to 70% of the order book comes in from Middle East. But if I look at the stock price reaction, it's been unscathed. Yesterday, it was up 2.2%. Since the start of the conflict also, it's managed to hold on to all its, to the green line. So tell us a little bit more. Has the company's fundamentals been unaffected? What has been the impact of the crisis, or is there a future risk to earnings?
Yeah, good morning, Rima. So definitely we do have good coverage on VATech Vabag. What we see is that order inflows that continues to remain strong, and the business in the Middle East that continues as usual. Even if you see on the domestic front, they've bagged a large order from Chennai, which is a 1,000 crore order to refurbish 45 MLD TTRO plant for an order execution over an 18-month period, followed by an O&M contract for another 18.5 years. So overall, what we see is a 16,000 plus crores of order book, which is 5 times the FY25 revenue. Plus, they are preferred bidders in over 3,000 crores, so a strong bid pipeline, which provides a strong 15 to 20% revenue growth visibility for the next 3-4 years. With respect to Middle East, we are seeing that project execution so far has remained normal, and given that they are working in the critical and non-discretionary nature, which is the desalination plants, which is very important and core to the existence in some of these regions. I think the business continuity is expected to remain intact, and hence market is not reacting that sharply. Overall, company has reported strong improvement in cash flow generation, in return ratios, and valuations at about 17-18 times on FY27 basis looks pretty attractive to us, and hence we maintain a buy rating and a target price of 1900, which gives almost 50% upside from current levels.
All right, so that's about VATech Vabag. What do you make of Eternal and Swiggy? There were a lot of weaknesses, over the last couple of days because of fear of LPG shortage and that impacting their food delivery business. Now that it's been given some relief, do you think, these make an investment bet?
Yeah, Mangalam, I think the long-term investment thesis on some of these quick commerce, e-commerce companies, that continues to remain. I think in the near term, there is definitely some knee-jerk reaction because of the closures of some of these restaurants and the supplies. I think market will rebalance to restaurants which are trying to provide the food, and hence the balancing act will happen in the near term. But definitely valuation wise, both Eternal as well as Swiggy have come down to pretty good, attractive valuations. And I would believe it's a good opportunity for investors looking at this theme, the digital commerce theme, to start accumulating some of these stocks. Definitely, Eternal has a much better execution track record. The food delivery business has been generating cash flows, and I think is the better of between the two.
Okay. Reliance Industries also you'll track very closely. Now, increasingly, there is a fear that maybe the Jio IPO gets delayed. And plus, even tariff hikes could get pushed down the road because anyway, we're dealing with high inflation on account of crude oil prices. And there are UP elections in early part of next year, which means that the industry perhaps has a window only till October of this year to hike prices. So now Street is maybe coming to terms with the fact that the tariff hike could get delayed. What are your thoughts on that and the impact a delay in Jio's IPO will have on Reliance Industries valuations?
Had started factoring in the delay in the Jio IPO, and hence we saw the stock price correcting from those around 1600 levels to now around 1400 levels. So the price hike as well as the IPO, both of which looks a little bit delayed as of now. But given that there are several moving parts, what we believe is that the O2C business, that is looking attractive because of the geopolitical disruptions that has led to the price cracks. That is moved up sharply, especially if you look at the refinery outages in Middle East, the China export curbs, as well as the soaring tanker freight rates that have pushed the refining cracks sharper, almost 40 to 100% premium in some of the products. And that has a potential to improve the EBITDA by about 8.5%, and give a further upside in the near term. What we also see is that there are multiple factors in the global energy market, at least in the near term, that could help Reliance report that higher EBITDA. We have seen in the past as well, when in FY22, FY23, where the RIL's O2C EBITDA rose about 18%. And something like that can again happen in FY27, where we believe that the O2C business could provide that additional upside. So for now, we have a positive view on the core business. We have a target price of 1750. But if that were to happen, the upside could also further increase by about 10% from there as well.
All right, Sid, thanks a lot for that. What we'll do is take your leave on that note and take a short break, come back. On the other side, we will get tracking the pre-opening. We'll also connect with Shrikant Chauhan, Mitesh Thakkar for some technical trades. Later, we will have Digant Haria of GreenEdge Wealth Services to talk about the banking sector, the outlook, the conversation that started yesterday, PSU versus private banks, how valuations stack up, and what's more investable right now. All of that on the other side. Welcome back. You're watching us here on Open Exchange live from the CNBC TV18 Motilal Oswal studio. When we started the show, the Gift Nifty was actually a downtick of 170 points, and now as we speak, that has further accelerated to about 280 points on the open itself, which means that from yesterday's close, the opening would be closer to 23,350, 23,400, much below yesterday's panic low as well. So perfect time to get in, Shrikant Chauhan and Mitesh Thakkar of Bonanza portfolio. Shrikant obviously joins in from Kotak Securities. Gentlemen, it's looking painful if one is a bull. At any level, there is some recovery. The next couple of days, we see a bigger low being hit. So these panic lows are actually not holding on. What should one do? I mean, is it, are these tradable unless it's positional? And even if it's positional, you don't know what happens overnight. Mitesh?
Good morning, Mama. I've been highlighting this for many days now that the medium and the long-term charts are getting damaged. When I say about that, that the longer-term charts are getting weak, it also means that the retracement and the decline will happen on the longer-term chart time frame, which means that it will be much severer than what we have seen when it happens on the shorter-term time frame. So I think we are going through that phase that a broader correction is playing out. My belief is that the Bank Nifty in a normal case scenario should at least decline to about 53,600, so which is about 1,500 points lower, and in a worst case scenario, even more. So I think this market, while it will keep getting those pullbacks because we have run away too far from the 10-20 day averages, we are also oversold on indicators. So I think that will happen. But given the fact that the bigger wave is on the downside, I think the broader directional bias should be more on the negative side, at least in the next few weeks, few months. So I think with that, the trading should be such that you should be either, if you're not prone to go aggressively short, you should be either doing buying into put options or doing some put spreads, or even you can trade long dated options. So I think these are the ways you'll navigate such movements, which are slightly on a bigger time frame and on the downside.
What's the downside for Nifty Bank, as you said, Mitesh? The level?
Prashant, to me, I think a very logical target is around 53,600. But in a worst case scenario, I am also penciling in 51,750 to about 51,500 zone. So there could be still some more downside left. Of course, you will get those phases when the markets will bounce back. It will make a temporary low, give you a good rally from there. But the longer term chart suggests that slightly lower targets could still be tested.
And still stronger, right? I mean, if you do a relative analysis, Nifty Bank is still much stronger as compared to the Nifty. From the highs, how much are we down? Nifty is now, I think, down 10% from the highs.
True. So I think even the Bank Nifty is down 10% from the highs, but I think that phase of outperformance has also reversed.
Yeah.
I think till mid-February or end of February, I think the Bank Nifty was very clearly outperforming the Nifty, but I think that phase is also reversed. If you look at the relative strength index, which is basically not the RSI but the relative strength comparative, when you compare two stocks or two indices vis-a-vis each other, the Nifty Bank, which was leading the Nifty, has now started to give a pullback on those charts as well, which means that in the next few weeks it could slightly underperform the Nifty.
Right. Shrikant, what are your chart checks suggesting about the downsides on both the Nifty as well as the Nifty Bank?
Good morning, Mangalam. Good morning, Prashant and everyone. I think what Mitesh is saying is absolutely right, that the way the market is shaping up, one thing is very clear, that at every rally, we can see some more liquidation of long positions, and ideal strategy should be to look for reducing long positions, leverage long positions. If there is any pullback of 200, 300 points during the day, or let's say in a 1 or 2 days of time span. But ideal strategy on the other side is to create some short positions whenever the market is breaking its previous low. Like today, if we see the market is breaking 23,500, then again, we should look for creating some short positions, because in a bear market, most of the time breaking this low results into one more slide towards the next major support. And now the next major support for the market is between 23,200 and 23,000. So from here also, one can get easily 300, 500 points on a lower side. For the Bank Nifty, yes, 53,500, 600 is going to act as major support for the Bank Nifty. And in case if Bank Nifty breaks that, then we can expect further more slide towards maybe 52,500. But on immediate basis, 53,500 should act as very good support for the Bank Nifty.
53,500, that's a good 1,500 points away from where we are right now as well. Mitesh, before we get to your stocks, do you have a view on Reliance? Because that's, trying to hold up one end of the index, but at the same time, we're seeing, the stock finding some sort of challenges between that 1420 to 1450 sort of zone.
Yeah. So I think, Reliance again, if you see the, slightly medium charts, in the month of August, Reliance, I think, bottomed out around 1350 odd zones. We had a August low of 1350, then September low was around 1340. So that's the broad range. And we are seeing the stock repeatedly bouncing off those monthly pivots. So I think for the time being, Reliance is outperforming. It's not one of the weakest stock. It's a stronger stock, though I think it may still go through some price correction if the Nifty goes through a bigger decline. But I think broadly, as long as 1350 is holding, Reliance should do well. And on the upside, because it's not showing signs of an uptrend, I think it will be capped around 1450, 1490 zone. So looks like a 150, 140 point kind of a range for Reliance.
Jeffries today says that Reliance Industries is trading one standard deviation below its long-term averages, which suggests limited downside amidst earnings support. Shrikant, what would your stock calls be?
So for the day specifically, we are we need to create some long and short positions. Specifically on the shorting side, we should look for creating short positions on IDFC First Bank. It is around 64, 65 levels. From here, the stock can slide to 58 or 60 sort of levels. We can keep a stop loss around 67 for creating short positions on IDFC First Bank. Also, IndusInd Bank looks weak. There also we have a target of 800. We can create short positions with a stop loss at 845. And on the other side, if we have to create any long positions, then Adani Power looks a strong candidate to buy for, because we are seeing some buying interest in all power companies. But Adani Power is currently around 149. There we have a target of 165. We can keep a stop loss around 142.
Mitesh, what will you go with?
I have also a mix of buys and sells. On the buying side is CG Power, and if it starts getting past yesterday's highs, that is. So it's a buy about 741 with a stop at 729 for targets of 765. Adani Ports is a sell with a stop at 1406 for targets of 1364. Then a sell on Hero Motors. Keep a stop at 5481 here. Look for a target of 5225 to about 5210 on the downside. And one more sell call, which is on Chola Finance, which I would recommend taking a short-term sell side position with a stop at about or just above 1542 and a target of 1495.
All right, gentlemen, thanks a lot for that. We'll come back to you for your 9-10 calls shortly. But the private credit engine seems to be hitting a speed bump with investors trying to pull money out of big funds. Prashant, large fund houses and banks are capping withdrawals in shares of many of these firms. Tell us more about that.
Thanks for that. So this is a story which is, as I was saying it in the morning, which kind of got masked because over the last 5 days, actually last 10 days, it's all been about Iran on the headlines, right? But the problem is not going away. The problem is very much there. And that's why I'm saying it's sort of, I've put that sort of word again there, right? So flurry of headlines last night and all kind of pointing to the fact that there is perhaps more stress coming. So we'll go one by one. There are two, which are getting the most amount of attention. Morgan Stanley and private credit lender Cliffwater have restricted withdrawals from private credit funds. By the way, there is also JP Morgan, which is saying that they're going to stop lending to private credit funds, especially those with exposure to software companies, software stocks. So some of the biggest, largest banks in the US, right, like Morgan, like JP Morgan, and of course, specialized private credit lenders like Cliffwater are all starting to sound, I don't want to be alarmist, but it always, and I've seen this over the last, you go back to 2000. I'm not saying this is 2008. As I said, don't want to be alarmist, but it always starts slow and everybody kind of says that, it's all well, it's all good, etc., etc. But eventually more cockroaches are found. No disrespect to cockroaches. But number two, right? Partners Group, which is, of course, a very large group, a private equity group, And they were quoted as saying, this was an article in the Financial Times, they said that there's a good chance that we see default rates double in the next few years. Remember, the US private credit market, and I did a full detailed half-hour program on this, is about $1.5 trillion US. And it's not just, it's an opaque part of finance, but the problem is it is plugged into everything else. It's plugged into banks, it's plugged into insurance companies, it's plugged into regular investment firms, etc. as well. So that is number two. Number three, you have an investment fund in LA, $5 billion in asset management, not very well known, but that's why I mentioned the size of the fund. It questioned asset manager Blue Owl. Blue Owl now is a very well-known private credit alternate asset manager. It's listed, and this is where the trouble started. And we had highlighted it about a month ago. This investment fund with $5 billion in assets essentially is now questioning Blue Owl's current value on its investments. I mean, their assessment of what these assets on their books is worth, and saying, well, perhaps they're not being marked to market properly. Number four, Deutsche Bank, and this was separate, right? Deutsche Bank came out with an annual report last night, and they essentially are saying that their exposure to what is described as NBFIs, non-bank financial institutions, is about 26 billion euros, about $30 billion, basically. This is essentially exposure to the private credit fund. Now, again, you've got to remember that Deutsche's size is, what, 500 billion euros. Size of balance sheet is $500 billion. This is 26 billion euros, right? So context matters, but just wanted to put that out. And another company, and maybe completely unrelated, but I'm just picking up different pieces, shares of Canadian subprime lender, a company called GoEasy. They fell 50% yesterday after guidance of surging loan defaults and write-downs as well. So just wanted to sort of, put, it's a lot of headlines. It's perhaps a little unrelated, but the center of all of it, I think, is concerns around private credit, which aren't going away anytime soon at all. I don't know if we have Digant Haria. If we have, I'd just like to sort of bring him in. Digant, good to have you back on the program. Thanks very much for joining us. And we'll get to Indian banks in just a bit, but I don't know if you're watching this private credit thing in the US. If you have a view, just quickly, 30 seconds, is it something to be really worried about, or is it going to be the next shoe to drop in that sense?
Yeah, I think, always very difficult to say, but a lot of fishy things keep going around in the US. It's trying to protect the dollar. And whenever interest rates, crude oil, there are these huge moves, these things happen. So I think we have to watch out. And private banks falling was one of the reasons, Prashant, as you mentioned. The Indian private banks, the FII selling, I think that is what we have to brace for.
Okay. Digant, so let's get to the Indian banks then. Now, banks have been underperforming this week. From the start of the week, banks are down close to about 5% And yesterday, we had an interesting chat with Sridhar Sivaraman, and he was making the point or explaining why private sector banks have been underperforming. And it echoes what you said. Basically, the profit pool has been shrinking. Private sector banks are now barely growing at 10 to 12%. And PSU banks have now aggressively started getting into and capturing the market share. So this is something we've discussed in the past with you as well. But, banks also go through a cycle. All this happened at a time when credit growth was weak. Now, increasingly, you're getting signs that the credit growth is picking up, which means the overall pool expands. Does that make the case for private sector outperformance after going through a period of underperformance versus PSU bank? The pendulum swings both ways.
Yeah, morning, Rima. I think you are absolutely right. We also were backing PSU banks for the last 2 years. But I think now we have reached a point where that trade needs to be revisited, that, PSUs may keep doing well and privates will not keep doing well. I think that does not work. See, for PSUs, we had two great cycles, 2022 to 24. There was a credit cost cycle, where asset quality improved. And maybe 24 to 26, we are seeing a growth cycle because for the first time, we are doing retail products like personal loans, car loans, gold loans, and so on. So PSUs have had it good. I think, but private now, the valuations have reached such a point and, AI can get in a lot of operating cost efficiencies. PSUs cannot get operating cost efficiencies so easily. So I think we are now becoming more constructive on private banks that they will outperform the PSU banks.
All right. The point that we were making yesterday as well, when people were talking about how PSUs are doing a lot better fundamentally than private sector banks. The outperformance of public sector banks has also been a lot. Over the last 1 year or so, that index has rallied almost 50%, where the Nifty Bank hasn't as much. So there's a near 5 times outperformance in just the way these have been priced. So what is the valuation differential now, and how much more? Do you think that outperformance is in the price fundamentally as well?
Yeah, so outperformance is in the price now. Mangalam, if you look at 10-year CAGRs of SBI and ICICI, or any other private sector bank, SBI is a winner now. So it's now 10-year CAGR on the stock price that SBI has done better. On valuation front, the two largest ones, SBI is at 1.7 times this year's book. ICICI is at 2.4 times. So SBI is, say, 1.5 standard deviation away, higher, and ICICI is lower. So I think valuation convergence has happened a lot. And I think now the next layer, which is next 5 years, we'll see all this AI-led efficiency and, hyper-personalized banking coming. So I think that particular trend, I think private banks will capture it better than the PSUs. So I think, yes, PSUs did fantastic, but I think now the baton may actually shift to, private banks. But PSUs will also do well. But I think from an investor point of view, private banks probably offers more upside now than PSUs.
Which private sector banks' valuations look attractive to you?
I think, the large ones, ICICI is probably the best placed. Then comes Kotak, then comes maybe Axis, and, then comes, this HDFC. I think that's the pecking order which we like. But yeah, I think, as a basket also, the large private banks can actually do well. And Rima, just because this conversation is PSU versus large private, I think the real gems are lying below the large banks. So,
And you've spoken a few times about it. Why don't you revise us with, because that's helpful for the viewer, right?
Absolutely, Prashant. So I think there are two pockets, which are really doing well in terms of business. It's just the bad stock market sentiment that is not getting reflected. So microfinance, the cycle is really reviving. So all the good microfinance plays can actually, keep doing well. The good ones in business are L&T Finance, Credit Access, Arman, Ujjivan. I think these are the good companies. And second, I think gold loan as a sector is doing very well. Even if the gold price were to stay where it is for the next 2 years, I think the sector itself will grow at 35-40% over the next 2 years. So there's a good tailwind out there. A lot of good picks available there. The best one is always Muthoot. Then there's FedFina and there's IFL. There's a buffet to choose. I think these two will report very strong earnings, Prashant.
Muthoot, FedFina, and IFL as well. Digant?
Yeah, IFL as well. Almost 45% is gold. And there's a small regional bank called Tamil Nadu Mercantile Bank. They are also 45% into gold loans.
Okay, we'll just put those up as names because that's useful. Just one quick point from my side, Digant. There are concerns. This oil shock is the latest one, but otherwise AI, etc. Right? I mean, jobs, maybe a little bit of deflation there. There is this view. One is PSUs growing faster than private, right? We had Sridhar Sivaram of Enam yesterday, who also, I asked him specifically, but are there any underlying asset quality concerns? He didn't think so. But is that something to be watchful of as well? Because, whatever happens in the economy shows up in banks.
Yeah. So see, we have to be watchful, Prashant, but we just published a note 2 days back that we think AI will generate a lot of entrepreneurship. The jobs at scale that we had in the IT sector, they may slowly decline, but it will create a lot of entrepreneurship because AI, everyone can get a personalized app, personalized software, and so on. So I think it's too early to say that, there will be a big job impact and the banking sector impact. It's quite on the contrary. I think entrepreneurship rises, private companies, it flourishes, and private banks are actually well placed to capture this whole wave, the hyper-personalized banking. So I think it's too early to worry about that third order effect. Even the first order effect is not clear today. So.
Thank you, Digant. A helpful conversation as always. Thank you very much for joining in. It's 9:12. Now let's get in some calls. Mitesh?
Yeah. I'll go with a sell call on Hero Motors.
Hero Motor Corp. Nimesh is now joining in with a standout brokerage report of the day.
Hi, Rima. So today's standouts on ABB India. A big upgrade from UBS. They've upgraded the stock to a buy from neutral, and they've sharply raised the target price on ABB to 8,030 versus the previous target price of 5,310. So big upgrade in terms of target price as well. In fact, they've added the stock to their APAC focus list as well, and they see multiple triggers for the stock to outperform. The first being a favorable risk reward with both structural and cyclical growth levers aligning together. Two, a marked shift in the niche and scalable end markets going forward. And third, even the short cycle outlook is improving for the company. In fact, UBS thinks that the market is actually misjudging the company's ability to tap a large TAM in segments like motions and electrification segments. In fact, they're much ahead of the street in terms of numbers, and they see at least at 20% both PAT and EBITDA CAGR over the next 3 years. So a big upgrade to a buy from UBS, and they've sharply raised the target price on ABB now to 8,030.
ABB in focus, and Nimesh picking out that particular name out of all of the stuff that he's going through. So 64.40, keep an eye out on that one as we open up for trade. I think we're just about a couple of seconds away from open. Maybe we can just put out some of these stocks, right, which we highlighted in the morning. Nifty is, by the way, starting about 170, 180 points down. That's the settled, the final pre-open rate. Eternal, Swiggy, etc. will come up on your screen. We should look at Reliance and how that is, where that is at. And of course, I mean, you know, names like ABB, etc. also settling. Borosil is the other one, right? We had the company, the management with us talking about some amount of supply disruption, but also saying on the other side, the demand is super strong for their products, etc. So yeah, I mean, oil marketing, maybe we should look at IOC, HP, BP, also the MGL and IGLs of the world. Because they are direct, it's directly impacted because of high price of oil. Also, yesterday, names like Chennai Petro and MRPL went up. Chennai was up about 5-6% yesterday, and we'll just take a quick look at that as well. These are all straightforward oil-related names, which should be in focus. So, coming up, market open coming up in a couple of seconds. What do we have? First rates anytime now. And that's the opening bell. It is down 150 on the Nifty and about 500 points lower on the Sensex. So 25,450, 0.75% lower. But actually, so it's not that bad, right? I mean, if you're able to settle here and then kind of spend the day around here, maybe some bounce along the day. Let's see. It'll depend on headlines. Nifty Bank, 54,580. And it's been a bad week. We've been, of course, flagging this from Monday morning that it started cracking late, but as it started cracking, I mean, it's quickly lost a fair bit from the highs. The Sensex down about 0.75%, the small cap index down 0.5%, the mid cap index will come up as well, and there is some amount of pressure. 2:1 in terms of declines to advances. 480 stocks are higher, and about 800 stocks are lower. Rima.
Well, third day of losses for the markets now, and this week's loss tally stands at 4% for the Nifty and the Sensex. Autos once again under pressure. The Nifty Auto Index is down 1%, with M&M lower by 2%. Eicher Motors weak in trade, that's seeing a cut of 1%. The street fears the geopolitical conflict, rising commodity prices will create cost inflation for the Indian auto industry, and plus the weakening consumer sentiment could also derail the recovery that we're seeing. L&T under pressure. L&T is lower by nearly 2%, sliding 7.5% this week. It's in the midst of the Middle East conflict. Banks are weak in trade. The Nifty Banking Index is down 500 points, with HDFC Bank, ICICI Bank lower by 1.5%. The overall macro stress in the Indian economy will hurt private sector banks. Adani Ports, Tata Steel weak. UltraTech Cement is lower by 1 1/3. Shriram Finance under pressure, that's also down about 1.25%. IT on the back foot today, so 1% gone for Infosys and HCL Tech. On the way up, once again, it's many of your PSUs, power names. Power was the big theme yesterday. Power Grid on top of the charts, 1% up. On Coal India, the expectation is that e-auction prices will be higher. So that's lifting Coal India's stock price today. NTPC also up in the green, and Eternal was flat today. No recovery after the recent selling, but no selling at least. All in all, it's down about 3/4 of a percentage point on the Nifty and the Sensex, but it's broken yesterday's intraday low of 23,550. Today, it's 23,450 on the Nifty.
Yep, that's where we are right now. But, the broader markets are a lot better at the opening today than it was yesterday. Yesterday, we had about 400 stocks which were in the green, and this morning itself, we have over 550 stocks which are in the green. So The market breadth actually is a lot better at the open. Let's see how it progresses from here on. Power has definitely been the theme of yesterday and continues today. The important part, however, the stock of today and this week has been Adani Total Gas. Something is, definitely underway out there with a 5% up move yet again today. The weekly gains on that stock are at 32%. So that's a big move that we're seeing. NHPC is up around 2% in the broader markets. ABB India, Nimesh highlighted that stock in his standout brokerage note. That one's higher too. And we are seeing a big move on NTPC Green Energy as well, which is up 5.5% straight off the bat. This week's gains on that stock are up around 17%. Continued buying for some of these induction cooktop makers like TTK, Prestige, etc. We've seen that stock too put on about 25-26% this week. And we've seen, Eureka, Forbes and the others also come into the picture today. Among the stocks which are selling off, some of these tire makers are lower. So CEAT is at the low point of trade. Devyani International. Yesterday there was news that came in from Pizza Hut. Their social media account said that, due to LPG crisis, their deliveries would be very limited. So Devyani and Sapphire obviously are Yum Brands franchisees and franchisors in India. Obviously announced the merger. So both those stocks move in tandem. Devyani and Sapphire are lower. Amidst, some sort of relief coming in for names like Jubilant Foodworks. And you spoke about Eternal. Swiggy also is about 1% higher. So that's pretty much about it, the way the market is. We have 558 stocks which are on the NSE in the green, 1800 stocks which are in the red. A bunch of them from yesterday continuing their up moves, and a lot of these oil-related plays which are moving in the direction, whether they're, it's upstream or downstream. The ones which are upstream moving higher. HOEC stands out in that. And the downstream ones, they are under pressure today.
Absolutely. 190 points gone, 0.8% lower is what you have, 23,450 at this stage. Nilesh Shah is with us, founder of Envision Capital. Nilesh, welcome to the program. Thanks very much. I mean, you're a micro guy, and that's helpful at times like this, right? Because, macros, as someone posted, human beings were not built to track this amount of headline and news flow, right? Makes the head spin. And what do you do with all of it at the end of the day is the question. So I guess at some level, better to focus on what is understandable and maybe knowable in some sense, and that is companies and businesses. So across your portfolio, Nilesh, just give us a sense of what you're seeing. Have you run a broader market analysis of the drawdowns we've seen? Are broader markets now at attractive levels? Just start there.
Surely, Prashant. Thanks for having me here. And I think from a valuation point of view and from a multiples point of view, I think we're down to historical averages. So that I think is honestly a great situation to be at. This is really where over a period of time we see the markets which do tend to kind of find great support and do tend to kind of come back from there. Notwithstanding the fact that clearly the macros and the global news flow is extremely negative and it's hard to essentially have a positive stance. But the bottom line is that valuations have come off. We've gone through time-wise corrections and we're now down to those historical averages. Clearly, amongst the mid and the small cap space, we're seeing now a bunch of stocks, sectors where valuations probably are even as down to 12, 13, 14p multiples. And these are businesses still growing at about 20-odd%. So clearly, on the whole, this requires basically a way more constructive stance. We've seen in the past geopolitical conflicts impacting sentiment, impacting valuations, impacting prices. But they end up being great opportunities to essentially kind of add to positions or even continuing to build a portfolio.
Right. What's perplexing, Nilesh, this time around is the underperformance of the Nifty Bank. One would have thought that maybe because of its domestic facing nature, relatively better asset quality in the banking system right now, across all these things with not a big jump in valuations either, it was a place to hide. But that's the one, after its outperformance, has actually underperformed. And in a way, it's dragging the market lower. Even now as we speak, the Nifty is down 200 points, and it's the biggest culprit is the Nifty Bank, which is below that 54,500 mark as well as we speak. 600 points gone in the Nifty Bank. What's perplexing, or what according to you is hurting the banking index right now? Are you part of the PSU versus private bank sort of debate as well?
So, Mangalam, banking as a space has done relatively well, especially at the index level, maybe over the last year or so. And many of these leading PSU banks, private banks, all had delivered a very strong stock price performance. So that's essentially, I think there's some basically money being taken off the table. It's also probably players who are looking to basically hedge their bets, and they think probably that having a more nuanced stance on banking might just be helpful in the current environment. So I think that's what is playing out. Third, inevitably, I think banking becomes a proxy to basically where interest rates are moving, yields are moving. Maybe the whole story of rate cut cycle is now behind us. We probably get into a pause mode, or maybe if oil remains at elevated levels, we could see the pressure exerting on inflation, which could lead to basically maybe interest rates moving up. That probably is something what the markets are currently trying to factor in. And lastly, global investors still continue to own a lot of banks. And I think it's just basically them trying to adjust their positions, maybe pruning some of their positions, given that they still own a fair bit of banking stocks. So I think it's a combination of all of these phenomena. But basically, I think the fundamentals still remain solid for the banking system in India.
Is this the time to aggressively buy right now, Nilesh? Or because we still don't know how long this conflict will go on, the fog of war continues to question mark the duration of the war, it's still better to avoid before deploying?
I'd probably say just have it on the watch list. I honestly don't see a significant or a material downside to it. Maybe, yes, on an individual basis, stocks can possibly correct by another 5 to 10%. But that again just creates an additionally attractive buying opportunity. So I'd continue to be positive on banks. Maybe there's, yes, a 5 to 10% decline in individual stocks, but I think that's really how the overall market currently is positioned at.
So positive on banks, maybe another 5-7% downside. And this is large cap private banks, Nilesh, we're talking about?
That's right, Prashant. I think look at just the valuations. I think all the leading private banks are now hovering down to significantly lower price to book value. They're probably a lot lower than the historical averages as well. And I don't think the earnings profile or the earnings trajectory of large private banks is materially impacted even by this event.
Nilesh, with full disclosure, you said, right? I mean, lots of mid and small caps have come to now trading at 12-13 P ratios. Growth offered is still 20%. Give us a few examples just to think about, chew on. As I said, with full disclosure, not as investment advice. I mean, I think everyone should be careful and trust their research or trust their advisors. But just your thought process, Nilesh.
Yes, so I think clearly, from in the mid and the small cap segment, it's across a variety of sectors that basically value is emerging. Many of these stocks have already corrected about 50% from their 52-week highs or historical highs, and that's what has basically led to a trading down of their valuation multiples. So I think I see that across the board, but just kind of getting beyond individual stocks. But I think three pockets which essentially look extremely good overall in the current environment, or even from a medium to long-term perspective. Firstly is the overall the digital platforms and businesses which are proxies to the whole digitization that is currently underway in India. I think that's a very attractive pocket. Second is defense. Clearly, I believe that the earnings expectations or the possibility of a significantly higher earnings in the entire defense pact has improved quite significantly with whatever is going on geopolitically. Third is pharma. I clearly believe that the pharma is clearly seems to be a very standout space. Several things going for it. One is, of course, the strengthening of the dollar, depreciation of the rupee I think augurs well, given that pharma companies are net exporters. Two is pricing power that they have. Even though API prices might go up due to higher raw material prices, or there might be higher freight costs, but I think they have the ability to have a pricing power. And third is this whole GLP-led opportunity, which is there. And clearly that's going to be a very big opportunity starting April this year. So clearly they have an added layer of growth. So I clearly believe these are the three sectors which I think investors from a medium to long-term perspective need to kind of watch out for, and this is really where portfolios will need to be positioned.
Right, that's an interesting one because we had done an entire town hall on the GLP-1 opportunity, the impact that it could have on your portfolios. The positive impact obviously coming in for the pharmaceutical space, the adverse impact, the second or third order impact could perhaps be on the way consumption is, changed fundamentally. But, you did speak about the digital platform theme. Nilesh, a couple of these stocks in that theme itself have seen sharp corrections from the top, be it Eternal, which has been among the biggest losers, down 40% from its highs. We've had a decline in Swiggy as well. Even Urban Company, while this week it's found some buyers, it's again down about 45% from its post-listing high. In fact, at some point went below the IPO price as well before it saw some buying resume. What are your thoughts on the digital space? In particular, what parts of that space look a lot more attractive than the others? Because the theory is that maybe consumer-facing digital plays have a lot of moat around them, but some of these financial players are all fungible because, it's very difficult for them to get to cross-sell, etc.
That's a fair point, Banglam. And clearly, I think the quick commerce pack is witnessing heightened competitive intensity. Honestly, one doesn't know for how long this will persist, but I don't think it is going to basically last for a very long period of time. Yes, it could be there for another maybe a quarter or two. But I think beyond that, I believe the competitive intensity should pretty much normalize. It's not that there hasn't been competitive intensity, but I expect it to basically normalize. And clearly, I think with the kind of price shave off that we have seen in the couple of listed plays on the quick commerce side, I clearly see now the risk reward getting hugely favorable from a most likely medium to long term perspective. Coming over to basically the fintechs, clearly on the equity broking side, the digital platforms which are there. Yes, I think for them there still are likely to be headwinds given essentially a slightly lower and a subdued market activity. But currently, I think the places in digital platforms which is looking, I think, rock solid for now right now is I think the payments space. There, I think while there has been competition, but there is a lot of cross selling happening, especially in terms of credit. The other is clearly the beauty and the personal care digital platform. Their businesses still continue to grow at about 25% odd. And I believe that that's not going to, the consumer spending there is not going to be impacted with whatever we are seeing on the macro environment. So I clearly believe that there are still pockets which are continuing to have solid performance in the short term, but they look extremely attractive even from a medium to long term perspective.
Thank you, Nilesh. Great conversation. Thank you for joining in. The Nifty is now at 23,465. We had dropped to levels of 23,415. So from that level, there has been a recovery of about 50 points. And consumer names are seeing buying. HUL, Nestle, ITC up in the green now after opening lower, 0.5 to 1% higher. But let's talk to the management of PG Electroplast. Vikas Gupta, Managing Director of the company, is now joining in. And with him, we'll discuss the relaxation in Press Note 3 guidelines, the impact of lower gas supply allocation, and the update on the compressor JV. Thank you very much for joining in. On the 9th of this month, you intimated to the exchanges about how the availability of gas has become severely constrained to your company. And you went on to say that you're assessing the situation, and as of now, the potential impact of the ongoing shortage situation cannot be quantified. You would have had a better sense now. It's 4 days past. What's been the extent of production or volume loss that you've seen? And to what extent has gas been curtailed as a percentage of your overall production?
Good morning, Rima, and thanks for having me on your show. So please understand that right now the situation is quite volatile, and we are still not being able to, make a sense of how the things will work out. And definitely there has been a disruption in the production schedules for us on a daily basis. And we are seeing a shortage of LPG availability for our various plants where we manufacture our air conditioners right now. So that is quite a challenge. We are working on with the gas vendors. We are working with our supply partners to see how we can mitigate and try to minimize that disruption.
Yes. What is the quantum of cut? Good morning.
Good morning, Prashant. So, Yeah, so the quantum of the cut is like this. Prashant, please understand, we are working on a daily basis right now. Like today, we are covered for maybe today and tomorrow we are covered, but we don't know how it will happen for day after tomorrow or something like that. So it is quite volatile. It is very difficult to say that. But definitely, any loss of production or any loss of production in this peak month actually has an impact on the overall numbers that we can achieve because March usually happens to be a peak month for the production and sale as well.
Yeah.
That exactly is the
On
question.
the average, Vikas, on average, if you can just last few days since this started, what is the cut? If you can, is it 5%, 10%, 15%, or is it much more?
So Prashant, like out of 4 manufacturing plants for AC, like 2 manufacturing plants were not able to operate for 3 days in last 1 week.
So that's a 50% cut for 1 week.
Yeah, out of 1 week, last 4 days, there has been no production in 3 plants out of 4 plants.
So what does this do to your guidance? 5,800 crore with the top line guidance for FY26. You said March is an important month for you. How much of your guidance will be missed because of this unforeseen circumstance?
So Mangalam, it is difficult to quantify, but definitely there will be an impact on the achievement of the revenue guidance. I cannot give you the exact number, what will be the impact in the percentage terms or in the absolute terms. But what I can tell you, there will be an impact on achievement of that revenue guidance.
Okay, if you could give me a sense, the we'll back calculate that. March as a proportion of sales, how much does that account for in your annual sales?
So it can be like, it can be almost as high as around 12 to 15%.
Okay, 12 to 15% of your annual sales may come from March, and a week of that has been impacted. 50% of that has been impacted. So back of the envelope calculation suggests that maybe a percent or 2% sort of impact, at least that has happened already. And if this continues, maybe 0.5% or maybe 1%, 2% more. Would that be a fair estimate? Between 2 to 3%? Just mathematically speaking.
So I would not be able to give you the number on that. What I can tell you that we are trying to work on how we can salvage the situation. We are working more on that instead of, calculating how we are able to achieve that revenue guidance or not that. Our teams are more focused on how we can mitigate this. We are working on some alternative technologies, alternative gases.
That is absolutely fair. That is absolutely fair. And that's what your team, that's exactly what your team should be doing. But, the analysts will have to look at the impact of that in this financial year. And
if I can just confirm, Vikas, just to confirm, right? You said in last week, this is not this week, but last week, 2 out of your 4 plants did not work, right? That's what you said. And this
for 3 days, 3 to 4 days out of the complete week.
I see. Okay, I will just, okay, it's not, because what I heard first is 2 out of your 4 plants did not work last week, and in the last 4 days, 3 out of your 4 plants did not work. Is that not what you said?
So I'll tell you. So Prashant, out of 4 plants for manufacturing of vehicles, last week there was a disruption of 3 to 4 days. This week there has been already a disruption of 2 to 3 days. So if you look at, we have almost lost 1 week of production.
And that 1 week of production, I'm just mathematically calculating, 15% of your annual revenue is coming in from March, 7 days loss. That comes to about 1.75% specifically. But we'll let that, we won't allow, ask you whether that is true or not. The analysts will make those assumptions. Now, the second part is that the government had come up with easing of the FDI norms with PN3 approval. What's the latest on the company's compressor JV with Highly? Do you stand to get affected by this norm that has come in? And as a result of which, does this JV with Highly go through?
So Mangalam, let me correct here, because I've said this thing earlier also.
Yes.
It's not a joint venture that we are getting into with the compressor company in China. We are getting into a contract manufacturing agreement where we will be putting up all the investments, and there is no investment coming in from a Chinese technology partner. Okay. So the question of getting a Press Note 3 approval is not there in our case right now. So we are already working on that. And we have already started the placing the orders for the equipment, and we are hopeful that we should be able to start the production of compressors before the end of this calendar year.
You know that because that press note 3, right? This is the approval, you're awaiting approval from the Chinese side, right?
Yes. So basically, Prashant, so there was a issue related to the approval from the local Chinese government.
Correct.
So there was
press
no
note 3
angle
has-
of a press note 3
Exactly.
approval in that.
Exactly, because press note 3 is for investments into India, and if there is approval which is stuck, then that perhaps gets faster. But this is from a local Chinese side, in that sense. Now, just give us a sense, Vikas, if you will, on there were some reports that maybe, and now suddenly the weather has turned and it's become quite hot, etc. But there were some, 10, 15, 20 days back, some reports that it's a little cooler for longer, AC sales perhaps not moving as fast and those kind of things. So is there already enough inventory in the system, Vikas, in that sense? And that is now perhaps getting used even as your production is disrupted, just trying to get overall sense.
So Prashant, what I feel now this the tertiary movement or the secondary movement has improved quite remarkably in last 2 weeks, 3 weeks. And there is a kind of a sentiment which is quite positive in the channel partners right now. And we are all hoping that there will be an extended summer. And our teams currently, what we are looking at, if we are able to resolve this LPG situation and work on some alternate technologies, we should be able to cater to the demand for our customers' plans in the coming months of April and May. So that is what we are looking at.
So in the last 2 weeks since the start of the conflict, have you managed any alternate sources? How difficult is that? At what point do you think you will be able to mitigate the situation with another source?
So I think we are working on some alternate technologies, and our technical team is working on some particular process where it is very critical during the manufacturing process for air conditioners. So we should be able to find some solution to that in 7 to 10 days time. And maybe the April month will be better because once we have this process in place, a new process in place, the April month will be better.
Can you tell us a little bit more about this alternate technology? Is it an alternative fuel source or another way of, building by? Tell us a little bit more about this.
So it's an alternative gas. There is an alternative to the LPG that we are trying to work on. Okay. And I do not have the technical details right now, but we are trying to repurpose our existing equipment also, which is used in the bracing and the welding of those copper tubes. And we should be able to come out like this is what my technical team has gave me that download yesterday night.
Okay, April should be better. What's the cost associated with repurposing your machinery? Is it significant?
It's not. No. So the cost associated is very, very minimal. Okay, the main issue is finding the source of that alternate gas.
Okay, got it. One more question. One casualty of the conflict has been on LPG and the shortage, etc. Anything else? Any other collateral damage? For instance, helium prices have doubled. And that also, is an important critical part of your production.
Yeah, so I don't consider that as a main issue. Other than that, there is a availability issue related to the polymers, petrochemicals. And we are seeing a surge in the prices of the polymers. In last 10 days, the prices of polypropylene and the plastic raw materials like ABS and HAPs have gone up by 40 to 50%. So that is also an area of concern. The availability of those polymers is also becoming a concern right now.
Right. So does that do anything to your margins, or do you pass this on to your customers? And since we're talking about that, just a final question on the outlook for room AC demands, because day in day out we're getting updates from the weather department saying that this could be a hotter summer. Last year was obviously a washout for cooling products. So are some of your clients asking for more this year, and how are you supplying them because production is lost?
So Mangalam, what I've said earlier also, like what we hope that once we are able to find a solution to this LPG scenario right now, and as our teams are working on some alternate technologies, we should be able to come out of this in next week to 10 days time. And as we are hoping for an extended summer, we feel that the months of April and May will be better in terms of sales for us.
All right. We certainly hope so too. It's going to be a hot one, and we certainly need air conditioning. Thank you. And generally, I think we can do with less heat, right? Not just from the weather, but otherwise also. Thank you very much. It's a tough one, but I think perhaps better in the coming days and weeks. Thank you. 500 on PG Electro Plus. Stocks down about 5-6%. We'll take a break. Dilip Bilkon is going to be joining us. The government's extended the Jal Jeevan mission to 2028. We discussed the outlook going forward. Stay with us.
Welcome back. The Nifty is still around 23,424. It's a big cut that we're seeing at the low point of trade actually, and led lower by the Nifty Bank, which is holding below that 54,400 mark. But a bunch of stocks which were on our radar a couple of days ago were the pump, pipe and EPC stocks. And that's because the Union Cabinet recently approved the extension of the Jal Jeevan mission till 2028. They've also upped the allocation by about 1.5 crore rupees. The total program outlay now pegged a little under 9 lakh crores at 8.7 lakh crores as well. Rohan Suryavanshi, who's the head of strategy planning at Dilip Bilkon, joins in to discuss the opportunity from the Jal Jeevan mission, FY27 outlook and the group plans going forward. Thanks a lot, Rohan, for joining in. It's been a while since you joined us on the channel, so welcome back. The question obviously is of your current work, of the current work that you do, what proportion comes in from Jal Jeevan mission? With this extension, what's the increase in the scope of the work that you would do? And one of the problems with the Jal Jeevan mission, at least over the last year and a half, were the delayed payments. Did you face the same as well? What's the kind of receivable that you have from that?
Hi, thanks a lot for having me on your show. Such a pleasure to be back. It's been a while. Of course, a lot has changed in our business as well. From when we used to earlier speak, we used to be primarily focused on road EPC, but now we've really diversified ourselves, and we're doing, roads, bridges, dams, canals, water supply projects, mining, airports, everything. But to answer your question, the Jal Jeevan mission is a very small portion of our order book currently. So our order book stands at about 29,500 crores or in that range. And I would say the Jal Jeevan mission projects is roughly, the remaining amount is about 467 or something odd crores. So it's 1.5% of our order book. While we welcome the government's sort of step in terms of increasing the allocation and increasing the timeline, and we remain optimistic about more projects to come in that space.
You have stuck receivables from Jal Jeevan mission?
We don't have stuck receivables. I think that's a more localized problem to certain states. We have about a month receivable from Jal Jeevan project. It's about, I think, 90 odd crores and all, which is sort of typical in our sector and our industry.
Right. No, absolutely. That's interesting. Rohan, hi, good morning. I must say it's been a while. So what, I mean, a few years, maybe more.
It has been.
You're looking older, wiser. Not that you were not those two things earlier. But
just older, not wiser at all. Definitely. You still look very young and the same, man. So I need to know what your skincare tip, routine is.
No, there's nothing. Absolutely
Diet
nothing.
and the exercise that you're kind of following.
Nothing. Rohan, no. So it's good to see you and speak to you again. So what's the opportunity here? You said there's 90 crores in receivables. So that perhaps, also gets expedited with this now coming through. But what's the opportunity size, as you see, from this program now?
I think the earlier allocation was about 4.5 lakh crores, and I may be a little off on the numbers, but now it's been increased to almost about 9 lakh crores. A lot of it is also because there is cost escalation, so the opportunity size may not be as much. But we take whatever opportunity size the government gives out a bit cautiously, because I think those numbers may not necessarily materialize. But I think still there will be a few lakh crores of orders across the country that will come. For us, Jal Jeevan Mission is only like a very, one part of what we do. We like I mentioned, we're now doing work across 10 different sectors. So for us, each sector would be roughly 10-15% of our order book. So, and given that our capabilities lied in our EPC strengths, the way that we used to execute with our own equipment and people, we are very much agnostic about where the opportunity comes, as long as it comes at a rate that we are comfortable with.
Dilip, I have to ask you this, because I remember we had 2 days back, we had another company with us on the Jal Jeevan issue, and they said that there were some companies which were flagged off because of some malpractices, etc., and they were kind of sort of any projects that you've undertaken over the last couple of years which kind of sort of fell under that ambit over the last few years?
Fortunately, we've been fairly well received by the department, and we've actually done some really cutting edge work. Even for our projects where we were building water tanks and all, we wanted to ensure quality, so we went for prefabricated tanks, and so it was really high quality rather than constructing on site. So ensuring that a really high quality product came out. So that was very, very well received by the government, and they were obviously are sending other players as well to kind of look at the kind of work we were doing. So we're very lucky that because we controlled every aspect of our construction sites, and because of the pride that we take in each of our sites where only our people are working and our equipment is being used, we've not faced any such issue. In fact, we've been applauded by the government on multiple occasions.
Rohan, you all divested about 25-26% stake in 7 out of the 11 HAM projects. This happened recently to Alpha Alternates. What is the debt currently on the company's books? What more by way of divestment and plans to bring down your debt?
Absolutely. Hi, Rima. So first of all, we divested just 7 projects to Alpha. The idea there was that we wanted to partner with them, and we gave them 26%, and we wanted to set up our own InvIT, which has also been set up. Last October, we just had a listing of Anantam Highways. Now, the idea was we wanted to get a partner as a part equity contributor to our PPP projects, and where both of us go and jointly tap the capital market, set up this listed platform where even in the future, we can keep putting in assets, because earlier DBL used to sell those assets to the different funds. We wanted to get out of that race. We wanted to hold these InvIT units. Going forward, we wanted to have predictable, consistent cash flows coming for us, and that's basically what we did. So 11 assets are still remaining. Against the 7 assets that we already put in the InvIT, we have received about 1,400 crores of units of the InvIT. Against these 11, which will go into the InvIT in FY27, all of them will conclude in FY27, we will receive another 2,100 crores of units. So total units that DBL as a company will hold will be about 3,500 crores. Now, that's the asset and the investment portfolio that DBL will have, and this will roughly give you about 400 crores of dividend income every year. So at the InvIT level, profit after tax paid, DBL will receive almost 400 crores every year for the next 14, 15 years. So that's the kind of idea that we had as a company. Now, talking about the debt, obviously there are two kinds of debt on the company. There is the standalone debt, and then there is the consolidated debt, which we take for the projects such as these. So the consolidated debt will keep on going away as we complete these projects and keep on moving them into the InvIT platform or sell them to any other player, like some of the other assets that we are taking for the future. On the standalone debt, I'm very happy to report that, when we used to earlier interact, our debt at its peak was almost about 3,500 crores, which was about the breakup of that was about 2,000 crores of working capital and about 1,500 crores of equipment debt. That 1,500 crores of equipment debt has completely gone. So we have about a 4,000 crore gross block of equipment, which is about 1,000 crores of completely net block. And we have about 2,100 crores of working capital debt. But against that, like I was mentioning, we have 1,400 crores of units of the Anantam InvIT. Plus, we also have 200 crores of units of the Shrem InvIT that we had earlier divested into. So 1,600 crores of units. Unlike other players who sell all their assets and take all the money, we decided to hold these. Had we also sold these assets, we would have had this 1,600 crores or more of money in the company. So our net debt would have remained only 500 crores. But because we did that, that's where it is. But in the next 2 years, we will be nearly net debt free because of the cash flows that the company will kind of generate. And that's the idea and goal. On the standalone level, we will remove our debt. We will improve our ROE, our ROC. And on the consolidated basis, we are looking at building long-term consistent cash flows with platforms such as the road InvIT. There is a renewable platform in the works that we're kind of thinking about. There is the mining business that is also going to be throwing out.
And sorry, Rohan, I'm sorry. We will.
I'm so sorry.
No. There's a lot happening, and I understand you want to share. What we'll do is we'll invite you back, and we can maybe do a bit of a deep dive on the business itself, right? All these different segments you're talking about. But for now, I'll thank you, and I hope this is the start of many interactions. Appreciate it. So that is Dilip Bilkon with what's happening in the business, and of course implications of the Jal Jeevan Mission, new allocations from the government. Well, as the war in Iran intensifies, global sugar prices have gone up. There is, of course, also the ethanol angle. Vivek Sarogi is Managing Director at Balrampur Chini Mills. He's been waiting by. Mr. Sarogi, good morning. Good to have you with us here. Before I come to you, I just want to highlight what Prime Minister Modi said yesterday. And I want to just put this up for our viewers because I think it'll establish the context. So this is what he said. I'm reading verbatim his comments. He said, this global crisis has once again demonstrated why it is so important for any country to be self-reliant. To reduce dependence on petroleum, we emphasized on ethanol, biofuel. Before 2014, the country had only 1 to 1.5% ethanol blending capacity. Today, we are nearing 20% blending in petrol. If this had not been done, we would have had to purchase approximately 18 crore barrels of additional oil from abroad in the last 11 years. Looking at the current situation, due to ethanol, we have to import approximately 4.5 crore barrels less oil per year. That is, of course, Prime Minister Modi himself on ethanol. Now, I thought I must sort of put this up before I come to you, Mr. Sarogi, because I think you kind of sort of echo that voice, and you're a prominent player in both sugar and, of course, ethanol as well. But there has been, over the last few years, a little bit of policy inconsistency with regards to ethanol from sugar, from maize. So just lay the context out, and then we'll go back and forth. Go on.
So, thank you and good morning, everybody. The issue is the ethanol supply is intact, but that is being not looked at ethanol properly. So last 3 years, government has not raised the ethanol price. Earlier, it was being raised as a percentage to the rise in FRP. So currently, last 3 years, ethanol has been stagnant. If the supply is to continue unabated, and I'll come to the point where we need to increase the supply, the prices need to be looked at. So that is a big grouse, and for what? For peanuts. Maybe 25, 30 paisa is the maximum increase you need to do on the petrol price.
Yeah. So,
sorry.
So you're saying supply is intact, right? All their investment has gone in and supply is intact.
But if the price is not raised and sugar price goes up, one can easily shift back to sugar and leave ethanol.
Yeah. Yeah. Are we at that stage? Are we at that stage right now, Mr. Saraogi?
Yeah, but it may come, Prashant, and that's government is not a trader. Government should not see, I buy this, I sell this. Government has put in a policy where they committed to you in no uncertain terms and gave interest subvention to set up capacity and said, please produce ethanol because we need it. The premise was blending will go up 20%. And there is another, BI standard being developed for 22 and 25. Ethanol can be used in so many other things. It can be used in homes.
Yeah.
So being done in Kenya. Yeah. So there are a plethora of uses. The idea is to first see how and at what price you need to buy it.
Yeah.
And today, if you were buying ethanol, it'd be way cheaper than importing crude. At 90 rupees to the dollar and $100 to the barrel.
Yeah. So that's the, so you're making a case that prices should be, I mean, they've not gone up for the last 3 years and it should go up as it used to as a percentage of FRP. And this will ensure that investment which has gone in and the supply, etc., remains firm because as I just read out, I mean, of course, during times like this, you realize why you need to be self-sufficient as much as you can. The other point you made is households, right? And just talk to us about that point as well.
So I'm just taking quickly a very larger point. There's a Bio-E3 policy announced by Government of India. What does it say? It says reduce dependence on fossil fuel, and in brackets, fossil fuel is imported. 60% of your LPG, everything. So 60%, I believe, of your fossil fuel is imported. You import that basic raw material and then you refine it here. Okay, you could be making chemicals out of that, you could be making petrol out of that, diesel, anything. I'm saying India is sufficient in biomass. And this is what the Bio-E3 policy says. So biomass, if let's say sugarcane is biomass, maize is biomass, there's enough biomass and starch available in the country to be able to give you a plethora of chemicals. As you're aware, we're going to bioplastic, give you ethanol. Ethanol can be used, in Kenya, people are using it in cooking gas in stoves at home. So it is a policy which needs to be understood on the overall context. Atmanirbhar Bharat should be genuine Atmanirbhar Bharat, not processing in Atma and calling it Atmanirbhar. If you don't play with this biomass and if you policy which is not stingy, which encourages the environment for investment and continuity of that investment. So we were one of the first people, a very quick example, Modi ji was the CM in Gujarat. They bought, and solar was just, about to begin. The then capital cost was 12 crores a megawatt. PLF was 18%. We would given a PP of 15 rupees per unit. With that initial support, technology developed, PPAs, prices came down, capital cost reduced, PLF went up. So any kind of thing which is supported for a bit and then said that this is the direction can move up. So ethanol has a lot of use, is what I'm saying. Other bioproducts have a lot of uses. So Atmanirbhar Bharat should be moving towards biomass, bio-wheat.
So have you brought down your ethanol sales target or volume production target for FY26? And what do you expect for FY27 if there is no increase in prices?
We, in this year also, we did curtail our bidding by 5% odd. In the next year, if this is to continue, God knows what can happen. And if the sugar prices remain firm, as a businessman, you might bid 50%. I'm saying we, government and industry should not be at loggerheads that, I'm not bidding, you're calling for the bid, therefore raise the price. It's not an attritional relationship. It's not a trader relationship. It's an industry-government relationship with a long-term mandate in place. It is at these points that you realize how important this is. And I brought up a larger context where these things can be used ad infinitum for a lot of things.
Yeah. You know, and I have to say this, and I want you to respond on air. That's why I'm bringing this up. There's been a fair bit of, with regards to this fuel blending, etc. The government has already clarified it. But all this talk of that it's that it damages vehicles and engine, etc., etc., etc. That kind of, it was all over social media. I wanted to respond to that.
There's a PIB clarification by the government of India. How this actually improves the knocking of the engine. It's around 95, which means there's more oxygen. And this improves the acceleration and the engine efficiency. Yes, on a very minuscule level, it does reduce the mileage. But that's like 2 to 3, I think 2% at best. So overall, it is much better. In the larger context of things, in this overall, if you see the maintenance, engine efficiency, etc., it might not be, if I cannot go and stick my neck out, say it's cheaper, but it will not be more expensive.
Okay. And of course, I mean, if at a net level it is neutral to maybe slightly positive, and add to the fact that we have it here, that I think
environment friendly, hugely environment friendly. So you go out and say, I'm spending trillions on climate funds, this, that. This is climate. This is rural growth. This is biomass usage.
What about water intensity, Mr. Sarogi? That's the other criticism which we hear often.
Thank you. Good question. So there was a sort of charade going on, and which said that sugar cane is a water guzzler and maize is water friendly. Studies have been given, and government in itself, in the parliament, they have acknowledged and clearly said now that for each liter of ethanol produced, sugarcane uses the minimum groundwater, minimum. Rice and maize are used much more. So that also controversy has been laid to rest.
Okay.
There are controversies created, if I may say.
Okay. Just last quickly, Mr. Sarogi, when is the cycle, if there were to be a hike, right? Typically, when does this happen, ethanol prices?
Legally, the contract says government may raise the price or reduce the price as in, if the situation demands. So there is an opening left for raising the price for this year, and it can be done retrospectively. But I've not seen that happen much. So I hope they give some incentive for the balance period. However, the next cycle will begin from 1st November.
Okay, 1st November. Good conversation, Mr. Sarogi, and we covered a fair bit of ground. I'm sure officials, government, etc., are also listening to you and the arguments that you made so forcefully.
And it's not an argument. I am laying the facts in order.
Absolutely.
So it should be seen.
Yeah, absolutely. Thank you very much for joining us here on CNBC TV 18. It's always a pleasure. Thank you. So that is Balrampur Chini, and essentially, the importance of ethanol, especially at a time like this. But I think Mr. Sarogi made an important point that policy, of course, should be steady and consistent. And I think he used the word government should not be a trader trying to buy low and sell high, things like that. Well, I think 295 points lower, so it's a 300-point cut. 23,345 is where we're at. We'll take a break. We're back. Somil Mehta of Mirae Asset Sharekhan joins us with a view on markets. Stay tuned.
Welcome back. Markets selling off now, approaching 23,300. It's a 300-point cut on the Nifty Sensex, lower by 900 points. Perfect time to get in Somil Mehta, Mirae Asset Sharekhan. Somil, first just tell us why this 23,300 mark is an important support for our market. What happens if that gets breached? And then your stock calls.
Good morning. Good morning to everyone. The first thing, 23,500, 23,400 zone was the 61% retracement level of the entire rally which we saw since 2025 April. The bottom from where 21,800 was the bottom, and we went up till 26,300. Now that zone has already broken on the downside. 23,300 level, which you mentioned right now, there is a gap area which was formed last year, and that area becomes a very crucial support zone for the markets right now. If it breaches on the downside, again the next levels starts getting open. So now 23,000 is the next target, and if that level is broken on the downside, 22,700 becomes the next level. So these levels keep coming up as and when the previous swing lows or the gaps keeps filling on. So the trend remains negative in the short term, medium term both, and I'll be expecting markets to keep selling off from here. My view is negative. On the upside, if there is a bounce, 24,000, 24,200 remains a very, very crucial resistance. Only and only above those levels, I'll be expecting a good bounce back, very sharp bounce back. So yes, view becomes negative in the medium term, short term both. I have two stocks on the selling side. Persistent would be my first sell stock. A flag pattern has broken on the downside, already in the downtrend. Great setup for a short trade. Stop loss would be 4,700 and targets would be 4,400. UPL would be the next stock to sell. A triangular pattern has formed on it's already in the downtrend. That triangular pattern has already broken on the downside. So stop loss would be 630. Target would be 580.
Okay, thank you very much for that. We will slip into a very short break with the news that the mid-cap index, which started off a little more resilient than the large caps, is now violently declining. 1,000 points lost on the mid-cap index. The fall for this week stands at 3.5%. Very small cap index will also come up for you on your screen. There also we're seeing a near 2% slide. On the other side is our special segment. It's the economy. Lata will discuss the impact of surging crude prices, the falling rupee on India's macros. Samiran Chakraborty of Citi and Abhishek Upadhyay of ICICI Security Primary Dealership will join her.
Consumer price inflation was up by 3.2% in February. We heard that yesterday. And that is in YOY terms, year-on-year terms, driven largely by food inflation. But the CPI number is not becomes important only from March. If you remember, the first strikes in Iran began on February 28 and crude prices rose from March 2nd. So it's March CPI that becomes more important. Moreover, this time, the wholesale price index, WPI, which we have been ignoring so far, may become more important, given that the government may control what consumers pay for petrol and diesel and maybe even cooking gas. But industry has to pay much more for all crude derivatives, like, you know, things which we hear less, propane, ethane, polymers. Also, all commodity prices like iron ore and aluminium are also rising because of logistical problems due to the war. So how will CPI and WPI pan out in FY27, and what will be the impact on other macros? I have with me two economists, Samiran Chakrabarti of City India and Abhishek Upadhyay of ICICI Securities PD. Gentlemen, good morning. Thank you very much for joining me. Samiran, first up, CPI, because that's what RBI will track. What is your math on how bad it gets in March itself? Because we know that gas prices and ATF prices are up, and I assume they go into a CPI. So impact in March and impact in FY27 more importantly.
So thanks, Lata, for having me. So I guess we have already kind of bottomed out on the CPI cycle, and we're seeing some gradual inching up of the headline CPI number. Now, from here on, if you see the precise impact of this LPG price hike, that's probably somewhere around, let's say, 10 to 15 basis points. But in general, because this upward move is going to continue, our sense is that we will get something around 3.6 for the next print on CPI. There's still 15 days to go in the month, so we'll have to see whether there is any further revision in any of the petroleum product prices. The other thing that we are closely observing also is the relatively early onset of summer and the heat waves that are coming. So to what extent that distorts the vegetable price situation, the overall food price situation, that's also something that needs to be closely observed. But in general, we have just marginally upped the FY27 average CPI forecast from 3.9 to 4%. And we have talked about a 50 to 75 basis point of upside risk to that number if this conflict lasts longer. Right now, the petrol diesel weight in CPI is about 5%. So if we are moving into a phase where 5 to 10 rupee of price hike is required for retail petroleum products, then that can add 25 to 50 basis points to the overall CPI number. But we don't think that's coming immediately. For that, we need to have the crude oil prices sustaining at this high levels for a much longer period of time.
Fair point. So, I mean, I heard from economists that we were working before the war with probably $65 average for FY27. Now, it may not be outlandish to work with a $90 average. Abhishek, if that were the case, I mean, if we have such a substantial increase, even assuming that crude prices will ultimately come down, but the average may not be 65, but much higher, maybe 85. What is your sense about WPI, since there the government's actions won't work?
Lata, as you mentioned, WPI reflects the imported price pressures much more closely compared to CPI, where there's a big weightage for services, where food is a big component. So WPI, what we have seen is a broader rise in commodity prices, not just the energy complex that you mentioned. Crude prices are, of course, up, but petroleum products, more broadly, jet fuel prices, etc., are up much more. That will have an impact. Plus, metal prices also, this year itself, metal prices are up 10% broadly. Since September, up more than 20%. All this will have implications for WPI. So in the current fiscal year, WPI should average very low, perhaps below 1%, closer to 0.5%. But for next year, while we were earlier thinking WPI averages around 4%, we're now thinking average closer to 5.5%, which of course impacts other metrics, including nominal growth, etc. But we should not see the favorable spillovers that we typically see from good nominal growth on fiscal metrics, etc., because this is a supply shock induced increase in prices, and therefore the tailwinds from this will be limited also.
Oh, that's very important. Nominal GDP, yes, may likely go up. So we would look at maybe a 11-12% rise in nominal GDP, you think? I mean, I know for wrong reasons, but it is.
Yeah, so if we still think GDP growth could average close to 7% if prices settles over the next fortnight to a month. On top of 7% real GDP growth, we are broadly working with a 4 to 4.5 average for CPI inflation. We were earlier thinking maybe CPI could average below 4%, but given recent developments, it is likely that even if prices and crude prices settle down, they will settle down at a higher level compared to what we were assuming earlier. But most of the pass-through will happen through weaker rupee. And with WPI averaging 5.5, maybe we could see a nominal growth in 11 to 12% range, therefore.
Yeah, government sources I spoke to are kind of happy about that. But as you say, that's not very positive, the reasons for which nominal GDP is rising. But Samiran, now to the downside. Do you think that, that the 7.6% growth of the current year is in danger? A whole host of ceramic companies, we were just speaking to PG Electroplast, they have not been getting LPG. So a lot of output has been hit, and consumption also may be hit. We've heard of gig workers and smaller restaurants. Impact of this quarter's GDP and FY26 GDP.
On a lighter note, Lata, we had 11 months of the year without the war, and only 1 month will be impacted by the war. So it's not that you will have a very significant change in the GDP growth number because of that 1 month issue.
One minute. If I may interrupt, Samiran, yes. March is a very important month. I mean, March accounts for almost 2 months. If you compare it to, say, June or April, the real hot months. So maybe it can have, it won't be 7.6, it may be less, you think? The overall GDP?
I mean, we have not revised our numbers down at all for FY26. But a quick point on that nominal GDP thing is that this will be the real test of the double deflation method. Because most of the price increases that we are seeing is actually for inputs. So if that's the case, then in a double deflation method, you should see the real GDP coming off very substantially, and the gap between real and nominal widening much more. So whether that happens or not, we'll have to see. So it will be a good year to test the double deflation method.
But are you revising your FY27 number or at least giving it a downward bias? I mean, GDP, Samiran?
Absolutely. I mean, there are multiple reasons why you could see growth headwinds coming and persisting, but it will all boil down to the duration and severity of this conflict, which honestly, at this point of time, it's a very difficult one to guess.
Okay, fair enough. Abhishek, have you tweaked your FY27 number at all? But the bigger question for you is, any change from Reserve Bank? I mean, they've been the most generous of banks, both with liquidity and with rate cuts. Do you think that they will have to start sounding hawkish sometime in calendar 26 or behaving hawkish?
Well, Lata, first on growth, as Samiran mentioned, we are not changing this year's growth estimate. In fact, we thought there was case for some upward revision to FY26 estimate because Jan-March growth has been implied to be comfortably below 7%. It is possible in the worst case scenario, we still get a 7.4% kind of number only when revised numbers come out. For next fiscal year, we are assuming, earlier we were thinking crude averages 65 to 70. Now we are assuming $80 on average. And therefore, while we earlier thought growth next year averages 7 to 7.5, perhaps closer to 7.5, it is now more likely at $80 crude, which is itself a big assumption. We get maybe closer to 7%, could be below 7% in the early part of the year. In fact, probably in the 6% handle in the early part of the year, when crude prices, energy prices generally are likely to be higher than the second half in our baseline. In terms of monetary policy, again, RBI starting point, they are in a good place. So inflation, H1, they were predicting 4% inflation, growth close to 7%, which is broadly potential in our view. So from here, I think what they need to assess is how much is the impact on inflation, how much is the impact on growth. It's still early days to make such calculations. But I don't think if you take into account, if you are assuming not a substantial increase in crude prices and maybe only $80, $85 crude average next year, and then RBI should be able to retain current policy settings, which is current policy rate. At the same time, because inflation in the new series, particularly the underlying inflation metrics are so low, that gives them leeway to keep injecting more liquidity as and when that is basically withdrawn on account of their FX intervention operations. And that has been, and they have been intervening quite significantly. So in that light, the current approach where they have been quite preemptive and proactive, as Governor mentioned in the last press conference, likely that preference continues given low starting point for inflation.
Yeah, thanks. I'm rushing you because I just want to get one more word on the rupee from Samiran. 92.36 as we speak. What should we be prepared for next year? Should we be prepared for, say, 93, 95? As well, any special steps from Reserve Bank in terms of attracting capital flows?
I think, Lata, what RBI is trying to do right now is to ensure that whatever global uncertainty is happening, that does not get amplified through domestic financial markets, also exacerbating those uncertainties through large moves. So that's why the rupee move post this war has been actually very benign compared to movements in some of the other currencies. For FY27, I think the critical factor is that do we turn into a BOP surplus after 2 years of BOP deficit? And for that to happen, right now, we were very comfortable on the current account side, but depending upon where oil prices finally settle down, we'll have to see to what extent the current account stays that benign or not. I think that will be a new factor to watch out for. And then
2% current account deficit?
We are right now working with a 0.5% of GDP current account deficit for FY27. This is with the assumption that oil prices are averaging somewhere around 65, 70, and every $10 per barrel increase in oil price increases the current account by about 0.4% of GDP. So clearly, if oil prices stay at 80 plus, then it increases the current account deficit substantially to more than 1% of GDP. At that point of time, the BOP surplus story would be more difficult to sustain. But for now, we are still holding on to that BOP surplus view, assuming that the conflict is short-lived.
Okay. Well, that will require a lot of discussion, the external balance sheet of the country. Thank you very much for parsing the domestic implications of the likely increase we're going to see in inflation. That's it on this edition of Bazaar. Chartbusters coming up after a break.
Stocks correct across the board with no sign of de-escalation in West Asia. The Nifty slips below 23,400, led by the banking index with slumps over 1.5%. Broader markets are worse off as all sectors trade with cuts.
PG Electroplast slumps as the management tells CNBC TV18 that the gas shortage has already resulted in a loss of 1 week's worth of production and may impact revenue guidance. Balaji Mines also slips as it says that multiple plants have gone offline following disruptions in ammonia supply.
Stocks of quick service restaurants also under pressure despite the centre saying it will supply 20% of monthly LPG requirements to restaurants.
ABB India rallies in a weak market as UBS upgrades the stock to a buy rating from a neutral rating, citing cyclical growth levers and favourable risk reward. The brokerage has also raised the target price to 8,030 rupees per share from 5,310 rupees earlier.
Kalpataru Limited rallies over 8% after signing a redevelopment project in Mumbai with a revenue potential of 1,400 crore rupees.
Hello, good morning. You've tuned into Chartbusters coming live from the CNBC TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Sonal Putra. Sonal, one more day that we're seeing pressure coming in. West Asia tensions continue. There's no declining in terms of the war there or any commentary that we're seeing that could be a bit of a positive sign. And today that's why 23,300 is what the Nifty is trading at as of now. Just slightly above the day's lowest point, not any sort of a recovery. Nifty down more than 300 points in the trading session. Apart from that, Nifty Bank, that continues to be under pressure as well, down almost 2% in the trading session. So Nifty Bank continues to be under pressure. PSU banks specifically are seeing a lot more pressure as well. Metals also continue to see a decline, and today the Nifty metal is down 4% as well. Sonal, a bit of a red screen coming in. FMCG, I think, is the only one that was flip-flopping between the red and the green today, but not much of green.
Yes, so it's the FMCG sector, as Vinny mentioned, is the only green on the screen today. It has continued to be the case, came off from the highs, but then recovered from those levels as well. Some defensive play which is coming in here. But apart from that, if you look at the metals index, that is seeing a big cut. Autos are down almost 7-8% in the last two trading session. It continues to be the case today as well. Again, the supply concerns around gas, that is something which could impact the production and, of course, further sales and demand as well. So Nifty Auto down another 2.5%. Broader markets under pressure. The advanced decline ratio should come up for you. And that is the one. For every one stock which is on the declining side, there are 6 stocks on the declining side as well versus advancing. So it's a good time to get a technical check on the markets. Okay, so Rupee has also hit record low of 92.41. So that's another dampener coming in for the Indian markets. Good time to get a technical check on the markets. Manish Hatirumani, proprietary trader and technical analyst from Jindal Investments, is joining in now. Manish, there's no respite to the fall that we're seeing in markets. Yesterday, yes, there was a massive recovery, but that got sold into 37 out of 50 Nifty stocks ended in the red yesterday. The trend continues. Do you think this is something we could see in coming weeks as well? And what are the next important levels on the Nifty?
Good morning, Sonal. Thank you so much for having me on the show. Well, yesterday when I had a chat with you, I did mention about the support of 23,600. And we also discussed that if that breaks, we should be heading to 23,200. Well, we are now heading towards 23,200. It's not very far away. What needs to be seen is whether we are able to hold that. While we do see supports breaking one after the other, if 23,200 does not hold, I therefore feel 22,700 should be the next level of support, and 24,000 is the current upside, which is already capped.
Okay, so 22,700, if it breaks below 23,200, then that is where the support comes. Manish, in terms of individual names that you're looking at, I believe yesterday you gave some 2 sell calls as well. Today, anything different, any buy call or both sell again?
Sorry, both are sell again. The first one is on Indices Bank, which is for a target of 760, stop loss of 910. This stock has recently broken the support of 870. Before that, it was 930. So 2 multiple good supports have broken, and both have happened on the back of good volumes. The second sell is similar to what I had mentioned yesterday also, which is on trend because the weakness continues. The target is 3,300. Stop loss is 38.50. This stock triggered the low of 2nd of February, which was 3645. This is an added sign of weakness on the back of very good volumes.
Okay, 2 more sell calls coming in today as well. Manish, thank you so much for joining us this morning, explaining us the technicals as well in terms of levels and individual stock names. But let's move on and shift focus to our special segment where we get you a few ideas of profit from Money Control Pro. Kanchi Shah, who is from moneycontrol.com, is joining us now to talk to us about the stock that she's been tracking closely, and that is Mahindra & Mahindra. Kanchi?
Yes, so today's stock idea is Mahindra & Mahindra, which continues to see strong demand momentum across its key segments. So GST rationalization has helped improve overall demand sentiment in the automobile industry. Consumer preference continues to shift towards SUVs and demand in this category remains quite strong. Another important driver is the commercial vehicle cycle. So as the economic activity is improving, demand for logistics and transportation also increases, which in turn supports its in both the LCVs and medium and heavy commercial vehicles also. The tractor business currently looks positive with higher reservoir levels, improving rural income and better infrastructure spending. The company expects the tractor volume to grow by about 24% in FY26. On the product side, the company has an active pipeline. So it also has plans to introduce 3 new ICE models and 2 new electric vehicles in 2026. Capacity expansion is also underway to support future demand. Of course, there are some risks such as rising commodity prices, increasing competition in the SUV space, and with the potential onset of El Nino can possess a key risk, particularly for tractor industry, given its direct linkage to monsoon and rural cash flows. But overall, Mahindra & Mahindra has been consistently outperforming the industry, and thus we advise investors to accumulate this stock from a long-term perspective.
Okay, all right. That is idea for profit coming in from Money Control Pro. With that, we'll slip into a break. When we come back, we'll get you more on the markets and a lot of stock-specific action on the other side. Stay tuned for that.
Key segments. So GST rationalization.
Welcome back. You're still tuned in to Chartbusters. Well, gas supply squeeze has impacted the auto sector. We've seen auto index being one of the biggest laggards in last couple of trading sessions. Sudarshan is joining us to tell us what brokerages are making of this move. Sudarshan?
So as you have said, that auto has been one of the biggest laggards in the sector, like if you talk about across the market. And this week, Nifty Auto Index is down almost 10% and set to be the worst week that we have seen in last 6 years or say since COVID. Now, talking about the impact, so gas supply issue has become one of the important issues, especially for the auto sector. The usage is huge. Now, two brokerages have written. First one is JP Morgan. It's saying that ongoing geopolitical conflict and rising commodity prices have become major risks for the sector. And so what it will do, it will disrupt the production. And also, if you would have seen that all the prices of commodities have been rising, that also going to impact, especially on the margin front, all the auto companies will see. Now, it has mentioned few risks. First, gas, whether it's LNG or LPG shortages, could lead to production shutdown or disruption. Second, potential disruption to CNG availability may at the pumps could impact consumer preference. So companies like Maruti has the if you're across the portfolio, CNG cars has the contribution of almost 50%. So if there is a impact, then the preference for CNG cars might come down. Third one is higher fuel and commodity cost could hurt the margin. Fourth, global shipping disruptions could impact the exports. Majority of the companies have huge export exposure, especially on two-wheeler front. Bajaj Auto's export forms almost 50% of total volumes. TVS Motor, almost 30 to 40% come from exports. And last one here is weakening consumer sentiment could hurt the recovery that we have seen post GST rate cut. Post GST rate cut, there has been a huge increase in the volumes across the industry. Growth has been in the range of 20 to 30%. And if this disruption continues, it might hurt consumer sentiment. Now, Nomura has analyzed the usage of all the energy. It believes that gas has the huge exposure across the sector, whether you talk about auto companies or auto ancillary companies. And in the near term, it would be very difficult for companies to shift to another source of energy or another source of fuel. So amongst auto companies in its coverage, majority of the companies will be impacted, but the companies which will be impacted the most are Maruti, Bajaj Auto and TVS Motor. Coming to auto ancillary companies, they believe that Balkrishna Industries, Apollo Tyres, Uno Minda and Bharat Forge have the huge exposure of gas usage and they will be impacted the most. Now, lastly, talking about the retail data. In March 2026, as of now, the data is good. So, numbers of 2026 March are already higher than what we have seen in March of 2025. But we'll have to see the impact that industry will face going forward, or say after 10 days or 15 days, that will be tracking very closely.
Okay, thank you so much for that, Sudarshan. And Nifty Auto month to date, that's in the last 13 days, especially since the war started, is down 13%. But Petroleum Minister Hardeep Singh Puri said that OMCs will allocate 20% commercial LPG to business starting today. Let's hear out the comments coming in from him.
3-member committee comprising executive directors from IOCL, HPCL and BPCL was constituted on 9th March 2026. Extensive meetings have been held and state civil supply departments and restaurants associations across the country and are continuing. The committee has assessed genuine need by geography and sector to ensure available commercial volumes reach commercial LPG requirement is going to be supplied from today by OMCs in coordination with the state government so that there is no hoarding or black marketing.
Okay, all right. So that is an important clarification coming in. 20% of commercial LPG supply, which will go to industries. Now, this is different from the gas allocation order, which had come by earlier. That was for natural gas, LNG and regasified LNG. That is where 80% of allocation would go to industries. So this is different from that. So just wanted to clarify that as well. Let's talk about the QSR space, because as Hardeep Singh Puri said, government will supply 20% of monthly requirements to restaurants and eateries. Manglam is joining us to tell us more as to how this will impact the sector.
Well, the last two words of what Hardeep Singh Puri said, that, hoarding and black marketing, those are the couple of things that the government wants to go against and, in fact, improve the situation upon that. And there has been a lot of panic as well. So they want to just improve that situation. So as a result of which the centre has said they will release commercial LPG cylinders on priority to curb panic-driven bookings and restaurant shutdown risks. And 20% of the average monthly commercial LPG requirement will be allocated from today to restaurants and eateries by OMCs. What does this do? Does this, fix the situation completely? Perhaps not. But it definitely ameliorates the situation. And, the fact that the government is listening keeps the sentiment intact, even though on the ground there could be some sort of shortages, etc. But the fact is that, they have put a bit of a backstop to that, which is why the stocks are mildly lower and not as much. The only two stocks which are losing a lot more are Devyani International and Sapphire. And that's because if you look at Pizza Hut India's official social media pages, they have put out a note that, their restaurants would be operating on limited capacities, or limited outlets of theirs would be operating. And because Devyani and Sapphire have announced a merger, both those stocks move in tandem. But by and large, there has been some respite that has come in, even if not completely fixing the situation, should be a positive, which is why the decline is limited on most of these players. In fact, some of the players like Swiggy are still marginally in the green.
Okay, Mangalam, thank you so much for that. But on that note, we're going to step into a very short break. We'll come back with more on the markets, more stock-specific action on the other side. Stay tuned in. Welcome back to Chartbusters on CNBC TV 18. The Nifty is where we started the show with 23,370 approximately there, where the Nifty continues to trade at. But let's move on and talk about NSE because that's getting ready for its mega listing. And Nimesh has been picking up some details from sources and is joining us now to tell us about more on this. Nimesh, over to you.
I mean, this has been a much awaited IPO in the pipeline for a very long time. Looks like finally it's going to see the light of the day. Yesterday, NSE has put out an official communication that they've appointed 20 investment bankers as well as 8 lawyers as well for the IPO. So that's the detail which has come from the NSE. Additionally, my colleague has picked up from his sources that NSE is looking at a valuation of close to 5 lakh crores for the IPO. It will be an entire OFS, so no fresh issue. The existing shareholders will have to potentially sell stake in the OFS. 4 to 5% dilution is likely why the OFS route, and the IPO size could be upwards of 20,000 crores. So that's something that my sources that my colleague has picked up from his sources. There was no official communication from the NSE yet, but the official word from the NSE last evening was that they've already appointed 20 investment bankers and 8 law firms for the IPO. So looks like the wait is finally over. Remember, this is one of the unlisted stock where the retail holding is the highest. So there is a lot of anticipation, a lot of retail interest as well. And looks like finally the NSE IPO could be around the corner. Maybe towards the end of the year, you will see that IPO getting listed.
Okay, all right. Important update coming in on the NSE IPO, much awaited. Thank you so much, Nimesh, for joining in now, and we'll keep coming back to you for more updates on this one. But the other big news to track is Rupee hitting another fresh low, with dollar now at around 92.4. Oil is at $100 per barrel. Lata, tell us more. What's happening in the dealer checks?
Today, it's a pan-Asian fall, as it has been for several days in the past. It's about a 0.25% fall you're seeing in practically every Asian emerging market currency. I mean, you can take ringgit, Filipino peso, Thai baht. All of them are showing a similar ranged fall. And that's because there are 200s doing the rounds. Crude is at 100 and dollar index is at 100. I mean, it is 99.8. I mean, not so long ago before the war, it was 96 decimal point and something. But now both crude and dollar at 100 is creating a psychological impact on people wanting to go ahead and buy dollars. So the dollar demand in India itself is from the usual suspects. I'm not giving you any new information on that. It's foreign investors, it's importers, all of whom just have to, those who are rushing out after selling stocks, and those who have to buy imports for raw materials. After all, March is a month to the finish for manufacturing sector, and therefore importer demand is also there. The real price of the dollar is not 92.40, but much more. All central banks and RBI spearheading it are generously selling dollars in the hope that this is a short-lived war and they should curb volatility. So, but if the Reserve Bank were not there, we would be staring at a much higher number. However, they've been offering generously. The chatter in the market is that in the past several days, they may be even averaging a sale of $5 billion, not entirely from in the spot market. It could be forward positions as well. So 1 month ago, forward positions also matured today from the NDF market. That also creates a demand for dollars. So there is enough demand, and the supply, therefore, from the Reserve Bank continues. The economists' worry now is we are entering the 3rd week of the war once we get into the weekend. That will mean now you have to start rethinking that this is not a very short war. Their assessment of next year's macros, whether it is GDP or inflation or current account deficit or rupee, was based on crude at $65. But now with the port congestion, and even if the war were to end, the amount of time it will take to restart refineries, restart normal shipping, makes everyone believe that an assumption of $80 next year or $90 is not out of the realm of reality. It is not a stretch. And therefore, the worry is that current account deficit, which everyone thought will be under 1%, is likely to be over 1%, I mean, close to 2% next year. And to find that much of capital flows to bridge that current account deficit gap will be an ask. Capital flows have been negative all of this year. And therefore, will we be able to fill it is a very, very big question. So there are worries on current account deficit, worries on balance of payments, worries on the rupee.
Okay. Lata, thank you so much for giving us the roundup over there as well. But on that note, we're absolutely out of time on this edition of Chartbusters. Thank you so much for tuning in. Up next, of Trading Hour.
You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. As always, with me are Hormas Vatakia and Ritu Singh. It's another day of big decline for the frontline index, another day of seeking newer lows on the index from what we saw at the start of the week, where, we thought maybe 23,700 could actually hold out. Not just that, yesterday we touched 23,550, and today, straight off the bat, we're below that 23,400 mark as well, hovering around 23,350. So market's treading lower, and it's seeking lower levels as well. As we speak, the Nifty Bank is down over 1,000 points, just on the verge of breaking that 54,000 mark as well. This week, it's been bad. It's down nearly 2,000 points for that frontline index. And we have the broader markets as well. The mid-cap index started off by not falling as much, but now it's falling twice as much as the frontline indices, 2% lower. The only respite, perhaps, is the fact that it's a Friday today, and then the next 2 days of no trade. Ritu, seems like bears are on top and are clutching the bulls by the neck.
Good morning, Manglam. That's right. I mean, it seems that every up move is, getting sold into. But market breadth, it's not worsened a lot more than what we'd seen in the morning. There are about 4 to 5 stocks that are declining for every 1 stock that is advancing. It's red across the screen, whether that is the frontline index, the bank Nifty, the broader markets. The only pack that is just managing to about hold on to the green is the FMCG pack. That's up about 0.5%. But other than that, I mean, you have names like Hindustan Unilever, that's buzzing in trade. Bharti Airtel, Reliance, Tata Consumer. These are some of the names that are holding up, the markets on one end. But the big drag is coming from, some of the financials like HDFC Bank. That alone is one of the big draggers on the Nifty today. L&T, ICICI Bank again, State Bank of India. Those are all some of the names that are contributing to the downfall. But Hormas, what are the top movers you're watching out for in trade today?
Well, it's been a forgettable week for the markets so far, and this time around, compared to the broader markets, it's been the index that has been leading the fall. This time around, the Nifty is down 4.5% so far this week, and we still have around 3 odd hours to go for trading to end. That 4.5% fall is the worst since December of 2024. If this fall goes below 5% and above 5%, then this will become the worst week that the index would have had since June of 2022. And leading the fall on the Nifty has been the Nifty Bank, as Manglam just highlighted, that 1,000-point fall, 6% lower on the Nifty Bank this week, the worst it has had since May of 2020. And compared to the Nifty and the Nifty Bank, the broader markets have been fairly okay. A 4% cut on the mid-cap index, a 3% cut on the small-cap index. They have seen this before just in the month of January itself. But it is the Nifty that is leading the fall this week. When you look at the worst performers as well, unsurprisingly, it is auto. The auto index is set for its worst week since March of 2020 as well. Eicher Motors, Tata Motors, Maruti, Mahindra & Mahindra. 4 out of the top 5 losers this week have been auto names, and all of them are down 10% or more in today's tradings in this week's so far. Take a look at the Nifty Bank as well. All the stocks on the Nifty Bank are down for the week. In fact, the best performing Nifty stock is also down, Nifty Bank stock is also down 4%. So it shows the kind of sell-off that you have seen. Look at IndusInd Bank, IDFC First, Axis, Kotak, SBI. These are heavyweight banks on the Nifty. That's 7%, 8% cut. IndusInd Bank is down 12%. Of course, no longer a part of the Nifty, but a 12% cut nonetheless. You take a look at the broader markets. So the pain here has been led by the wires and cable companies. Polycab and KEI until last month were trading at record highs. This week, they are down 20%. This KEI is down 16, Polycab is down 17. Auto stocks find a mention here as well with Ashok Leyland and Bharat Forge, and Colgate Palmolive, after the sell-off that it has had this week, earlier in the week, down 11% as well. Now look at the small cap worst performers. PG Electroplast, it took a bit of a pummeling on Monday. It is being pummeled today as well, so 19% lower for the week. The fall in PG Electroplast has percolated down to Amber Enterprises as well, down 17% with 5-star Business, Signature Global, MRPL, all of them seeing losses of anywhere between 12 to 13%. Of course, there are some outperformers this week. One of them predominantly has been Adani Total, and this stock is up almost 30% this week. NTPC Green, of course, the power stocks that surged in yesterday's session, the stock is up 14%. Premier Energies has done well this week, and the only one Nifty name that stands out for the week has been Coal India. That stock is up 6%, still trading close to 52-week highs. But otherwise, it's been an absolutely forgettable week if you are a bull.
Indeed, a forgettable week if you're a bull, barring a couple of these names which are doing well. But, the plate that Horma's put out on how weak, the markets have been this week versus how long ago, it'll tell you, put things into perspective as well. We take a short break and we'll, on the other side, speak to Dheeraj Nim of ANZ Research.
Welcome back. 300 points on the index as of now. Every minor recovery is getting sold into. We just highlighted PG Electroplast and the kind of week that it has had. And this is after the management spoke to us earlier in the day. Of course, on Monday, they put out an announcement. The stock has recovered from the lows of the day, still down 4%, still down almost 20% for the week. And they also spoke about the gas impact on operations. Upasana is here with more details on this.
Well, the company 3 days earlier had highlighted that the gas shortage under its supply agreement due to the Middle East conflict. Now, the disruption has led to curbs on LPG allocations, prompting the firm to explore alternative supplies while assessing the potential impact on the production and customers. To discuss this, the company joined us today morning, in which they have highlighted that the LPG shortage is impacting their production lines overall, and that this gas shortage may impact the FY26 revenue guidance given by the company, as March forms nearly 20 to 15% of the overall annual sales. So the impact in this month would certainly impact the overall yearly outlook of the company. They've also highlighted that till now, they are seeing a 1 week of production loss across its AC manufacturing units. So 2 out of 4 units are seeing a temporary delay in that sense. And companies also exploring alternatives to LPG gas is what they have highlighted further. So that is the reason we can clearly see the stock moving in trade today.
All right, Upasana, thanks very much for bringing us that summary. But actually, let's listen in to what the management exactly had to say, when they spoke to CNBC TV 18 earlier, talking about the gas shortage, which they said has already resulted in a loss of a week's worth of production and could impact revenue guidance as well.
Out of 4 plants for manufacturing of air conditioners, last week there was a disruption of 3 to 4 days. This week there has been already a disruption of 2 to 3 days. So if you look at, we have almost lost a 1 week of production. So I would not be able to give you the number on that. What I can tell you that we are trying to work on how we can salvage the situation. We are working more on that instead of, calculating how we are able to achieve that revenue guidance or not that. Our teams are more focused on how we can mitigate this. We are working on some alternative technologies, alternative gases. Our technical teams are working on that.
All right, let's get you a quick check on the macro signals of the day. The market sell-off that we've been seeing, a 300-plus point cut on the frontline index and another 880 points cut on the Sensex. The primary catalyst is this continuing tension in West Asia, as we've been telling you. The surge in global crude prices on the back of that. Brent crude nearing $100 per barrel, and that has triggered a broad-based sell-off across sectors that are sensitive to the raw material cost. Oil prices back above $100 a barrel, in fact, reacting to some of these developments with the Iran leadership pledging to keep the Strait of Hormuz closed. This is a critical choke point nearly for 20% of the world's oil supply, and that is what is adding to the negative sentiments. Now, higher oil prices increase India's import bill directly. They raise the demand for dollars from oil companies, and that puts a pressure on the rupee, and that's exactly what you're seeing playing out today. The rupee has hit yet another record low, about 92.41 to a dollar from the previous low of 92.35 that it had hit yesterday. So it's down about a quarter of a percentage point just in today's trade on the back of what's happening with crude prices. The dollar index also nearing 100, continued foreign investor outflow, the dollar demand from importers, all of that playing in. In fact, all Asian currencies are lower today. It's not just the rupee. The 10-year benchmark yield as well, trading around 6.67%, which is about a basis point higher than the last close. So that is the macro setup. But let's bring in Dheeraj Nim, who is the economist and forex strategist at ANZ Research, who joins us now with the rupee hitting this fresh low of 92.40, even as oil, crosses that $100 per barrel mark yet again. Dheeraj, thanks very much for joining us yet again. The last time we spoke a couple of weeks ago, you said we could get to 93 a whole lot sooner if oil prices stay where they are. And, the wild swings that we've been seeing now, again, back above 100. That's why we're seeing this new record low. But what else is really adding to the pressure today? What is new? We know that there's been FII selling. We know there's demand from importers. But what's adding to the fresh pressure today?
Look, I think it's broadly the risk assessment around this conflict that it could drag on for much longer. In fact, when we spoke last, I think the market was yet not factoring in any significant possibility of it dragging beyond a couple of weeks. But now with the Hormuz closed and the conflict dragging on, I think those assessments are changing. And mind you, oil prices are the most important global push factor for India's economy, which at the same time cut growth, raise inflation, widen your current account deficit, weaken your fiscal balances and currencies. So it is a very formidable shock. In fact, if oil stays around $100 a barrel, this is not really, the record low of rupee we are talking about. It could be much, much weaker.
Right, could be much, much weaker is what you're saying. But, the initial assessment so far that you've made, your desk has made on the impact of this crisis so far on our, on our macros, if you could give us a sense on your base case scenario, your bear case scenario, and at what point in time do you expect, this to perhaps de-escalate, if not entirely, and, end and get better?
Right. So we have recently revised our crude outlook, and we think that for Q1, it could really be around $100 a barrel and then could gradually ease towards, $70 to $80 a barrel by the end of the year. But that's somewhat, implicitly making a statement on how long this conflict could go on. Of course, there's much uncertainty around it. The key factor here is that currently the world may not be in a deficient supply as far as gas and oil are concerned. But as long as these disruptions continue, what we are currently seeing as temporary setbacks could become more durable ones. So that is a key risk to monitor. Now, when we are thinking of macro, we have analyzed a scenario, oil prices averaging between $80 to $100 a barrel. Look, if it's towards the $80 a barrel in FY27, I think some amount of burden sharing can do the macro trick, preserve macro stability. The growth hit will not be very large. And the rupee could also be somewhat more stable. But closer to $100 a barrel, I think the absorptive capacity of oil marketing companies, governments, and households is already thin. I mean, the financial buffers are not very large. It could mean material adjustments in macro and markets.
So based on this assumption, Dheeraj, that you're expecting crude to remain around about $100 a barrel, what does that do to the balance of payment situation of the country as well? Have you or your desk estimated an impact on the current account deficit and so on as a result of this?
Look, if the crude were to stay around $100 a barrel, which is our worst case scenario at the moment, I think the current account deficit could easily rise to 2.5% of GDP or higher. Now, historically speaking, these numbers are on the worst side of things, but not really the worst that India has seen. But remember that, the current balance of payment challenge is a capital flow challenge. It's not only portfolio flows that have been missing, but also the stable flows, the net FDI, etc., which have also been missing. So even a slight widening of the current account deficit is quite problematic from a funding perspective, and therefore has a compounded effect on the INR or the FX reserves of the RBI. So at 2.5% of GDP, current account deficit will be particularly wide from this funding constraint perspective.
Right. While we're strong on our forex reserves, it's been tapering off lately because, the RBI is obviously trying to smoothen the decline in the rupee or the weakness out there. How much more room do we have on that front as well, given that not only will we be using dollars to pay for the extra price of oil, we will have to use some of that to also smoothen the rupee decline curve. If you could comment on that. And you did say that, if some part of the burden is shared with customers, maybe we could protect the fisc. But then again, that comes at a time when you have important elections like West Bengal, we have Tamil Nadu, Kerala, Assam. Politically, do you think that would be prudent?
Look, tinkering with fuel prices, domestic cooking gas prices very much is never politically very easy. So, with elections, it becomes even more politically difficult. But the reality is that if oil prices do remain around $100 a barrel, there is no other option. Neither the fiscal has enough absorptive capacity to absorb that kind of a shock, nor do the oil marketing companies. So in that case, inevitably, households will have to share some burden. The tricky part is their net financial savings of the Indian households are not as robust, for example, as it were in the backdrop of the Russia-Ukraine crisis. So I think that the prudent path would be to absorb as much as you can from a policymaking perspective. But if these challenges are going to stay here, then eventually, the households will also have to partake in burdening the shoulder.
Dheeraj, what is the absolute worst case you've built in for the rupee in the near term? A level that you could share with us. The previous one you've given us was a 93 kind of a level. And also, has your thesis on what the RBI may do about it with the upcoming policy in 3 to 4 weeks, has that changed at all? Can it continue to look through the fact that rupee is at 92, 93 kind of levels, crude is at $100? At some point it starts to reflect in the macros, in the inflation as well.
Right. So on that, we have, maintained our call that in the April meeting, for now at least, the Monetary Policy Committee will leave the policy rate unchanged. And there are two reasons behind that. Look, easing is out of question with this kind of a supply shock on the horizon. But I think the policymakers would be mindful that even at higher prices, there is not enough supply of energy in several parts of the economy, several pockets of the economy. You're already experiencing growth concerns. So I think they would be mindful of that. And we also have to realize that India has entered the shock from a place of strength. Growth is above 7%, inflation is below the target. So it buys the Reserve Bank of India some time to wait and watch and assess how this shock can durably pan out. So in April, we expect a hold. But again, most of it depends on a very fluid situation in the Middle East. If oil prices do remain close to $100 a barrel, I wouldn't rule out tightening is on the cards, but perhaps later.
Dheeraj, thank you so much for sparing time and joining us today. The rupee hitting a new record low, and what is in store for the currency going forward. Take a short break. The index still down over 300 points. Get you a chart check and some trading ideas with Ajit Mishra from Reliance on the other side.
Welcome back. Weakness persists for the market, and perfect time to get you all the updates from the FNO desk. And the thing that stands out is there is a fair amount of long unwinding. There are fresh shorts which are being added to the markets, and at the same time, there is a sentiment, a huge sentiment of risk off. Right now, the Nifty Bank holding on to 54,000 by the skin of its teeth, while the Nifty itself has fallen 300 points. The mid-cap index has it worse, down about 1.9%. Risk off and safe haven seeking is what we're seeing, which is why some of the money has been directed to a couple of these beaten down multiple derated FMCG stocks. So look at something like an HUL or maybe Tata Consumer Products or Britannia. At the same time, something like Trent as well, which has fallen about 40-50% from its peak, finding some takers right now. But that's pretty much the nature of the market or the sentiment of risk off. The reason why I call it risk off is because if you look at a lot of these put writers as well, the ones who had written options at 23,600, 26,400 and 23,400 and 23,500, all of them have been caught on the wrong side. So we're not seeing a lot of put writing either. All those who had written their puts earlier are now unwinding their positions. So pull up, the 23,500 put or the 23,400 put. All those options come up for you on the screen. And below, in that plate itself, you would see a lot of red. Red implies that those guys have covered their positions. And the green, 132 on the 23,500 put for one, implies that the premium has risen. So when the premium rises, those who've written those options are caught on the wrong side and they are struggling to cover those positions, and that's what we're seeing. On the other side, however, as the market falls lower, those call writers have come back into the action. And over the last few trading sessions, if you've noticed, the call writers have made a lot of money. And now the parties move lower to 23,400 call. And if you look at the others as well, 23,300 call as well is being seen a lot of writing right now, as is 23,500 call. Again, telling you that the ceiling of the market is coming down. A couple of days ago, it was 24,300. Yesterday, day before, it was closer to 23,800 to 24,000. And now as we speak, it's come lower to 23,600 to 23,700, while the bottom of the market is grinding lower as well. All of this is at some point going to unwind and, unravel, because 90% of the positions are still on the short side. But when that happens is something that we will be tracking very closely. The put-call ratio right now is at 0.76. Typically around 0.65 to 0.7 is where it bottoms out. So there is still some room on the downside for the market from an FNO positioning standpoint. The only stock that is seeing a lot of long positions being added, and this has been the case right since the morning, we've seen a big move on Syngene, up 4.5%, with a lot of open interest backing it. That's telling you that longs are being taken on that stock. Again, it's the risk of safe haven seeking sort of sentiment where consumption pharma stocks are doing a lot better than other parts of the market.
Well, that's the story of the market. In fact, there's been the story of the market all through the week, right? Every time the index sees a recovery and then gets sold into, from 24,300, we moved to 23,800, and now we're at 23,300. That's the kind of week that the Nifty has had so far. Still, in meandering in that 23,300, 30 odd to 23,360, 370 odd in the last half an hour or so, there has been no significant movement as such. There is a recovery, then that recovery gets sold into, and then we try to recover from those lows again. Ajit Mishra from Reliance Broking is now joining in. Ajit, good morning. Thank you for joining in. Your call on the index now that we've come, almost 3,000 points now from the record high levels. Do you still are going to be brave enough to catch a falling knife, or do you see more downside on the Nifty? And of course, your stock calls for the morning.
Yeah, good morning, Hormaz. So Hormaz, last week also we discussed about this, that though we have seen decent correction from the record highs, but still there is no sign of bottom, considering that the crude is still hovering around $100 mark. The India VIX is still around the upper band, close around 2021 mark. So this shows that the caution, the uncertainty is still intact in the market. And the way we are seeing that supports are not working as such, means the recent swing low close around 23,700. We breached that mark yesterday. Today we are inching toward the gap area of 23,000, 23,200 mark. So we feel that this area, considering the kind of pressure that we are seeing in the rate sensitive pack like banking, auto and all, possibly a retest is quite likely of 23,000, 23,200 mark in the near future before we see any meaningful up move. Like Mangalam rightly mentioned that apart from the technicals, the derivative readings are also indicating oversold positions. So possibly, yes, around that area, we might see a respite or a rebound attempt in the market. But as of now, it's a sell on rise until we decisively reclaim 23,800, 24,000 zone. So basis that, at the same time, pharma and energy basket, they are still offering a bit of a respite. They are still offering buying opportunity. So within the energy basket, NTPC, wherein we are seeing gradual uptrend maintaining. In fact, there's a fresh breakout that happened in stock recently. We are seeing a bit of a pause. So this can be considered as a buying opportunity in NTPC with 402 as an immediate target with stop at 383. At the same time, ITC, while some of the FMCG names, they are witnessing recovery, here we anticipate this negative trend to continue, and 294 is what we are eyeing as an immediate target. So with stop at 309, one can go short in ITC.
All right. Ajit, thanks so much for joining in with those calls. We'll let you go on that note. We'll slip into a short break, but when we return, we'll discuss market technicals, market fundamentals rather, with Ashi Anand of IME in just a bit. Welcome back. We have with us, as promised, Ashi Anand of IME Capital, who joins in to discuss the market fundamentals, his top sectoral picks. Ashi, always a pleasure to have you. You know, since you're constructive on the financial space, and that's been in the news these last few days, let me start with it. You know, we've been seeing the, sort of downturn on the bank Nifty the last few sessions. Yesterday we had, some guests like Sridhar Shivraman telling us the profit pool for banks is shrinking. You have PSU banks now sort of coming in with a larger force, taking away some of the market share from private banks, especially in the retail space. And this whole narrative around PSU versus private bank itself shifting a bit. Where do you stand? I know you're bullish on sort of some of the large cap names. Where do you stand in this? Do you still think there's opportunity in some of the private banking names, or are you more in favor of the PSU banking pack, some of the larger names there itself?
Yeah, sure. So great. So I think you can partially agree with the narrative if you just look at what's happening in terms of private sector versus PSU. If you go back 6-7 years, there was a big divergence in terms of their performance. Your Kotak's and your HDFCs and most leading private sector banks were all growing very consistently at 20% plus. And your PSU banks, which are still struggling with historical corporate NPA issues, were actually barely growing, and they had large NPA issues. So as compared to the situation 5-7 years back, where the value migration from PSU banks to private sector was happening at a very rapid pace, that distinction or difference is actually clearly reduced. However, that said, there clearly still is a very big difference in terms of the overall quality of the banking operations, the kind of access to technology that some of the newer age private banks have, the level of aggression, etc. So I think you're still looking at a situation where there is clearly going to be a continued value migration away from kind of PSU banks towards private sector banks. PSU banks would still account for over 2/3 of system credit. I think that move away from PSU banks towards private banks is structural. It's just that the pace has probably reduced a bit. But that said, at least from our positioning, with the exception of possibly a much higher quality PSU bank like SBI, which does operate quite often with private bank type characteristics, we clearly still believe that it's better to pay a premium for some of the high quality banking top private bank franchises, because the overall performance of PSU banks still has a fairly large way to catch up.
All right, we take that point. So PSU banks, in the overall business-wise, still have a fair long way to catch up, but valuations have caught up as per you. I remember from the last time we spoke that you did have some sort of exposure to a couple of these sectors which are hit right now. One of them, obviously, is the IT space. You had a fair weight on Infosys, if I remember correctly. Then you had some stake in Zomato as well. Part of your portfolio was on Zomato. Then Titan has been doing well for you. Zomato was down about 40% from the peak. And Sobha was one of your larger investment bets. Sobha has some sort of exposure to the Middle East market as well, which is now facing some sort of concern. What's your, do you still hold them? And what's your prognosis for these stocks from here on?
So just to give you an indication, and I think more than specific stocks, this is part of larger risk control. We are a bit concerned about what's happening with the entire US-Iran conflict, and we aren't necessarily sure that the worst is behind us. This is going to be a bit of a 0-1 in terms of how quick the resolution is going to be. If you see a resolution within March, April, the 10% fall from the peaks probably kind of capture the risk in, and it's a good buying opportunity. But given the strategic difficulties or complications related to how close Iran is to the Strait of Hormuz towards key oil infra, there is clear potential for further downside risk, and we are a bit cautious about that. So within that context, we have actually created cash in the portfolio. And so we're holding about 10 to 15% cash in the portfolio. And actually, that cash which has been built up includes some of the names that you've included. So we've kind of reduced our weights in IT very significantly. In fact, we've largely exited. Now, this is actually something we were doing prior to the US-Iran conflict because of kind of this larger concern around deflationary pressures of AI on IT. So while IT does offer a tremendous amount of value, I think there's uncertainty around deflationary pressures, and which is where IT services is a segment that we've strategically decided to get out of. And the same actually holds true for real estate. What was happening with real estate is this is a high discretionary, high beta play. If you kind of have the whole US-Iran conflict continuing for longer than expected, we kind of saw a certain level of risk here. So as part of overall portfolio restructuring, it's not really specific names. We've actually gotten out of IT services and real estate. That said, we continue to be extremely bullish about the longer term outlook for all digital platforms. Eternal is just one of them. So that we continue to hold.
Sure. All right, Ashi, thanks very much as always for joining in with those views. We have to slip into a short break, but up next, we'll focus on the bond market with Panisha Gupta in just a bit.
CNBC TV 18 and India Bonds present Bond Street.
Welcome to Bond Street. Joining us on the show is Lakshmi Iyer. She is Group President, Investments and CEO, Bajaj Alternate Investment Management Limited. Lakshmi, hi. Thank you so much for joining in. We all do understand that while equities rule when it comes to India, but when it comes to alternate investments, especially for retail, what is the understanding, awareness and willingness to invest in these?
Hi, Manisha. So firstly, when we talk about alternates, it is somehow meant that, you know, it is beyond the obvious. But if you just look around, you realize that Indian investors, and of course offshore investors also, apart from equities and fixed income, are so used to investing in real estate, for example. So that is part of alternate investing. They invest in unlisted equities, like private equity, again, for as a case in point. They love investing. AI is a theme right now, right? So they love investing in startups, which is having something to do with AI. So I think all of this is basically part of the alternate ecosystem. And of course, there's more. I mean, there is part of equities itself. There's part of fixed income, which is offered in the form of performing credit. So I think that ecosystem is gaining popularity. And if you see this category, depending on which category that I spoke about, is growing maybe lower end of 25% to upper end of 40%. So I think in terms of awareness and willingness to invest, I would say the keenness is very, very high. And the key word here is diversifier. People don't want to put all their eggs in one basket. So yes, they want an entire platter. I mean, whoever said that if I go to a movie, I just watch the movie. I want the popcorn, I want the Diet Coke, and probably many more.
All right, nachos for me, please. But Lakshmi, having seen the India's bond market evolve and across multiple cycles, what is that single biggest structural shift that you witnessed and you believe that the recent push of retail investment, whether it has been from the policy framework, SEBI pushing it, Niti Aayog report as well, what is it that movement that you think will take it to the household adoption?
So I'll say, Manisha, you know, I've been a market student, I would say, for over 2 decades. And my pet peeve always has been that, you know, the bond markets has always been for institutional investors. Whereas equity markets, even real estate, gold is there for everybody, I mean, Aam Janta. So I think the biggest thing that happened was that, you know, launching of these online bond platforms, which allows, if you can say, tokenization, you know, maybe absolute retail, 10,000 rupee investor, I mean, like $100. I think it's the biggest, I would say, eureka moment. You don't need to go to a bathtub for that, but clearly it's a very, very big mindset change. And well, it's just been early days. Even though we've been 4 or 5 years into it, I'd say that, and volumes have picked up, no doubt. But I'd say it's early days because we need more and more of the FD mindset investors or in, you know, retail investors to find favor with the platform. So I think we barely have touched the tip of the iceberg.
So you talked about OBPPs earlier in your comment here, and while of course they have reshaped the way retail investor does invest into bond markets there, but what is it, and do you really think that they can become what equity brokers became for stocks?
See, I'll tell you, equity brokers today are catering to retail and institutional audience. You have a different set of broking fraternity which is catering to this audience in the bond market. So I'd say we will get to there, but to completely ask them to morph or expect them to morph might be a little bit difficult, but we are getting there, as I said, because it's great to see. When I say retail, I'm talking about retail, HNI, anybody who's non-institutional, socialize with all of these platforms. And it is brilliant because today there is awareness. You know, everything, the proliferation of an asset class always starts with awareness. Only if you are aware, you will actually, you know, would you have ever seen, today somebody told me, I saw Dhurandhar only after you started using dialogues. So if you are not aware, how are you going to make it available? So I think awareness is very, very critical. And I think that's what these bond platforms are doing.
Who knows?
Yep.
All right. So what is it, what do you say is, you know, the single biggest gap holding the retail in bonds today? What is it? How would you fix it?
As I said, I partly touched upon it, the awareness route. I really don't know how many people knew that Rashmika Mandana is also doing Bollywood. It's not that she is just Tollywood. So I think the key is awareness. And once you build on it, what happens is that there are multiple levers in bonds, unlike just the price, you know, which moves up and down and retail investor just latches onto it.
Right.
I would say beyond that is the liquidity. Today, I enter a stock, one stock, 10 stocks, 100 stocks, or lakh stocks, I can do entry exit because there's a vibrant exchange. So I would say liquidity is the second criteria.
Okay.
Because people will say, I'm very happy with fixed deposit because I'm assured a rate of interest. Bonds cannot assure you a rate of interest, right? Because they cannot guarantee you capital. So what is the next best thing that they can assure you? Liquidity. So I think work on the liquidity. I think globally we have market makers as a concept. So you bring in market makers, give them a skin in the game. So I think there's lots to be done on that level between the regulator, between the platform, between the investor. Here it takes three to tango. So I think it's important. And I'd say that whatever we are doing right now is not bad. I mean, 5 years back, I mean, could your father or my mother have invested 10,000 rupees in bonds? Never. Koi unko patta nahi deta tha. So, you know, and they were like the aspiring actors, as I would call it. And now here they have stardom, so why not?
And with the way the things have been changing and perhaps would move even better from here on, how would you look at the Indian bond markets, let's say, in the next 5 years?
See, today, if you see as a percentage of GDP, and that is an aspiration or a metric for growth, even if you look like, look at countries like US or China, the corporate bond market as a percentage of GDP is north of 30, 40, 50%. We are still in like mid-teens or late teens. So I think the more and more this market expands, and I think retail is that moolah. Retail is that, I would say, the propeller to the engine, which can allow this segment to grow further. Of course, I'm not undermining the power of the institutional investor, which always has been the backbone. To expect FPIs to come very soon and meaningfully might be a little bit of, expecting every Bollywood movie in its sequel to give a repetitive hit. So I think we need to be realistic about it. But I think the retail tsunami, the way we have propelled over $5 billion into equity markets, why can't we create that revolutionary moment for the bond markets?
CNBC TV 18 and India Bonds present Bond Street.
Welcome back. I caught up with the Bayer CEO who's betting on India to be the top market for the company come 2030. The German life sciences conglomerate is backing that ambition with investments planned across their 3 segments in India. Take a look at what Bill Anderson, who's the CEO of Bayer, had to say.
But we want India to be a top country for us by 2030, not 2047. And so that's why we're investing. We're investing in technology here in Bangalore, but we're investing in manufacturing, R&D, commercial operations, and we're investing in our customers. We're actually not investing more in one than another. We're going in all of them. And in pharmaceuticals, for example, you may know this, when people are exposed to intense heat, they are more vulnerable to cardiovascular distress and to kidney disease. And so we have a therapy that's in India today. It's expanding rapidly, and we've now brought new clinical data in heart failure, so we're investing there. And so whether it's consumer health, pharmaceuticals, or crop science, a lot of potential, but a lot of work to do.
Every recovery now on the index continues to get sold into, and we saw the index move towards that 23,400 mark just a few minutes ago, and now again it started to cool off from those levels. So if you are an optimist, you would say, oh well, we were down 320 points an hour ago, we are now down 260, so there is still a 60-point recovery. But we'll see how the last second half of the final trading day of the week turns out. Take your leave on this edition of Trading Hour. From Ritu Mangalam and me, thank you for watching. Halftime report on the other side.
Stocks get battered as the war in West Asia rages on, causing supply disruptions across sectors and pushing crude oil prices to above $100 per barrel. Metals and industrials are the biggest losers, even as FMCG and utilities eke out gains.
PG Electroplast says 2 of its units were shut down due to shortage of gas. Borosil warns of a complete shutdown of its units if gas supply dips. Balaji Mines reports some plants have shut operations. The list goes on.
National Stock Exchange has appointed 20 investment bankers for its much-awaited IPO, which sources say could value the premier stock exchange in the country at over 5 lakh crore rupees.
The rupee is down a further 0.2%, taking the dollar-rupee rate to a new high of over 92.40. The RBI is believed to be selling dollars to slow the fall, but all Asian currencies are lower today as they respond to a surging dollar index and commodity prices.
Petroleum Minister Hardeep Puri declares that 20% of the average monthly requirement of restaurants and eateries will be allocated by oil marketing companies. The decision follows several representations on the matter.
Hello, good afternoon. You've tuned into Halftime Report, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Sonal Putra. Sonal, good afternoon to you. Today is Friday the 13th. Not that much of a freak show coming in for the markets, but still, again, a day of red. And we spoke about this at 10:30 as well, that, you know, the West Asia tensions that continue for the Indian markets and markets across the globe as well. As of now, Nifty has seen a slight bit of a recovery from that low of the day. So watch out for that one as well. 23,340 is what the Nifty as of now trades at. So again, it came up and again, we're seeing a bit of a downtick. So we'll watch out for where it's going to be going on in the trading session. The second half of the trading session as well will be key in terms of levels. FMCG, let's pull that up, right? Because that's the only bright spot today in the trading session. Seems like it picked up a bit more of a momentum from the day's lowest point. And now it's 0.5% of gain is what FMCG is holding on to. So that will be interesting to watch out for. Tata Consumers, HUL, Britannia, all of them managing to hold on to some bit of a gain as well, Sonal.
Okay, yes. So that's what the markets are looking like. FMCG stocks have come off from the highs. Nifty Bank, the mid-cap index and the Nifty Bank down 1,000 points as we speak. And a couple of these stocks which are at the day's low, something like an Axis Bank. You do have Eicher Motors as well, which is at the day's low. ITC, Maruti Suzuki, Wipro, Bajaj Finserv. Some big names which are leading to the losses from the highs of the day. So we'll keep tracking those moves for you. But let's talk to you about what do we have on the show today. We put the spotlight on big movers in trade today. And in our movers and shakers segment, we put the center stage on auto sector, talk about Lupin and Zydus as well. We'll also connect with Parthiv Jhonsa of Anand Rathi Institutional Equities to talk about the underperformance that we are seeing in the metal index and the correction is overdone. Vinny will then talk about major portfolio changes which are made by Kotak Institutional Equities, and we'll talk about the market moves as well.
Okay, let's move on to our first segment then, and the top movers and shakers of the day today. Let's go across to Vivek, who's here to take us through that list of the stocks that are moving around. Good afternoon, Vivek.
Well, thank you so much for that. Another session where you're seeing a significant downtick, especially with names that have exposure either to West Asia or are dependent on the supply chain as far as West Asia is concerned. But a few stocks or a few sectors, on the other hand, doing quite well too. Now, the first on the list, of course, has to be the entire FMCG pack. So that particular set of stocks doing quite well. Names like HUL, Tata Consumer, Britannia doing very well in the session. The other set of stocks that are doing quite well is actually Muthoot Finance. Gold Financials today have doing quite well, and Jam Capital today went ahead and upgraded.
All right, we'll come back to you for more stocks. I'm sure you have a long list, Vivek, so we'll hear about that in just a bit. But before we do that, let's talk about the impact on auto space, because remember, auto index has been one of the big laggards in markets in last couple of trading sessions. So Darshan is joining us now to tell us what is the impact of this gas supply squeeze on the sector. So Darshan.
Auto sector has been one of the most impacted industries amongst all the sectors, and in the last 1 week, Nifty Auto has been reflecting this. The index is down almost 10%, and the biggest weekly fall we can see in the last 6 years. So today, two brokerages have come out with a note on the gas supply issue and this impacting the auto industry. First one is JP Morgan. It says ongoing geopolitical conflict and rising commodity prices are creating dual risk for the industry. First one is it might impact the production. Second, increasing input cost may impact the margin also. Also, it has mentioned few challenges. First, gas, whether it's LNG or LPG shortages, could lead to production shutdowns or disruptions for majority of the companies. Second, potential disruptions to CNG availability may change the preference for CNG cars or CNG bikes also. Third, higher fuel and commodity cost could hurt margin for the industry. Fourth, global shipping disruptions could impact the exports. Some of the companies have huge export exposure, like Maruti. Amongst two-wheelers, Bajaj has almost 50% exposure to export. For TVS Motor, it's in the range of 30 to 40%. And fifth is weakening consumer sentiment could hurt the recovery that we have seen post-GST rate cut. After GST rate cut, there was a sharp increase in the volumes, and that has been maintained till the month of February this year. That might hurt the sentiment if this gas supply issue lingers further. Nomura believes that it has analyzed the energy usage, and that indicates that usage of gas is huge amongst majority of the companies, and in the short term, it won't be feasible for the industry to shift to another source of energy. Where exactly it's being used? First, paint shops, which usually operate at full capacity, and second, furnaces for forging, casting and heat treatment process. Which all companies may be impacted the most? Amongst auto companies, amongst four-wheelers, Maruti, amongst two-wheelers, TVS Motor and Bajaj Auto can be impacted the most as per Nomura, and amongst auto ancillary companies, Bharat Forge, Uno Minda, even Balkrishna Industries and Apollo Tires. So we'll have to see how exactly the industry faces this issue. But as of now, I have talked to like few companies, production is normal, but the impact can be seen only after a week or two.
Oh, yes, and you've been speaking to a lot of companies as well, so we'll keep a track on that one. Sudarshan, thank you so much for joining us with all those details. Let's get back to Vivek. There's some update on Lupin and Zydus Life Sciences as well. Vivek, what are you picking up?
Well, that's right. So the pharma pack will remain in focus. Some positive news flow, or you could say implied positive news flow, especially as far as Lupin as well as Zydus Life is concerned. So what's actually transpired is that a Delaware federal court has upheld the validity of Astellas Pharma's patents on Mybetru, or better known as Mirabegron. Remember, Mirabegron is a large drug and important both from the point of view of Lupin as well as Zydus. It's one of the largest drugs in their portfolio, and a lot of FY27 earnings analyst estimate will come in from this particular drug. So what is the incremental update that's come about? The court has gone ahead and blocked another pharma company, which is known as Ascent Pharmaceuticals, from launching its generic version. The court says that the ruling would block Ascent's proposed generic till the patent expiry in 2030. Now, the decision actually benefits both of the generic manufacturers that have, number one, launched their generics, have already made windfall gains, and also have gone ahead and settled with the innovator. Remember, both Lupin as well as Zydus settled with the innovator last month, which is Astellas. So positive read across for Lupin as well as Zydus on the back of the Delaware High Court decision.
Okay, thank you so much for that, Vivek. But on that note, we're going to slip into a very short break. We'll come back with more on the other side. Stay tuned.
Welcome back. You're still tuned in Halftime Report. The markets are generally lower, but Nifty Metals Index is down 5% this week, and currently it's down 4.2%. Hormuz is here to tell us what's ailing metal stocks as we speak. Hormuz.
Losing some luster today are metal stocks, and as you mentioned, the metals index is the worst performing sectoral index this time around in today's session, down 5% this week, and most of the constituents on the index are also trading with losses on a weekly basis. You take a look at APL Apollo and Hindustan Copper, both are down 10%. You take a look at JSW Steel, Tata Steel, SAIL, all of them have declined anywhere between 5.5% to 7% as well this week. Now, the fact is that the metals index has done fairly okay so far until this week, because in the month of January the index was up 6%, in the month of February as well the index was up 4.5%, and courtesy of the fall that it has had this week, the index is down 7% for the month of March so far in the first half of the month. Now, the first major negative for metal stocks this time around has been the strengthening of the US dollar. The US dollar index is now back towards the levels of 100, and a stronger dollar is generally negative for metal stocks because it becomes unattractive for international buyers to buy the metals in the market. And the bond yields as well, because of the crisis in West Asia, bond yields across the globe have risen, be it in the US, be it in India, be it in other global markets as well, Japan and so on. That's another negative, and because of this war also iron ore shipments are getting disrupted according to reports as we speak currently. Now, but it's not as if the metals globally have done poorly or so on. It's because of this West Asia crisis that aluminum prices have risen to their highest level in 4 years. Analysts are expecting even further the levels of even $3,700 a ton going forward in the near term. HRC steel prices are at their highest level since January of 24. Iron ore prices are at their highest level in 2 months as well. So globally the prices are stable or even going higher currently. Now, we did speak to the steel secretary yesterday, and he did tell us that the steel sector is impacted by the ongoing situation. Although there is right now, SAIL has 20 to 25 days of propane supply. So far, there has been no disruption, but a prolonged issue could create supply side challenges, and they may have to calibrate production if this issue goes on for longer. Although the recent times, the bullish run that the metal stocks have had in January and February, the analyst community remains fairly bullish on them as well. Axis Securities, in an interaction with us last month, mentioned that they prefer ferrous over non-ferrous names. Macquarie added JSW Steel as a marquee buy idea last month. BofA Securities had upgraded Vedanta and they raised their target to 840 rupees from 480, and Nomura too had initiated coverage on Lloyd's Metals for a target of 1600. So globally metal prices are fairly okay. It is only because of the strengthening dollar and the bond yields, and you're seeing some profit booking right now. We'll see as the situation unfolds whether the metals are able to maintain their sheen at the start of the year.
Absolutely, Hormaz. Thank you so much for that. Will be key to note of that, whether they will maintain their sheen going forward. But let's also bring on board Parthiv Jonsa, who is the Vice President at Anand Rathi Institutional Equities now, joining us to talk to us about the metals pack. What is he expecting here as well? Parthiv, good afternoon. Thank you so much for joining us on the show. Overall, since we've seen the war start, month-to-date basis, metal pack overall has seen a decline of 7%. Let's start by talking about what are the key concerns now that you see. You heard some commentary that Hormaz mentioned that came in from the SEAL secretary as well. So what is the take from here on? Because apart from LPG, there are other shortages that come in as a concern as well.
Correct. So thanks for having me. Good afternoon to you and the entire team. Now let us just break this entire current macro scenario into multiple smaller pockets, right? Now, number one, yesterday, when the steel secretary sir was there on the TV, he mentioned that we have about 20-25 days of propane as far as the steel authority is concerned. Ideally, what happens, your raw material for each and every firm, whether it be coal, propane, XYZ, it's always in the range of 30 to 45 days. That's the ideal understanding, okay? So I don't think so there is any major hiccup in the very near term, that is in this particular quarter. If the war continues, the major issue would be from Q1 onwards. That's number one. However, what has happened now, we need to look at the other part, right? With gas issues pertaining globally, what would be the impact? The impact would be that your production cost or the gas availability will go down, your production cost will increase, and because gas is used especially for reheating and all those processes. Though as a percentage of the top line, your fuel and power is maybe in the range of 5 to 7% for the primary steel producers. it will still impact the margin. Because if you see the Bloomberg-driven data in the recent weeks, your gas prices has gone up by $20 odd last week to week, right? So that, sorry, 20 euros, right? So that will basically impact in the near term. That's number one. Number two, if you see our exports, though it has gone up year on year up to the month of Jan-Feb, however, the quota system in Europe for Indian exporters has completely done with. We are already reached 100% much before the March month end, right? So there will be slight impact as far as exports to Europe is concerned in such a scenario, right? Now, as far as your China is concerned, China, though 8% exports are down, but what is also happening, their exports are down because of their limitation or their, their requirement or licensing to export. However, if these things persist, going forward, if the production in India gets hampered, if there is a gas issue, there are good chances that the exports from China to India can increase. Because what is happening today, we as a percent, your steel as a discount to Chinese landed price is about good 6 to 8%. We are still at a discount. However, when you compare with the other FTA countries, we are almost on par with them. Especially with Vietnam also, especially with Huafa, we are on par. Other Vietnamese players are still at a quite discount. So there are good chances of all these smaller inputs coming into the country. And as far as the production in India is concerned, if import of coking coal and gas and so on and so forth has some limitation, there is a good chance that the production can come down. However, there is a silver lining that we do have some inventory being built up all these months, which will help us basically do cater in the near term. So let us wait for another week or two to get an exact understanding what will be the impact of this entire thing around the Middle East.
Okay, got it. Of course, it's a developing situation, but thank you for explaining the industry dynamics so well, Parthiv. Just a few clarifications on that one as well. You said gas prices have gone up, of course, by 20 euros, and that's one of the key inputs as well for processing steel, some other processes around manufacturing of steel. Is there any other shipment issues that the industry is facing right now? Yes, there is a 25-day stocking for propane available for sale. Is there anything else that they import which could be under threat because of these West Asian tensions?
Sure. Let me just rectify this. Gas and propane is not a major chunk. Power and fuel as put together is 5 to 7% of the top line, right? So compared to coal and iron ore, it's still relatively smaller as a basket, right? Now coming to the other aspect, whether as a country we import coking coal, number one. Number two, we import thermal. So thermal coal, what data I have, up to February, we have done about 119 million tons of import, though it's down year on year, but still we do import thermal coal. As far as coking coal, most of the players in the market, whether it be the top tier 1 mills or the tier 2 mills, they do import coking coal from global geographies. Now with the shipping rate going up, that definitely will impact your inward coking coal which is coming into the country. Right? Because the shipping rates have gone up. We import coking coal from multiple geographies, though you do not have disruption pertaining to the navigation of the ships, but definitely your logistics cost goes up to a great extent. If you see China also, they have started moving their thermal coal procurement. They have moved away from Australia right now, and they have actually gone to Mongolia. Why? Just to save on the logistics cost at the end of the day.
Parthiv, then, in a current scenario, what are you looking at? Ferrous, non-ferrous, in the middle spec? Is there anything you're looking at, or maybe you're just waiting on the sidelines?
No, I think right now one should focus more on the company-specific, story-specific. This is more on the broader market. There are a lot of moving parts, actually. So let me just give you perspective. Amongst, say, ferrous space or amongst the tier 1 mills, we are still very positive on companies like JSW, JSPL. Purely because JSPL also has its own integrated thermal and coking to an extent, they have with their own mines. That is number one. And number two, we are also positive on companies like, say, Jindal Stainless and Indian Metal Ferroalloy, which is basically a raw material provider to stainless steel companies, right? Because all these are very strong story growth journeys, basically, going forward. Then there are companies like Lloyd's Metal, which has now diversified beyond iron ore. It has now moved to pellet, has an MDO business in their kitty. So all these are very high growth trajectory stocks at the end of the day. You might have a profit booking, you might have, due to dollar index movement and all, you might have a near-term headwinds, but over a long term, you are very positive. Again, we are very positive on copper super cycle.
All right, take that point.
Aluminium has gone up, but copper is still a play to do.
Take that point, Parthiv. Thank you so much for joining us today with your thoughts on what's happening with the metals pack, a big underperformer. So there is some expert advice coming in. Let's slip into a short break. Up next, we'll get in Vinny on the big wall to focus on major portfolio changes which are made by Kotak Institutional Equities and Jefferies as well. Welcome back. You're still tuned into Halftime Report. Well, brokerage firms, Kotak Institutional Equities, Jefferies, they've made changes to their model portfolio. Winnie is here with more details on this. Winnie.
Hi, absolutely. Given this scenario that we're seeing going across, there are a lot of changes that have come in. Now, first, let's talk about Kotak Institutional Equities. Sanjeev Prasad says that the conflict in West Asia is actually throwing up a buying opportunity, but it's coming with a caveat. Now, he is using this moment to add what he calls better stocks and move out of what he describes as narrative stocks. Essentially, what he's saying is separating the fundamentals from which are your hype stocks. Now, specifically, let's talk about sectors that he's looking at. He sees that this is a chance to reduce positions in expensive names like something in the cement space or consumer stocks. What also is coming as a recommendation in terms of their model portfolio is they're making 3 moves. Indices Bank is being removed, and that weight is being redistributed into Bajaj Finance and Eternal. That the case for upside that they're highlighting for Bajaj Finance or even Eternal is one. For addition of Bajaj Finance, what they're highlighting is that a 12-month fair value of rupees 2,500 is what they've given for it. That's a potential upside of 41%. For Eternal, the fair value what they're assigning is 375, which is even more a compelling bet because that's now a 70% upside from the current side as well. Important to note that both these stocks have also corrected roughly 10 to 11% since the Iran and US-Iran as well as Israel conflict that started and that had begun on 27th of February, which is precisely why Kotak is looking at these names as well. Now, let's switch gears and talk about what's the word coming in from Jefferies, Mahesh Nandurkar and his team. They've actually done a bottom-up approach for their stock universe, which is around 247 stocks that they're covering. Out of that, they have 23 buys and 8 underperforms. Let's look at what are they and what is putting more conviction on which stocks and which are they removing. Now, on the buy side, Jefferies is adding fresh names. The new names that are added is SBI, Star Health, Grow, Bharat Forge, JSW Steel, Eternal, as well as Max Healthcare. So, covering different sectors, financials, healthcare, industrials, as well as consumers and internet side as well. Now, on the other side, Jefferies is initiating an underperform call on some of these names. The 3 names that are coming in here is Hyundai, Cipla, as well as Wipro. And finally, a couple of upgrades that's coming from Jefferies in is existing underperform list is actually Delivery and being upgraded to a buy. Well, we have Laurus Labs also. That's now moving to a hold. So that's the upgrade that's coming from there as well. So 2 important changes from 2 houses that have come in, Kotak as well as Jefferies, in terms of their model portfolio.
Take that point. Thank you so much for bringing us all those details, Vinny. Some interesting names in the list there. By the way, the Nifty has slipped below the 23,300 mark. The low for today is at 23,266. FMCG stocks are the ones which are leading to this fall from the highs of the day. So that is an important level which is broken now, and it's a swift cut from the highs of the day. At the day's low, we have L&T, there is Axis Bank, Bajaj Finserv, Kotak Mahindra Bank. So the bank Nifty is down 1240 points as we speak. At the day's low, the mid-caps have also added to those losses. It is down 2.2%. So across the board, there is some selling pressure which has come by. So we'll keep tracking that for you because this selling has seen some further action in the last couple of minutes. Time for a break now. Jay Thakkar of ICICI Securities will join in with some trading strategies on the other side. Stay tuned for that.
Welcome back to Halftime Report on CNBC TV 18. Looking at the Nifty 23,200, around that mark, what the Nifty trades at, just slightly above that. At the day's lowest point is what the Nifty is trading at. So important to get a check in terms of what's happening in the world of F&O. Let's go across to Mangalam, who's at the F&O desk for us. Mangalam, afternoon.
Forwards, hot knife through butter. That's exactly what's taking place in the market right now. You know, levels aren't being respected. When we started the day today, we thought that maybe 23,500 would be an important mark to track. 23,500, 400, 300, and now 200 is also not sacrosanct. And that's the kind of market that we've been in. And a large part of that has come by from the Nifty Bank, which has been underperforming, lost over 2,000 points in this very week itself. At the start of the week, we were wondering whether it'll hold on to 56,000 or not. And now we're wondering whether it's, going to reclaim 54,000 or not as well. And the broader market has it even worse right now as we speak, over 2% shed off the mid-cap index too. When all of this happens, the only thing that rises is the India VIX, and that's exactly that has taken place. So far, it was fairly moderate. Now, with the market sell-off accelerating, the India VIX too has moved to the high point of trade. So the intraday chart of the India VIX would tell you a better story of the day. But even now, if you look at it, it's up around 4%. The Nifty Bank is broken below that 54,000 mark. So now the next important technical level would be 53,500 as per the experts who joined us on our channel this morning. So that's another mark that we will be tracking. What's also at the widest distance apart is the mid-cap, advanced decline ratio. So if you look at the number of stocks which are advancing versus the number of stocks that were declining, yesterday, at least for most part of the day, we had those lines jostling or fighting with each other to look at, a higher number of stocks advancing from the time when we opened trade. But today, from the time we opened trade to now, the number of stocks which are declining has increased, whereas the number of stocks which are advancing has come wider apart as well. And a large part of this decline is also a lot of fear-led selling. So all those who had thought that maybe important levels of the market would be held around 23,600, 23,500, all those put writers have now been caught on the wrong side and they are now unwinding their positions. So that is causing an accelerated sell-off, and as a result of which, now because of this fear, not a lot of put writing is visible in the market. So most part of the market is on the short side. 23,600 put, as you can see, the red line on the chart tells you that those number of options have been unwound. 23,500 put as well. There have been short covering in those puts, and as a result of that, we've also seen some writing in the calls. So that's telling you that not only is the market's bottom, coming off, the top is also coming lower, and the range is coming lower. So 23,500 call, 23,400 call, all of them are seeing writing. At what point does it get overdone? Well, the put-call ratio is currently at 0.75. Typically, between 0.65 to 0.7 is where we see the put-call ratio bottoming out and the market being oversold. But right now, in the geopolitical uncertainty that we are in, even these oversold conditions, the market can stay in those levels for a very long time. Remember, any sort of de-escalation or any news on the other side, which is positive for the bulls, could lead to a sharp rally. And that's largely because of the positioning of the market right now. But that's just hope, not a data point yet.
That's so true. That's just hope. We don't know what will happen next. And on the back of that uncertainty, we are seeing markets trending towards the day's low. It's a 420-point cut on the Nifty as we speak, very close to breaking the 23,200 mark as well. Thank you so much, Mangalam, for joining in with the F&O setup. Let's also get a chart check now. Jay Thakkar, head derivative and quant research at ICICI Securities, is joining us now. Jay, very close to breaking the 23,200 mark. Do you think even we could see a further decline from those levels the way markets are moving?
Good afternoon to you, Sonal. Well, I would, extend it from what, Mangalam was just mentioning about the, India VIX or the volatility index, which is at currently the levels of 22, 22.4. We had recently seen it going up to 24.5, Sonal. And I think that around the levels of 25, 26 is where the max, the volatility should expand if at all, it's going or inching higher from these levels, because it's been almost 7 to 8 trading sessions that we are seeing this volatility indicator trading at its extreme. And generally, we have seen that not more than 9 to 10 trading sessions is where it takes to peak out, at least for the short term and the near term. So I think that if you ask me, as far as Nifty levels are concerned, gauging it from the volatility, then I think 23,000 should be the immediate support. And for this weekly expiry, I mean, that should be the last one, 23,000 to 22,800. So if at all there is further decline of around 200 points odd, the index would go into extreme, oversold territory, and from there on, you can see at least a sharp bounce back and a sharp correction in the VIX. But at least until the expiry, I think, this can extend until 23,000 to 22,800. And one more thing which I would like to highlight, Sonal, is that in this entire war situation, we have seen the volatility index, in fact, inching higher on the Fridays. Generally, one might sense or one might want to hedge their positions ahead of the weekend. So that, hence because of which we are seeing the a put call ratio on the monthly series is still above 1. And it's still not oversold, I would say. So if at all there is a fall till 23,000, I mean, that should be a good level to actually enter on the long side, as the risk reward would favor thereafter on the long side. The breadth of the market is also very weak. I mean, we just have 14, 15 stocks on the long side as far as F&O is concerned. And it has been one of the weakest, I would say, in this entire fall which we have seen. So things are oversold. It's just that the risk reward will improve around 23,000 levels.
Okay, as of now, 23,200, it's broken that, and now it's below that as well, what the Nifty trades at. But Jay, what are you looking at in terms of individual names?
Well, see, recently we have seen the power stocks, in fact, doing quite well. They have shown good resilience. In the near term, and I think NHPC among that looks quite clear that we have seen a good short covering happening there in NHPC. There's a good chance of stock, bouncing back from the current levels till the levels of 80 to 82. As a disclaimer, I would say that we already have recommended this to our clients. So we have a bull call spread recommended, bullish strategy out here. I think on the downside, it has formed a good base around the levels of 73 to 72. Hence, the risk reward is favorable on the long side, and the overall momentum is also quite in favor of the bulls out here in the power sector. Among the other stocks, I would say Pharma and FMCG, these two sectors have also relatively outperformed, at least today. So I think that Britannia among that seems to be a good buy, is at a good level to buy from these levels, because I think on the upside one can see 4 to 5% at least from these levels. 6,100 to 6,200 is one can target on Britannia, placing a stop loss below 5,700. Recently, in last 1 quarter or so, Vinny, what we have seen is this stock trading within this band of 6,200 to 5,700. Since it has arrived at the lower end of the range, the risk reward again favors on the long side, and these two both are acting as a defensive stocks in this kind of a market scenario. So if someone really wants to hide or be on the long side, I think sectors like FMCG, pharma, power, one should keep an eye on these sectors.
That point, Jay, thank you so much for joining us today with your thoughts. So that's the technical update on the markets. We have come back above the 23,200 mark, but important to note, we have broken those important levels. Some stocks in the broader markets which are seeing sharp cuts. CEAT, for instance, is down 8.5% as we speak. Sapphire is the other one, which is down 7.5%. The mid-cap index is at the day's low. MRPL, despite refining margins going higher and it being a standalone refiner, there is a sharp cut on that stock as well. 6.5% gone here. There is Rain Industries, the other name, which is down 5.8%. But there are some green shoots in the market. Zydus Wellness, for instance, is up around 11%. Confidence Petroleum is the other stock, which is up around 6%. Acme Solar is the stock which is higher in trade as we speak. We'll keep tracking market moves for you, but as we slip into a short break, here is a quick reminder for our viewers. CNBC TV 18's India Business Leader Awards will be held tomorrow. Tune in as we honor the ICC Men's T20 World Cup champions. Catch our coverage 4 p.m. onwards.
Welcome back to Halftime Report on CNBC TV 18. While markets 23,200 again back above that level, like we said. But let's shift focus. And India today is not among Bayer's top markets, but it is certainly our intention that it will be. That's the word coming in from Bayer CEO Bill Anderson. My colleague Ritu Singh caught up with him and spoke to him on the Indian markets, artificial intelligence. Listen in to a slice of that conversation.
Growth we've seen in recent years has been tremendous. I mean, we're here today in Bangalore because we're opening an innovation hub. And this innovation hub, it's not back office.
Yeah.
And it's not just for India, although we are supporting our rapidly expanding Indian operations from this hub. The work we're doing here is supporting the 88,000 people we have around the world. And I've seen some amazing results here, whether it's we're one of the largest providers of imaging solutions. So we've got imaging R&D here in this building. We've got people working on novel applications for pharmaceutical R&D, for crop science, genetics, all here in Bangalore. So I think we're just going to see a lot more of that in the years ahead.
Let me ask you how critical, the market is for you. As we speak, I mean, is it in your top 5 markets? What's the pecking order? What's your outlook on the kind of growth potential you see here? You've been here for 130 years. You have 13,000 employees. Crop science is the largest business. But what next? What's the growth engine?
Yeah, I would say today, India is not in the top markets today.
Yeah.
But it's certainly our every intention that it will be. And I'm not talking about by the way, 2047, those goals, I'm amazed, and I believe India can do this. I've seen, the progress you've made. I think this can be reality, but we want India to be a top country for us by 2030.
Okay.
Not 2047.
Okay.
And so that's why we're investing. We're investing in technology here in Bangalore, but we're investing in manufacturing, R&D, commercial operations, and we're investing in our customers.
Yeah, well, to get to, having India as one of your top markets by 2030, where are some of these investments across your divisions, if I were to ask you?
Sure.
Consumer health is one of the more younger businesses here, perhaps. Is that growing faster than the others, or what will get you to the top market by 2030?
They're actually growing at similar levels, and we think they're all capable of faster growth. So I want to answer your question, but the honest answer is we're investing in all 3 divisions. We're actually not investing more in one than another. We're going in all of them.
Okay.
And in pharmaceuticals, for example, you may know this, when people are exposed to intense heat, they are more vulnerable to cardiovascular distress and to kidney disease. And so we have a therapy that's in India today. It's expanding rapidly, and we've now brought new clinical data in heart failure, so we're investing there. And so whether it's consumer health, pharmaceuticals, or crop science, a lot of potential, but
Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty, yes, it's 23,230 is what the Nifty is at. 400 points down for the day in the trading session. Nifty FMCG, I would like to pull that chart up as well. Just holding on to a mild bit of a green right now. Almost in the red mark is what we're seeing. Just a few points between the red and the green. So let's keep an eye out on that because that was the only one which was managing to hold on to gains. So that has come off significantly from the day's highest point as well. Banks continues to be under pressure. IT continues to be under pressure as well. But with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next to Business Touch.
Stocks get battered as the war in West Asia rages on, causing supply disruptions across sectors and pushing crude oil prices to above $100 per barrel. Metals and industrials are the biggest losers, even as FMCG and utilities eke out some gains.
PG Electroplast says 2 of its units were shut due to shortage of gas. Borosil warns of a complete shutdown if gas supply dips. Balaji Amines reports some plants have shut operations. The list goes on.
National Stock Exchange has appointed 20 investment bankers for its much-awaited IPO, which sources say could value the premier stock exchange in the country at over 5 lakh crore rupees.
The rupee is down a further 0.2%, taking the dollar-rupee rate to a new low of over 92.40. The RBI is believed to be selling dollars to slow down the fall, but all Asian currencies are lower today as they respond to the surging dollar index and rising commodity prices.
Petroleum Minister Hardeep Puri declares that 20% of the average monthly requirement of restaurants and eateries will be allocated by oil marketing companies. The decision follows several representatives on the matter.
Good afternoon.
Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan, and with me as always is Harmas Patakia. Good afternoon, Harmas. Good afternoon, guys. I mean, the sell-off just deepening in the markets, right? There's no place to hide. Weak global cues, Brent above $100 a barrel. I mean, it's quite a bad day for the markets today.
With the eagerness to say good afternoon maybe would have been to get rid of the day as quickly as possible. But that's been the story of the market, not just today, but all through this week. Now, 20 lakh crore worth of BSE listed companies' market cap has been wiped out so far. And we still have a good 2.5 hours worth of trade still to go. Of course, this is something similar that played out last Friday as well, because traders wanted to go into the weekend light on positions. They do not want to go in heavy because you just do not know what happens over the weekend in terms of the turn of events. But the Nifty right now, 23,193, the intraday low that the index has made. So from there is a 40-point up move. So as of now, still a 400-point cut on the index. We are down almost 5% now for the week. And it also shows that this is turning out to be the worst week for the index since at least June of 2022. That's the kind of sell-off that you've seen. Look at the Nifty Bank as well. The Nifty Bank has been the principal culprit of why the Nifty has been down this week. As of now, and when we checked at the start of trading hour at 11 o'clock, the index was down 6% for the week. That loss would have definitely been extended now that the index is down almost 1,200 points, nearing the lows of the day. Now it's given up also on the 54,000 mark. So it's red across the screen. The broader markets are not faring any better. And same goes for most of the sectoral indices as well.
Absolutely. There's no place to hide, right? If you take a look at the auto pack, that's continuing to languish. We've got M&M, Eicher Motors, Maruti Suzuki, all of them down anywhere between 2 and 4% as we speak. The banks, as Harmas pointed out, are feeling the pressure. The big banks, HDFC Bank, Kotak Mahindra Bank, Axis Bank, all of them down between 1 and 3% in trade today. Metals, that's the index that's losing the most in trade today. It's 4% lower. Hindalco, Tata Steel, Vedanta, all of them down over 4% in trade. Hindalco down over 5% today. You know, the only outlier at the start of trade was the FMCG pack, but that's in the red as well as we speak. But if you look at any of there are 2 top Nifty gainers, and out of those, we've got HUL that's on top, 1% in the green, Britannia about 0.5% in the green, and Marico about 0.5% up. So those are the only few stocks doing well today. But you know, the other key factor that we're looking at is the rupee, which has hit yet another fresh low, with the dollar now costing 92.40 rupees, even as oil hovers around the $100 per barrel mark. Lata Venkatesh is here with a chatter in the forex market. Lata?
Today, it's a pan-Asian fall, as it has been for several days in the past. It's about a 0.25% fall you're seeing in practically every Asian emerging market currency. I mean, you can take ringgit, Filipino peso, Thai baht. All of them are showing a similar ranged fall. And that's because there are 200s doing the rounds. Crude is at 100 and dollar index is at 100. I mean, it is 99.8. I mean, not so long ago before the war, it was 96 decimal point and something. But now both crude and dollar at 100 is creating a psychological impact on people wanting to go ahead and buy dollars. So the dollar demand in India itself is from the usual suspects. I'm not giving you any new information on that. It's foreign investors, it's importers, all of whom just have to, those who are rushing out after selling stocks, and those who have to buy imports for raw materials. After all, March is a month to the finish for manufacturing sector, and therefore importer demand is also there. The real price of the dollar is not 92.40, but much more. All central banks and RBI spearheading it are generously selling dollars in the hope that this is a short-lived war and they should curb volatility. So, but if the Reserve Bank were not there, we would be staring at a much higher number. However, they've been offering generously. The chatter in the market is that in the past several days, they may be even averaging a sale of $5 billion, not entirely from in the spot market. It could be forward positions as well. So 1 month ago, forward positions also matured today from the NDF market. That also creates a demand for dollars. So there is enough demand, and the supply, therefore, from the Reserve Bank continues. The economists' worry now is we are entering the third week of the war once we get into the weekend. That will mean now you have to start rethinking that this is not a very short war. Their assessment of next year's macros, whether it is GDP or inflation or current account deficit or rupee, was based on crude at $65. But now with the port congestion, and even if the war were to end, the amount of time it will take to restart refineries, restart normal shipping, makes everyone believe that an assumption of $80 next year or $90 is not out of the realm of reality. It is not a stretch. And therefore, the worry is that current account deficit, which everyone thought will be under 1%, is likely to be over 1%, I mean, close to 2% next year. And to find that much of capital flows to bridge that current account deficit gap will be an ask. Capital flows have been negative all of this year. And therefore, will we be able to fill it is a very, very big question. So there are worries on current account deficit, worries on balance of payments, worries on the rupee.
Lata, thank you for that update there. And confusion and disruption continues over the supply of gas as well for domestic and commercial needs. People across the country are lining up for cylinder refills as fears of scarcity have grown. The Petroleum Minister Hardeep Singh Puri has assured that there is no cause for fear over the supply of gas, especially to domestic consumers. The minister also said that the centre would ensure that eateries and restaurants also get 20% of their average monthly consumption of LPG. Listen in to his comments.
Three-member committee comprising executive directors from IOCL, HPCL and BPCL was constituted on 9th March 2026. Extensive meetings have been held and state civil supply departments and restaurants associations across the country and are continuing. The committee has assessed genuine need by geography and sector to ensure available commercial volumes reach commercial LPG requirement is going to be supplied from today by OMCs in coordination with the state government so that there is no hoarding or black marketing.
PG Electroplast slumps as the management tells CNBC TV 18 that the gas shortage has already resulted in a loss of a week's worth of production and may impact revenue guidance. Let's listen in.
Out of 4 plants for manufacturing of air conditioners, last week there was a disruption of 3 to 4 days. This week there has been already a disruption of 2 to 3 days. So if you look at, we have almost lost 1 week of production. So I would not be able to give you the number on that. What I can tell you that we are trying to work on how we can salvage the situation. We are working more on that instead of calculating how we are able to achieve that revenue guidance or not that. Our teams are more focused on how we can mitigate this. We are working on some alternative technologies, alternative gases. Our technical teams are working on that.
Now, as the war in West Asia intensifies, sugar prices have rallied, oil prices have surged as well. We caught up with Vivek Saragi earlier in the day of Balrampur Chini, where he stressed on alternate fuels. Listen in.
The government is not a trader. Government should not see, I buy this, I sell this. Government has put in a policy where they committed to you in no uncertain terms and gave interest subvention to set up capacity and said, please produce ethanol because we need it. The premise was blending will go up 20%. And there is another, BI standard being developed for 22 and 25. Ethanol can be used in so many other things. I'm saying India is sufficient in biomass. And this is what the bioenergy policy says. So biomass, if let's say sugarcane is biomass, maize is biomass, there's enough biomass and starch available in the country to be able to give you a plethora of chemicals. As you're aware, we're going to bioplastic.
So that's the latest on what's happening with the gas shortage concerns. But moving on, sources tell CNBC TV 18 that the National Stock Exchange of India is getting ready for its long-awaited IPO. Farquan Moharkan joins us now with all of those details. Farquan?
Well, sources tell CNBC TV18 that the world's largest derivative exchange, the National Stock Exchange of India, is eyeing a valuation of upwards of 5 lakh crore rupees as it goes for the much-awaited listing. According to the person with the direct knowledge of the matter, the exchange is mulling to dilute 4 to 5% of its equity through an offer for sale. This would make it second or the third largest IPO in India, anywhere between 20,000 crore to 25,000 crore rupees. Till now, India's largest IPO has been that of Hyundai India, worth roughly 28,000 crore rupees, while the second largest was that of LIC, worth roughly 21,000 crore. NSE's IPO has been long overdue because of the overhang of the co-location case. Earlier last year, the exchange set aside almost 1,400 crore rupees for the settlement of the scam with the markets regulator. Yet just yesterday, the exchange said that it had appointed a record 20 merchant bankers for the IPO.
Farquhan, thank you for that update. And just within 10 minutes of the show starting, the Nifty has now made a new intraday low, 23,183. That's the low on the index now for the day. The Sensex is now down 1,300 points. The Nifty Bank has also headed lower. 1,200 points now shaved off on the Nifty Bank. That low, of course, it's still around 100 points away from the lows of the day, but still a 1,200 point cut on the Nifty Bank. The broader markets are no better. The mid-cap index, the small-cap index, all of them selling off and selling off sharply. A 2.5% cut now on the mid-cap index, 1,400 points shaved off here. And the small-cap index, the mid-cap index and the small-cap index were not down as much as you thought for the week, but they too are selling off as we speak. So the market at a new low for the day. Take a short break, get to the latest updates on the rising tensions in West Asia on the other side. 23,175, the new low now for the index, 460 points lower as we speak. The currency is at a record low, and three major reasons for this recent accelerated sell-off that you have seen over the last few minutes. The first one being that the dollar index is back above 100. It was hovering around that 98, 99, 99.7, 99.8 mark for a better part of the day. Now it's back at 100. The other one is Brent. Brent is now at 102. Almost there, but it's 101.7 as we speak. So Brent is recovering from the earlier dip that it had seen in the day. The NYMEX 2 is now nearing 97, and the third being the fact that the Dow futures that were up around 250 points just an hour ago are now down around 80 to 90 points. So there has been a very sharp reversal in the Dow futures as well, and the impact is what you can see on your screens. 450 points lower now on the Nifty, 23,190. Now let's get you a wrap of the latest developments in West Asia. Iran's Supreme Leader Mustafa Khamenei released his first remarks since succeeding his slain father. He said that Iran will avenge the blood of its martyrs, keeping the Strait of Hormuz closed, and attack US bases. Meanwhile, Israeli Prime Minister Benjamin Netanyahu issued a veiled threat to kill Iran's new Supreme Leader, saying that he has added another goal to create the conditions for the Iranian people to overthrow the terribly tyrannical regime. Now, in a post on Truth Social, US President Donald Trump claims to be destroying what he calls the terrorist regime of Iran. The Iranian Air Force and the Navy, as the post reads, stands decimated. Trump says, and I quote, "They have been killing innocent people for 47 years, and now as I, the 47th President of the United States of America, am killing them," end of quote. Now, speaking to Fox News, Trump also said that the ships should go through the Strait of Hormuz. He said that there is nothing to be afraid of, as Iran has no navy and they have sunk all the Iranian ships.
And amid the escalating tensions in West Asia, U.S. Treasury Secretary Scott Bessent has said that the U.S. Navy will escort vessels through the strait once it is militarily possible. Take a look.
That was always in our planning, that there's the chance that U.S. Navy or perhaps an international coalition will be escorting oil tankers through. There are, in fact, tankers coming through now, Iranian tankers, I believe some Chinese flag tankers have come through. So we know that they have not mined the straits. Words not mine. But again, it is my belief that as soon as it is militarily possible, the U.S. Navy, and perhaps with an international coalition, will be escorting vessels through. We've been planning. We have complete control of the skies and are degrading their. They have no air force. The Navy is sunk, literally and figuratively, and the munitions factories, the rebuilding capabilities for the missiles, the completely degraded. So as soon as it is possible for to ensure safe passage, we will do it.
The United States has opened an investigation under Section 301B of the Trade Act of 1974 on 60 partner countries, which include Canada, UK, China, India, Venezuela, Russia, and South Korea.
And as we slip into a short break, here's a quick reminder for our viewers. CNBC TV 18's India Business Leader Awards will be held this Saturday. Tune in as we honor the ICC Men's T20 World Cup champions. Catch our coverage 4 p.m. onwards. Welcome back. You're still with us on Business Lunch. South Korean Trade Minister sat down with CNBC TV 18's Ashmit Tej Kumar to discuss Delhi and Seoul's partnership in the AI and digital sector, in the automotive space, in shipbuilding and other upcoming investments. Take a look.
I think, this AI digital sector, I think we are very complementary. India is really well known for, soup of these engineers, software, this capability. On the other hand, Korea is really strong in this hardware, especially the semiconductor, HBM, high kind of memory chips. So I think there's a great complementarity between our two countries. Automobile sector, we have, Hyundai, Kia, who have invested from long time ago in India. They are planning to expand their facility, production facility in India. They are number 2 in terms of export figure, as this foreign the manufacturing companies. And I think sooner or later they kind of aim to reach about 1 million production in India. So I think our supply chains are already very well intertwined and interconnected. Yes, automobile is one example, and also steel sector. I think Korean company is very interested in investing heavily in this steel sector. Another great example is the shipbuilding. The Korea is really the second largest the shipbuilders, and in fact, our recent deal with the United States, also the shipbuilding played a very critical role, because also the United States wants to rebuild their the shipyard and the shipbuilding industry. And I think Korea has a lot to offer in this shipbuilding. And I understand that also India is very keen in building the shipbuilding industry. I think Korea will be a great partner for India.
Every time we are coming back after a break, the Nifty is making new lows. Now 23,137 is the low, 500 points down on the index. Arundhati and I take your leave on this edition of Business Lunch. Midcap Radar starts off the final 2 hours of what has turned out to be a painful week for the markets.
Good afternoon. Welcome to Midcap Radar, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Starting Midcap Radar on a grim note in terms of the market moves, because market has extended losses. We are below the 23,200 mark. It's been a swift cut from the highs of the day. Midcaps are down 1,300 points, or actually 1,400 points right now. Bank Nifty not far behind, sitting with a cut of 1,200 points.
That's right. Good afternoon, Sonal. And very, very weak set of cues is what we are working with as we start Mid-Cap Radar. Overall markets have weakened quite significantly. Mid-Cap, Small-Cap Index down both over 2% each. But a lot lined up on the show, so let's start off with the top headlines. Markets lift to the day's lowest point, with the mid-caps taking a big beating. Stocks get battered as the war in West Asia rages on, causing supply disruptions across sectors and pushing crude oil prices to above $100 per barrel. Metals and industrials are the biggest losers, even as FMCG and utilities eke out gains.
Impact of the war in West Asia hits chemical manufacturers. Balaji Mines flagged sharp disruption in ammonia procurement. Gas shortages also hit operations at Borosil. Management tells CNBC TV 18 that risk of complete shutdown remain if tensions do not de-escalate.
Kalpataru rallies over 4% after signing a redevelopment project in Mumbai with a revenue potential of 1,400 crore rupees.
And metal stocks are under pressure, with the metals index emerging as the top loser among sectoral indices. Disrupted iron ore shipments due to West Asia war and a stronger US dollar are hurting sentiment. Okay, all right. Those are the top headlines that we are tracking. We spoke about the Nifty and the moves in the broader markets. But if we talk about the sectoral moves, the Seoul index, which was in the green through the trading session, has also turned red. That's Nifty FMCG down 0.3%. For a larger part of the day, it was in the green. Metals continue to be the big drag, down 4.5%. We do have Nifty Auto, which is down, 10.5% this week itself. Big cuts across the board, and that is around the uncertainty because of the war that we are seeing, Vivek.
That's right. Big cuts across the board, especially the auto pack. The auto ancillaries, some of the tire names. These are the names, especially in the last 2 to 3 trading sessions, that they've taken a big beating. Names like M&M, names like Bharat Forge, all of them are down anywhere between 7 to 12% in the last 3 to 4 trading sessions itself. But these names and a whole host of other stocks is what Gaurav has on his radar. He's standing by the wall to take us through all of the mid-caps that are moving around in the session.
Well, yes. If you look at all the indices, in fact, if you look at Nifty, it is under pressure. Nifty mid-cap is under pressure. But even in this pressure environment, there are some stocks which are gaining in trade. So first, let's talk about that. We've got companies like Zydus Wellness, Acme Solar, LTTS. All of these stocks are up in trade despite the pressure that we're seeing across the board. IFCI is also up. Remember, they have some stake in NSE. And given that there are sources which suggest that NSE's IPO may come soon, the sentimental impact is what we're seeing in this stock. And Swarm Defense is yet another stock which is up and under its upper circuit limit of 5%. On the flip side, let's also not forget about companies like Muthoot Finance. There was a brokerage update, and after that, we are seeing some uptick in this counter. And TPC Green, Adani Total Energy, NHPC are some other stocks which are up in trade, not only up in trade, but they are also seeing good volumes. But on the losing side, first let's talk about some of the big key losers. KPR Mills, Ellen Berry, Sapphire Foods, SCPC, all of these stocks are under pressure. And not only under pressure, we are also seeing some pressure from volumes also. If you look at mid-cap index itself, only a handful of stocks are in green, and that's the reason why if you look at some of the losers, we are seeing a sharp movement in specifically Nifty Metals and Auto segment, and in the likes of that, we are seeing companies like National Aluminium, SAIL, all of these stocks are under pressure. Ashok Leyland, Hero MotoCorp are another pack of stock from the auto space which are under pressure right now. If you look at the market right now, it is also important to understand which are the stocks which are still at its 52-week low or near its 52-week low level. We've got companies like Exide, PI Industries, Coforge, and apart from that, let's also not forget about ACC and ITC. These stocks are currently trading near its 52-week low level, and it is really crucial to see if they sustain this momentum or if there is any turnaround from this level specifically now that they're at the lowest point in the last 52 weeks.
Okay, big cuts in some of these IT names. We are seeing that in the broader markets and some agrochemical names as well. Thank you so much, Gaurav, for joining us with that list. Let's now welcome Prakash Gaba, technical analyst for a technical check on the markets. Prakash, Nifty is making newer lows. We are very close to the 23,150 mark. Do you think it could only extend the losses that we are seeing? What is the next important level to watch?
Good afternoon to you, Sonal. So far, technically, the Nifty and the Bank Nifty both look weak. There is no strength. For market to come down, we need to see weakness, and we are seeing a weakness. Now, is there a strength? Little bit. No, there's not even a weakness in the weakness. So it's actually increasing by the day. Now, Nifty is trading 23,160. I feel that 23,000 is the next technical target. We must stop using the word support. Who knows where it breaks? If 23 breaches, the new support will be 22,500. So we need to see not supports, but more of targets instead. And strong resistances, yes. If it goes up, so all expansions that we see will be shorting opportunities.
Okay, Mr. Gaba, thank you so much for joining us. No supports is what you're saying at this point of time as far as markets are concerned. But any individual trading ideas you have for our viewers today?
Yes, I like ACM Solar. Solar seems to be good, given a beautiful breakout at 240 zones after a long time. And I think it can go up from here, but needs to have a stop below 240, and now it's trading at 250. The 18 rupee stop is big, but then the target needs to be 280. So you just buy and hold ACM Solar. Second stock that I like is Thermax. Thermax looks like it's building up. There is some kind of a support, good base formation, trading at 3,200 zones. Stop below 3,100, that means 100 rupees. Can it go to 3,300? Yes, the risk reward issue is in favor, but need to hold for a while, even Thermax as well. So I think these two stocks looks good to me.
Okay. What about metals index? It is down 4.5% now. Week to date, it's down 5.5%. Most of the losses have come today itself. Would this continue?
Sonal, I have not seen the metal index, so I would not be able to comment on it.
Okay. Anything on Bank Nifty, Prakash?
Bank Nifty is certainly weak, I would say that. Bank Nifty is trading at around 53,750. I think it's heading to 53,000 zones. But before that, 53,500 should be the target. And then I think it's heading down to 53,000 actually. So far, I don't see any strength. If it ever goes to 55,000, there'll be a beautiful shorting opportunity. So any expansion that you may see on Bank Nifty is a short.
Okay, all right, take that point. So another low for the day across the board. Nifty, as I said earlier, is closer to the 23,150 mark. Rupee has hit a record low. The advance decline ratio absolutely in favor of declines, 1:7. That's the kind of markets we are working with. We do have Brent crude, which has surged to levels of $102 per barrel. Actually, that gap is just widening on the advance decline ratio. And again, crude continues to be a problem, and that is the case yet again. So yeah, incremental pressure which is coming in. We'll see which way things go, but it's the uncertainty which continues.
That's right. And even as we speak, private banks taking a deep knock. Most of the names are names like Federal Bank, the metal pack. The weakness actually, especially in the last 5 to 10 minutes across metals, seen significant selling pressure. Tata Steel, Jindal Steel, JSW Steel, all of them have hit a fresh intraday low. Even as we speak, the metal index down 4.8%. But here's a quick reminder for our viewers. CNBC TV 18's India Business Leader Awards will be held tomorrow. Tune in as we honor the ICC Men's T20 World Champions. Catch our coverage 4 p.m. onwards. Welcome back to Mid-Cap Radar. Well, across the sector, especially in the mid-cap space, you're seeing significant selling pressure. Look at the EMS names. Names like PG Electroplast, the company came and said that they would find it tough to meet the guidance given that March, where they supply almost 15% of the total annual sales, has come under significant production pressure. That particular stock down almost 5%. Amber Enterprises grappling with multiple worries, especially in the supply chain. That particular stock near the day's lowest point. Even names like Dixon, too, facing significant selling pressure. The other set of stocks that are seeing selling pressure and stocks near the day's lowest point, look at the PSU banking names. Indian Bank down almost 6%. You look at another name like Punjab National Bank, PNB, that too has fallen quite significantly. From banks, another sector that has seen significant selling pressure is actually the auto pack. It's all on account of the fact that the gas supply squeeze has made its impact. Sudarshan joins in, and Sudarshan has collated what all the brokerages make of this particular development.
So if you remember 2025, this was the one sector which had completely outperformed all the industries, or say all the sector. But over the last few trading sessions, the sector has been seeing a continued fall. And this week alone, Nifty Auto is down 10%, going to see the biggest weekly fall in the last 5 to 6 years. And what's the reason? Gas supply usage, and basically the issue that gas industry is facing related to gas supply might impact the production. And on that, JP Morgan and Nomura have written notes. JP Morgan is saying it's going to impact the production. And second, input cost has been rising, and that will have an impact on margin. So it has mentioned few challenges. First, LNG or LPG shortages could lead to production disruptions or production shutdowns. Second, potential disruptions to CNG availability could shift the preference of people towards CNG cars. Third, higher fuel and commodity costs could hurt the margin of companies. Fourth, global shipping disruptions could impact the exports, and some of the companies have huge exposure, especially in two-wheeler. Both Bajaj Auto and TVS Motor. Bajaj Auto has 50% exposure to exports. TVS Motor has in the range of 30 to 40%. And last one in that one is weakening consumer sentiment could hurt the recovery that we have seen post-GST rate cut. Post-GST, this industry had seen a huge demand in the volumes, and the growth was in the range of 25 to 30%. That might we see coming down over the next few months. Nomura has done some analysis of all the fuel sources that the industry uses, and gas has the huge contribution towards that, and it believes that in the very short term it would be very difficult for industry to move to any other source of energy. And amongst all the companies that will be impacted, for auto companies, Bajaj Auto, TVS Motor amongst two-wheelers, and amongst four-wheelers, Maruti can be impacted the most. And if you talk about auto ancillary companies, Balkrishna Industries, Apollo Tyres, Minda, and Bharat Forge will be impacted the most. Lastly, talking about the retail or Vahan data, as of now in March 2026, the data has been strong. The numbers are higher than what we had seen in March 2025. But the impact, we'll have to see how the industry faces this issue over the next few days, and that will be tracking very closely.
Okay, all right. A big cut across the board. Thank you so much for joining us with all those details, Sudarshan. The other stock on our radar is PG Electroplast. It is under pressure on gas supply concerns again. Management also gave us more details on the impact earlier today. Pasna is joining us with all the details. The stock is lower by 5%, Pasna.
Well, certainly. First up, let me highlight what has exactly happened. Now, 3 days prior, company highlighted a gas shortage under its supply agreement due to Middle East conflict. This disruption has led to curbs on LPG allocations of the company, prompting the firm to explore alternative solutions. Now, management joined us today morning on this issue and update us about what exactly is happening on ground, in which the management has highlighted that the LPG shortage has impacted their production lines, and this gas shortage may impact company's FY26 revenue guidance, which was given at 5,800 crore. Now, companies also said that March is one of the key important months for the company, as it accounts nearly 12 to 15% of the yearly sales. Now, companies also lost 1 week of production as of now because of this gas shortage, and it is also exploring alternative solutions for this LPG gas, is what they've highlighted. Listen in.
Out of 4 plants for manufacturing of air conditioners, last week there was a disruption of 3 to 4 days. This week there has been already a disruption of 2 to 3 days. So if you look at, we have almost lost 1 week of production. So I would not be able to give you the number on that. What I can tell you that we are trying to work on how we can salvage the situation. we are working more on that instead of, calculating how we are able to achieve that revenue guidance or not that. Our teams are more focused on how we can mitigate this. We are working on some alternative technologies, alternative gases. Our technical teams are working on that.
Okay, all right, that is about PG Electroplast. But in a market like this, we do have some stocks which are doing well. Kalpataru Limited, which is a real estate company based out of Mumbai, doing well in trade. The company has announced to the exchanges that they have entered into a redevelopment project in Andheri West, which has a gross development value potential of 1,400 crore rupees. Now, do remember, redevelopment has been one of the ways in which Mumbai real estate developers have been expanding in the city, because now the horizontal expansion is not so possible in the city. The total potential is 0.4 million square feet, and company has continued to focus on redevelopment opportunities across the country. Now, do remember, we are seeing a lot of companies getting into redevelopment, be it Mahindra Life Spaces, we have Keystone Developers, Oberoi Realty, one of the big names, also recently entered this market. So it's heating up. There's a lot of competition. There could be some margin squeeze, but yes, the street likes this announcement. The stock, though, has fallen from the highs of the day. It was up 8% when we started trading, and now is up just around 4%. But yes, it is a screen for Kalpataru, at least in a market like this.
Absolutely right. One of the few specks of green you can see across the screen, and even as we speak, private banks have slipped further. Well, what we'll do now is we'll slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back to Mid-Cap Radar. Well, markets continue to see and remain under significant pressure. Mid-cap, small-cap index underperform the benchmark indices quite meaningfully. Well, some important news flow coming in, especially as far as select pharma names are concerned. Remember, both Lupin and Zydus are large players as far as the mirabegron market is concerned. This particular drug is used to treat an overactive bladder. So there has been some development as far as the US legal system is concerned. The Delaware Federal Court has gone ahead and upheld the validity of the innovator, who is Astellas, of this particular drug. And they have upheld the patent of Mybetru, or mirabegron as it is more popularly known as. The court has gone ahead and blocked another company which was trying to go ahead and launch this particular drug in the market, the company by the name of Ascent Pharmaceuticals, and that particular company has been blocked from launching its generic version till the patent expires in 2030. Now remember, this particular development has a positive read across for both Lupin as well as Zydus. Both of these companies have already launched their products in the market, and in fact have also gone ahead and settled all litigations with the innovator as of last month. So Nuvama says that this is a positive read across, and on the back of that, both Lupin as well as Zydus Life Sciences are in focus today. You did see a bit of a spike intraday, but remember, most of the stocks have been sold into on account of the overall market weakness. But with that, it's all the time we have on this edition of Mid-Cap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Betty Motiwala. With me is my colleague Arundhati as well. Arundhati, good afternoon, but not a very good afternoon coming in for the markets. Friday the 13th surely is playing its part in the markets today. Friday, we are seeing 500 points as of now, seeing a decline for the Nifty. Look at it. Sensex also is down 1,500 points. So both the indices are seeing a sharp fall. Broader end of the markets, that also is seeing a sharp fall as well. And look at the Nifty mid cap. That's too is seeing a carnage. 2 to 3% decline as of now for the Nifty mid cap as well. Day's lowest point is what the Nifty mid cap is trading at as well. Small cap too is trading with sharp cuts, and clearly 23,150 below that mark is what the Nifty is trading at. Now we've reached closer to the 23,100 level, so we're breaking those key levels, Arundhati, and that's becoming a concern in the markets.
Absolutely, big concern there. Huge sell-off in the markets. It's just deepening. Global Q is not supporting. Brent above $100 is not supporting. And if you take a look, there's no place to hide, right? We've got the auto pack in the red. We've got the banks feeling the pressure. We've got metals, which is the top losing index. We saw some respite in those FMCG stocks, but that's also given into those losses. And now the only two gainers on the Nifty is HUL and Tata Consumer, right? So that's how the markets are looking today. So not a good day for the markets. But let's get straight to answering all of your queries. So today joining us on the show are independent market expert Shaina Mukaddam and Chandan Taparia, the head of derivatives and technicals at wealth management at Motilal Oswal Financial Services. So let's go to the first query today. Ishwar Prasad writes to us from Chennai. He holds 300 shares of Indian Oil Corporation bought at 150 rupees. He is making a profit on the stock, and he wants to know if he needs to worry about his investment in the near term due to this LPG crisis against the backdrop of the West Asia war. So that's the key question on everyone's mind, right? So let's go to Shaina. Shaina, what do you make of the stock? What's the near-term outlook for the stock?
Oh, well, I don't think it's going to be very good. Near-term outlook looks weak. A couple of reasons, of course, which everybody knows. Now Brent is quoting around $100 per barrel, and that is extremely concerning because, as you know, that the government is very reluctant to allow OMCs to actually pass on the incremental cost. And the incremental cost is definitely going to be there over the shorter term because of not only the price of crude, but the availability of crude. So I would say it's going to be a bit tough for the next 3 months to 6 months till the war settles in the Middle East. I would suggest book 50% of your holding.
Okay. That's the suggestion coming in on the fundamentals. Book 50% of your holding in terms of the profits there. But, Chandan, what's your view on the technical front for IOC? What should the view be doing? And good afternoon.
Yeah, good afternoon, Mini. Thanks for having me. So the immediate structure is weak because the entire market is finding pressure. In fact, the index has been making lower top, lower bottom. Advanced decline ratio is quite weak. More than 90-95% stocks in the market are down. So structure is weak. But if someone is looking for positional point of view, then 145, 142 could be a major support. So if he's ready to hold with support for slightly 2 months to 3 months point of view, then he can look for some recovery. Otherwise, immediate structure for the counter is slightly negative.
Okay. Immediate structure is negative. Long term, maybe you can continue to hold if you have the patience to hold. That's the word there. Let's move on then to the next query. And we have Manoj Sharma who's writing to us from Shimla. It's an investment query. Wants to know if it's the right time to invest in Muthoot Finance. Shaina, normally, we talk about safe haven, gold. And then when you talk about stocks on the gold side, Muthoot Finance as a name comes up. Is this the right time to maybe look at Muthoot Finance as a long-term story?
Yeah, I think one can look at it, preferably because of the way the overall market is. Don't buy it all together, buy it in a staggered fashion. But in terms of operational performance, it's remaining very strong. We saw, the AUMs have increased substantially, I think over 45%, now currently at about 1.5 lakh, 1,60,000 crores plus. And a large part of it is gold, where the prices, while internationally have corrected a bit, because of dollar now strengthening against the rupee. Rupee is now almost around 92. So I would say that it is better to buy it in a staggered fashion. Operational performance is very good, so you could add, but add it in stages.
So buy in a staggered fashion is what you're saying, and buy it in stages. Chandan, what's your view on the stock? Any technical levels to watch for that you can enter into the stock?
So as of now, the structure of the counter is negative, and we have seen that most of the counters are making a lower top, lower bottom formation. So in my view, I think can wait for some more decline. If I look at the Muthoot Finance for bigger time frame or with the multiple time frame, it has been making lower top, lower bottom from last 8 weeks, corrected all the way from 4150 to 3100 levels. But yes, I think some margin of safety or some support based buying could be there. So if he is interested to buy in 2-3 times, can accumulate the counter in between 3000 to 3200 with the view that it can outperform and generate alpha to head towards 3600 to 3850.
All right. So the next query is coming in from Joyanta, who writes to us from West Bengal. He wants to know if he can invest in Reliance at the current level. So let's go to Shaina first. Shaina, what's your view on the stock, short term, long term, and is it a good time to enter the stock now?
Well, I think that could be more dependent on the technicals for the, at least as of now, because there are lots of positives and lots of negatives. The positive being that, Jio will continue to do well. There would be some delisting or some other activity in Jio over the maybe next 6 months and onwards. You have the retail will be reasonably well, doing reasonably well in terms of profitability also, or at least sales, and some impact maybe on profitability because of textiles also being to some extent impacted because of higher crude prices. Polymer, the petrochem division will be, I think, affected to a larger way because of the availability of crude in the first place, and also, as you know, Reliance has to a large extent stopped buying from Russia, and even if they do, I think it would be at higher levels than what it could have bought maybe 6 months back. So I think all this will impact. Refining should be also impacted to some way, but maybe GMRs will be GRMs will be slightly better, and that could be a positive. I think these are the impacting factors. Crude being 100 is definitely going to impact Reliance in some way. So I would say look at technicals, and you can add it and then keep it for the longer term.
Okay. Surely we'll get a technical check in terms from the levels also, which we can look to enter at. And Chandan, over to you for the technical levels, because in the last 6 months, pretty much nothing, right? Around those levels, it's roaming at 1,380. Is this the right time to buy, or is that something of an indication where maybe we could see a correction and you could get it at lower levels as well?
I think now the Reliance is stable and resilience even after the market pressure. Just 7-8 days back, it took support near 1307. And before that, in last 8 to 10 months, multiple supports were visible near 1335, 1350. So even after the market pressure, the counter is not ready to go below 1300. In fact, in derivatives data setup, we are also witnessing the put writing at 1300 strike. So 1300 to 1500 is the trading band for Reliance. If any small decline happens, can be bought in 2 tranches with the view that 1300 is major support, and slow and steady, this counter can have some better momentum to head towards 1500 levels.
Okay, thank you so much for that view coming in there for Reliance, Chandan. Let's move on then to the next query. We have Babu, who's writing to us from Tirupati. He's holding 60 shares of Aarti Drugs. Price is 697 rupees per share. He's been holding it since February 2022, so making a loss on this one, significant loss. Should he continue to hold or book his losses? Aarti Drugs, what is your view on the fundamentals for this one, Shaina?
The fundamentals are very volatile. And if you look at it from the buying price of the investor, the stock has corrected substantially. Now, after this correction, and also overall the performance being volatile, we've seen, some quarters up, some quarters down. Now, it's an interesting sector, pharmaceutical sector. It's a small cap stock. At the same time, I would believe it is better to book at least half your profit. The valuations are not expensive at current levels. Because again, the raw material in their pharmaceuticals also to some extent is impacted by the higher crude prices, which have shot up in the short term. So here I would say book at least half again of your quantity and relook at it maybe 6 months down the line. So they have interesting products, very old products, but interesting products. But still I would suggest book half the quantity as, and then relook at it a couple of months down the line.
So re-look at it in 6 months and book half of it is what you're saying. Chandan, what's your take? What about the technical level? Should he sell or hold the stock?
So like if someone has already taken, then I think can wait and look at the key support zone. However, in last couple of weeks, the stock has been making lower top, lower bottom. But if I look at the monthly chart, we have noticed multiple support near 310, 315 levels. And 3 to 4 times in last couple of months, the counter took exactly same support. So structure is weak. It can go down, but with the support of 310, one can again see the recovery for 385 to 400 kind of level.
All right, Chandan. On that note, it's time for us to slip into a short break. But before we go, here's a quick reminder for our viewers. CNBC TV 18's India Business Leader Awards will be held this Saturday, which is tomorrow. Tune in as we honor the ICC Men's T20 World Cup champions. Catch our coverage 4 p.m. onwards right here on CNBC TV 18. Welcome back to Your Stocks on CNBC TV 18. We still have with us Shaina Mukaddam and Chandan Taparia to answer all of your stock queries. Suresh writes to us from Hyderabad. He holds 1,200 shares of Tata Steel at 89 rupees. He wants to know both the fundamental and the technical views on the stock. He's clearly making a profit on the stock. You know, Shaina, let me come to you for the fundamental view. The stock's done well. It's seen gains of 22% in the last year. So what's your view for the stock going forward?
They came out with very good numbers over the 9 months. Actually, they had record production, and this supported their overall performance. Valuations also not expensive, If you look at it, EV by EBITDA, it is just about 7.5 times, which is not expensive for the quality of the management and the company. At the same time, I would suggest, because he's got quantity, to reduce his risk and also get into some non-ferrous stocks, maybe in copper, aluminium. So one of these could be preferred pick for at least half his quantity. Tata Steel has also reduced debt, so even the balance sheet has now become much stronger. But at the same time, what I believe is that the raw material costs are likely to go up. And like, for example, coking coal availability also is a question, and also other raw materials. So to that extent, I would say that, the shorter term may be slightly soft while steel prices have gone up. So I would say book half into some other, metal.
Okay, point taken there. Chandan, what's your view coming in for Tata Steel as well? They bought it at 89 rupees, right? And when you look at it, especially since this war has started, Tata Steel is actually one of those top losers coming in the metal packs as well, down 13% since then in the last 15 days. Anything that the viewers should keep an eye out on the technical levels?
Yeah, so he bought at much attractive level and price has gone double from his buying rate headed towards 216. However, it's down by around 13 to 15% from top, but major trend still remained intact. So even after the corrective move of 3,000 point in Nifty, the stock is just down by 13-15%. So if he's ready to hold or can book some partial profit. As per the technical setup, 165 is major support, and again counter can head towards 200, 210 once the market gets stability, and positional we are looking for 250. But those who are looking for, on immediate point of view, I'll suggest to avoid, because further 5 to 7% kind of correction cannot be ruled out looking at the negative price pattern on the daily and the weekly chart.
Okay, thanks for that, Chandan. Next query then for today, we have Kumaraswamy Reddy, who's writing to us from Chennai. He's holding 2,000 shares of Yatra Online and wants to know whether to hold or exit at current levels. He's not mentioned the buy price, but yes, he's holding 2,000 shares. So what should they be doing with this one, Shaina?
The stock price is below its IPO price also of 142. So, and it is not really, though it has been volatile, if you look at it over a 3-year period, it's not really given you any return if you're a long-term investor. And also now with these issues on flight cancellations, at least the international flight cancellations, there's going to be a lot of turmoil in the travel sector. You could have cancellations, lesser meetings in India, conferences, lesser conferences, and of course, international travelers also will see a big drop. So I think at least for the next 6 months and not, there is going to be an issue. So I would say you could exit from Yatra and again, relook at it sometime later. While valuations are not too expensive, I would still say that either look at the technicals and accordingly do, because it's at one of its lower levels over the last 2-3 years. But at the same time, I would say at least book half or some quantity of your holding.
So book some quantity of the holding is what you're saying. Chandan, we don't know at what price he bought the shares, but he holds 2,000 shares. And any key levels that he needs to watch out for where he could exit or continue to hold the stock?
Yeah, so in last 5 months, it had seen a corrective move of more than 50%, has corrected from 200 odd levels to now below 100 or near 100 levels. So structure is weak. However, in last 12 days, it has been consolidating with slight negative bias. But if 101 or 100 level is broken, it can go down towards 99 to 88, which is 10 to 12% further lower from current level. So suggestion is try to exit the position. If it manages to hold above 110, 111, then only the short-term stability will be there. While below 100, it can see a corrective move. So need to keep the position accordingly.
All right. The next query is coming in from Meenakshi Vasisht, who writes to us from Lucknow with an investment query. She wants to know the lower target entry point for 197 Communications, which is Paytm. So, Chandan, let me come to you first for this. So, what lower target or entry point can she look at for this stock?
So, if I look at the price behavior, I think 920 to 930 or 900 to 930 could be the major support. One can accumulate near to those levels with the view that it can again head towards 1150 to 1200.
Okay, that's the levels on the technicals. But Paytm, what should, Shaina, your view be on Paytm for the fundamentals? Is it a good bet right now?
Yes, I would agree with the levels that Chandan has given. And I would go with the lower one at 900. But, the issue is valuations after the stock correction. after the fall that it's seen after its high and the short-term correction, I think has brought down the valuation substantially, and it's made it more attractive. At the same time, I would say that there is still a bit of uncertainty because of the overall crude oil prices, the impact on inflation, and the impact it will have on buying by by customers using Paytm. So I would say better to wait for some time and buy it at slightly lower levels, while valuations are now attractive.
Okay, valuations are now attractive, so that's a good one to keep an eye out on. Levels also, Chandan mentioned. Let's move on then to the next query for today. We have N. Gopalakrishnan, who's writing to us from Chennai. He's holding 5,000 shares of Huhtamaki India. Price is 280 rupees per share, making a loss on this one. It's not the one we cover too often. But China, fundamentally, what is the view on this stock? Should they continue to hold or sell?
This company is into papers and containers. So one of the major impact that it's going to have is polymer prices as its raw material, and also in terms of revenue, it could be impacted because of the impact on ship movements as well as domestic demand. So I would say that it is better to exit from the stock, or then maybe sell a large quantity of what you're holding.
All right, sell a large quantity of what you're holding. But Chandan, what's your take on the stock? Should he book his losses or continue to hold at current levels?
So as of now, the structure and the trend is negative, but the only good part as of now is 150's major support. In fact, in the year 2022, it took support near 150 and then it headed towards 450. Even prior to that, in 2019, it made the bottom near 155. So now it has come to the key level. But if 150 is broken, then need to exit the position. So as of now, if he is having the position already in loss, that's fine. But 150 is major support. If that level is broken, then try to exit. Otherwise, with the support of 150, stock has potential to get some recovery. So 150 is a very critical level for the counter as of now, as per the technical setup.
Okay, 150 is an important level over there. That was the last query for today. So Chandan as well as Shaina, thank you so much for joining us as always and helping viewers solve their stock-related queries as well. So thank you so much for that. But a quick check on what the market has been doing in the last 20-odd minutes. We've seen a bit of a recovery coming in. When we started the show it was at around 23,150-odd levels. We've seen a good 50-60 point uptick that's come in for the markets as well. Still, a decline of 1.8% for the Nifty 50, but 400 points down as of now in the trading session. So slight bit of a recovery, a smidge of recovery is what we're at least seeing coming in the last 20-odd minutes.
A smidge of a recovery, but still everything in the red, and the sell-off just persisting. But on that note, it is time for us to wrap up this edition of Your Stocks. But do remember to email us all of your queries and we will address them with our experts. But closing bell is coming up next. Stay tuned for that, and that will take the action, all the market action forward.
go beyond market headlines to understand the reasons for the day's movers and shakers and get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
It's an equally red start, if not more, across the Asia Pacific.
By the end of this month, the U.S. Navy will be escorting some of those ships through the strait?
I think that, yes. I think that is quite likely the case.
It's doing very well. Our military is unsurpassed. There's never been anything like it. Nobody's ever seen anything like it.
West Asia war, no relief, oil at $100 a barrel. It kind of sort of tells you everything you need to know.
A big IPO in the waiting for a very long time finally looks like it's going to have a reality.
It is down 150 on the Nifty and about 500 points lower on the Sensex.
So I'd continue to be positive on banks. Maybe there's, yes, a 5 to 10% decline in individual stocks.
March usually happens to be a peak month for the production and sale as well.
In this year also, we did curtail our bidding by 5% odd. In the next year, if this is to continue, God knows what can happen.
All central banks and RBI spearheading it are generously selling dollars in the hope that this is a short-lived war.
The Nifty Bank is down over 1,000 points, just on the verge of breaking that 54,000 mark as well.
Oil prices increase India's import bill directly. They raise the demand for dollars from oil companies, and that puts a pressure on the rupee. And that's exactly what you're seeing playing out today.
Iron ore shipments are getting disrupted, according to reports, as we speak.
Mid-caps are down 1,300 points, or actually 1,400 points right now. Bank Nifty not far behind, sitting with a cut of 1,200 points.
Well, that was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Mangala. 1 hour to go, and I think everyone's going to say thank God for that, right? It's been a disastrous session. We've managed to claw our way back from the lowest point of the day, but still down close to about 420 points on the Nifty right now, 23,300. For the week so far, it's been a slide of more than 5%. This is the weakest weekly performance for the market in the last 3.5 years. The mid-cap, small-cap index down 3.5%. You can feel the pain in individual stocks, and that advanced decline ratio, 2:13. Hi.
Hi, this morning when we were talking about that being a Friday, and thank God it's Friday, what we also forgot was it's Friday the 13th. And that's exactly what, the bulls are facing right now, a fair amount of horror. In fact, so much so that if you had to, look at the pain in the markets right now, walk across the wall shortly and tell you, the kind of weakness that we're witnessing. Yes, notwithstanding the recovery from the lows that we've seen, at one point Nifty was perilously close to breaking that 23,000 sort of mark as well. But right now, holding on to 23,200. So just to set things up, you'd say there was a sharp fall in the markets today. And at the same time, if you had both the Nifty as well as the Nifty Bank and the mid-cap index, all of them come up for you on the screen. It's a big fall, and the biggest reason for that is the crude shock which has rocked the market right now. The Nifty Bank and the mid-cap index, all of them come up for you on the screen. A big gash is what we're seeing. The mid-cap index down about 1,300 points. The portfolio's feeling the heat, and it's not just about today, right? If you look at this weekly performance as well, the Nifty is down over 5%, and that's the worst weekly performance that we've seen all the way since June 2022. And alongside that, we have the Nifty Bank, which is fairly lower as well, which is the worst performance that we've seen all the way since the pandemic month of March 2020. So all these factors plaguing the market right now. If you look at crude, Brent is holding above that 100.8 mark as well. NYMEX around that 96. Moments ago, Brent was actually around $102 per barrel. So all these factors, geopolitical concerns, are impacting the market. If you look at the advanced decline as well, Wall Street futures down about 150 points right now as we speak. And that's also impacting sentiment on our market. So there was a big cut that we saw yesterday, and that cut continues even today. If you look at some more data points that have come by. This week we've seen a cut on the Nifty as well as the Nifty Bank. Alongside that, look at this, the Nifty Bank down 7% this week, worst since May 2020. If you look at some of the biggest numbers, and the number that stood out for me was this one, 28.5 lakh crore of market cap loss ever since the war started. So since Feb 2028, it's been a 28.5 lakh crore loss of market cap in India itself. And look at the leaders, L&T, Interglobe, they have declined anywhere between 15 to 19% in just the last week or so. BPCL, IOC, HPCL, all the crude related plays, and L&T obviously has business out in West Asia, the region. And the dollar as well has moved higher. You have the rupee, which is at a record low, 92.4. All these factors not painting a pretty picture for the bulls. The advanced decline finally comes up for you. You have those lines far and wide apart. This morning, they were fairly close, and through the course of the day, they've only moved away from each other. Advances at 400, declines at 2600. In fact, we caught up with a slew of managements as well. Up until now, it was just about sentiment, and now it's actually percolating to real-time problems across various sectors, be it PG Electroplast, be it Borosil, or someone like Balrampur Chini as well. All these managements basically told us that their business is disrupted. For Balrampur Chini, obviously the opportunity in ethanol hasn't yet come by, and if there is no price increase in ethanol, a lot of the production will go back into sugar as against ethanol as well. So let's hear out what the managements have told us so far on the channel with regards to the real impact of the war so far.
No, so as a consumer products company, we do have sufficient inventory to sustain sales. There will be no sales loss, if it's a temporary situation. So I don't see a challenge on the sales part, but obviously production costs have gone up substantially. But as far as the margins are concerned, yeah, there will be some minor impact in Q4 because it's happened in the last, say, 15 days.
Out of 4 plants for manufacturing of vehicles, last week there was a disruption of 3 to 4 days. This week there has been already a disruption of 2 to 3 days. So if you look at, we have almost lost 1 week of production. So I would not be able to give you the number on that. What I can tell you that we are trying to work on how we can salvage the situation. We are working more on that instead of calculating how we are able to achieve that revenue guidance or not that. Our teams are more focused on how we can mitigate this. We are working on some alternative technologies, alternative gases. Our technical teams are working on that.
Government is not a trader. Government should not see, I buy this, I sell this. Government has put in a policy where they committed to you in no uncertain terms and gave interest subvention to set up capacity and said, please produce ethanol because we need it. The premise was blending will go up 20%. And there is another, BI standard being developed for 22 and 25. Ethanol can be used in so many other things. I'm saying India is sufficient in biomass. And this is what the bioenergy policy says. So biomass, if let's say sugarcane is biomass, maize is biomass, there's enough biomass and starch available in the country to be able to give you a plethora of chemicals. As you're aware, we're going to bioplastic.
Crude prices are easing now. The rates are changing rapidly, but today we hit a high of more than 102 on Brent crude against the per barrel, and now we're close to about $100 per barrel. So crude prices have eased a bit, and that perhaps is helping the recover from the day's low. It's been about a 100-point recovery from the session lows, and you can see that in Tata Motors passenger vehicles, Adani Enterprises, Kotak Mahindra Bank, Adani Ports. Stocks are still deep in the red, but if you look at that intraday chart, some buying is emerging at lower levels. Still, this week, the Nifty, from Friday's close to today, it's down nearly about 900 points. How should you position yourself? Mitesh Thakkar is now joining in. Mitesh, thanks for joining in. Tough day today. What has been the approach? What trades have you taken? What would you advise for the last hour?
Good day if you have been long, good day if you have been short. I've been talking about the fact that take good spreads on indices, both the Nifty and the Bank Nifty, and I would say that we are near to the first medium-term targets which I had. So on the Bank Nifty, it was around 53,600. We got a low of 53,675. Also is the fact that we have booked profits on more than 50% of our short spreads on the Nifty and the Bank Nifty. So in that sense, I think, one, it's a weekend. So typically there is short covering after such a big decline. Two, I think, you were near support levels with extreme oversold reading. So I think that also made sense. The idea is that the directional bias is still on the downside, but tactically, I think, after you've fallen with this kind of pace, I think a pullback is what I'm expecting. So, as I said, we've not covered all, but more than 50-60% of our shorts have been taken out, and now waiting for this bounce back to play and see how strong it is. Having said that, on the stock side, though, I think the bias is still mildly on the negative side. So we're still trading with more of short bias on when it comes to individual stocks. But yeah, on the indices, as I said, I think the first targets on the downside is done. 23,000 was for the Nifty and about 53,600 for the Bank Nifty. Both have been nearly met. You have got a 100-point higher low, but I think that's nearly done. And on the stock side, the calls that I have right now, Sona Comms is a sell with a stop at 501 for targets of 466, and Keynes Technologies is a sell with a stop at 35.35 for targets of 34.10.
All right, as we speak, $100 billion eroded off the market cap in today itself. 9 lakh crore has been the BSE listed market cap erosion. This week itself, it's closer to 30 lakh crores, 28.5 lakh crores to be precise. Mitesh, at what point does L&T turn according to you? Because, a near 19% cut in since the war has started, it's below all its important moving averages. Chartically, is there any level which is crucial for L&T to turn?
One, I think, Mangalam, like the indices, L&T also on the medium to longer term charts is reversed on the negative side. So very clearly there will be more downside pressure. But if you look at the weekly chart, on the 25th of July 2025, we got a weekly closing low of around 34.42. And then from there, this entire up move started, which saw the stock get past 4,200 levels. So, and now we're getting close to those 34.40, 34.30 levels. So I think, again, if I was short L&T, and I'm not, but if I short L&T, I think this is the right point to take profits. I expect a bounce back or a pullback to about 3,600 thereabouts. And from there, I think, we might retest 34.40, 30, maybe even break it because the long-term charts are still weak. So for the timing, I think, at least 2/3 of your shorts should be taken out. 34.40, 34.30 is the zone which I'm watching on L&T.
All right.
Okay, it's a 19% fall on L&T since the start of the conflict. More than 1 lakh crore of market capitalization has been eroded from L&T. But the pocket this week, Mitesh, which has been hit the hardest has been auto. The auto index has slid more than 10%, and this is the worst weekly performance for the auto index since COVID. If you go back to 2020, and so many individual names are all down. TVS Motors is down 13%, Bharat Forge 12.5%, Ashok Leyland, M&M, Eicher Motors, Maruti Suzuki, all down 11-12% since just in this week. Technically, is there a signal that you're getting from the Nifty Auto Index? Are any of these stocks tradable?
Yeah, this is broadly in line with the indices. So Nifty Auto Index, if you remember, or if you go back to the July-August time, it was failing to get past 24,180, 200 zones. And then it opened with that big gap up on the 22nd of August. On the 22nd of August was the weekly closing, but the day was Monday, 18th of August. So I think we're back to those levels, 24,200 levels, again, at support levels. In fact, most of the sectoral indices and stocks are near their historical weekly pivots. So are the indices. I think, to me, it does look like that around these levels, maybe the decline will be arrested at least for a few days and there'll be stronger bounce back. So autos can also go through a bounce back. If somebody is stuck in long side, wait for a bounce back to sell. If somebody has short position, these are the levels which I would suggest, take at least 2/3 of 60% or 2/3 of your profit of the day.
Okay, let's try and find out the pain that you can feel in the broader market since the start of the conflict. Sudarshan has now crunched some numbers to find out how deep the sell-off has been.
So today early in the morning, if you remember the post on Truth Social by Donald Trump, he has said, and he basically sharpened his attack on Iran saying, let's see what happens today. So we don't know what would happen today, but one thing we know, and that is for sure, is a big fall in the market, and all the major indices have entered technical correction. Your frontline indices, Nifty, Sensex, Nifty Bank and Midcap Index are down somewhere in the range of 11 to 13% from their record highs. And for Sensex, Nifty and Midcap Index, 70% of that fall came in the last 2 weeks, and that's from March 1st to till now. For Nifty Bank, if you remember, last month, it was at record high. And from that level, it's down 11%. And talking about the weekly fall, market is set to see the biggest weekly fall that we have seen in last 4 years, basically since June of 2022. If you talk about monthly fall, we are going to see the biggest monthly fall since COVID 2019. And your 23 of 100 mid-cap stocks are at less than 3% away or are at 52-week lows, and 32 mid-cap stocks are down in the range of 10 to 20%. Now, talking about the major indices that are down. So, Nifty mid-cap index this week down 5%. On a monthly basis, down 7%. If you talk about yearly basis, it's down 10%. Similar move is seen for Nifty Bank, 7%, 11%, 10%. Even small cap slightly has outperformed Nifty Mid-Cap Index and Nifty Bank, down 4% this week, 6% this month, and 11% YTD. Now coming to the stocks. Ashok Leyland, one of the top outperformers of 2025, has fallen the most last month, down 20%, followed by KI Industries, Polycab. Both these stocks are down in the range of 17 to 18%. HPCL, IndusInd Bank, IDFC First Bank, KPIT Tech, all these stocks are down somewhere in the range of 15 to 17%. Among small cap names, Signature Global has seen a sharp fall, down more than 20%. PG Electroplast, remember today management has come on our channel saying that because of the gas supply issue, they can miss the FY26 guidance once again. Remember, they had cut the guidance in the beginning of the year. That stock is down 20%. Amba Enterprises, almost a peer to PG Electroplast, down 19%, Five-Star Business 17%, Reddington 17%. So we have been seeing a sharp fall from the time West Asia war has started. So we'll be going to the weekend after being almost fried on Friday the 13th. Hope we don't see Monday blues.
All right. Thank you very much for that. And the statements that are still coming through are very defiant. So Trump said we have unparalleled firepower, unlimited ammunition, and plenty of time. And this follows what the Iran Supreme Leader had to say in his first public official comment that the Strait of Hormuz should remain closed as a tool to pressurize the economy. Now, we've been trying to speak to a lot of market experts to try and find out what should you do when there is so much panic in the market, this kind of a sell-off. Envision Capital's founder, Nilesh Shah, believes that the broader market valuations after the correction are now back to historical averages. Listen in.
Valuations have come off. We've gone through time-wise corrections, and we're now down to those historical averages. Clearly, amongst the mid and the small cap space, we're seeing now a bunch of stocks, sectors where valuations probably are even as down to 12, 13, 14p multiples. And these are businesses still growing at about 20-odd%.
Well, we're looking at everything which has fallen, and when everything falls, the only thing that rises is the correlation among all of that. And that may perhaps have happened because the fresh weakness that we've seen in Rupee as well versus the dollar. Now it costs about 92.45 to the dollar, and even oil has crossed the $100 mark. Lata joins in with a chatter in the FX market. Lata, what are you making of this?
Well, it's a 0.3% fall in percentage terms of the rupee, but that is today. If one looked at from the time of the start of the war, which is, if you compare it to the closing rates of Feb 27th, the fall of the rupee is from 90 rupees 94 pies. That was the closing number on Feb 27th. It's a 1.5% fall. For today itself, perhaps the fall is slightly less than it is for the other Asian currencies. Many of them have fallen over 0.5%. The only reason why the rupee has fallen less is, although there is torrential selling by FPI, torrential buying of dollars by FPIs, foreign funds, importers, the counter is coming from the Reserve Bank, believed to have sold a lot of dollars in the offshore NDF market, the forward market, as well as the onshore spot market. In fact, it's believed that they must have sold close to $5 billion practically every day since the war began and the rupee came under pressure. The big worry is that the Reserve Bank can only smooth the fall. It cannot prevent the fall simply because now the macros are beginning to come under challenge. In February, when people were drawing up, economists were drawing up the estimates for FY27, the assumption of crude was about $65. Now, after the war has begun and is now well into its third week, or will enter its third week, the fear is that they may have to assume next year's crude price at between $80 to $90. And if that is the case, look at how the macros change. the original assumption of 7% or even 7.2% GDP growth for FY27 may have to be scaled down to 6.5% because every 10% rise in crude prices takes away some 20-25 basis points from growth, from GDP. Inflation likewise now estimated, or at $65 was estimated at 3.9 to 4%. Now that can rise to well over 4%. In fact, there are even estimates running at over 5% for FY27. Wholesale price index becomes very important because that goes into the calculation of the nominal GDP. That was originally estimated at 4. It might rise to well over 5%. But the worst really will be current account deficit. The original estimate at $65 was, under 1% current account deficit. Now it may go over 2.5%. Under 1%, we are not able to find enough capital flows to fill the current account deficit. If it rises to over 2%, will we find enough capital flows to fill it? And if it doesn't, it's another year of BOP deficit, and a balance of payments deficit normally means more pressure on the currency.
Take that point, Lata. It'll be very interesting to see what the RBI does in its next policy, and if they have any cautionary comments to make out there. But just a follow up on this one as well. You said that the RBI can smoothen the fall, at best not arrest it. But right now, do you think will they be a lot more mindful in even trying to smoothen that fall because of the extra dollars that they will have to pay because of the crude?
They don't normally stand against what is a global trend. And perhaps, when they see such a seminal fall in all markets, they will, provide less dollars. See, the Reserve Bank doesn't want, my guess is that one of the big reasons why they try to smooth the fall or try to provide some stability is a lot of capital flows which want to come. As Sudarshan was telling us, a lot of mid-caps are trading at 12-13 times PE.
Yeah.
I mean, that's a steal by Indian standards because the PEG then is well over 1.
Yeah.
Many of them have EPS growth well over 13%, some of the mid-cap stocks. If foreigners want to come to buy, and if they get the feeling that today I bring in the dollars and tomorrow that is cheaper, they will not come.
Yeah.
So the Reserve Bank normally comes in to provide that level of stability that in case capital flows want to come, we are here to provide the counter. So when they smell that flow, that's when they, support with greater gusto. But, all this is a discretionary game.
Yeah.
All this is a guessing and a judgment game. It's not as if the Reserve Bank will be able to smell the trend any better than the trader on the market.
Take that point, Lata. Thanks a lot for explaining that to us. The Nifty back below that 23,200 mark briefly. And as Lata was speaking, there was an interesting and important flash at the bottom of your screen which told you that Coal India, one of its arms, has gone ahead and filed for its red herring prospectus. So after the recent, listing, Bharat Coking Coal BCCL listing, in fact, it was just last fortnight where the management of Coal India had joined us on our channel, and we asked them whether they are looking to list some of their other arms as well. And that's where they said that, yes, they are. And we should hear about that shortly. And that's exactly what has come by. At least one of their arms has filed for papers for an IPO. Let's see what happens from here on as well. Coal India has been actually one of those, rare Nifty gainers in this week and this month itself. At a time when the Nifty is fairly lower, we have Coal India this week, which is up 6%, and this month, which is up around 8%.
Gurmeet Chadha is now joining in on the last leg of the show. Gurmeet, hi, tough times if you're managing money. You see your portfolio drawing down lower. How bad has it been, for you? What are you doing right now? What is the advice to your clients? And when you get fresh, are you getting fresh money in, or people are too scared now?
So I think God has been kind. We probably are getting a little bit. It's trickling in, but in a smaller lot. And as Lata was also mentioning, the valuations are very good. I think the sentiment can remain depressed for a while, so you have to go a little staggered and not go all in. So look at some of the banks. We are adding banks. You're getting most private banks below 2 twice book value at 12-13 times. A lot of small mid caps are in early teens, where at least there is an earning visibility of 15%. And there are a lot of let's say Middle East or petroleum related sectors which have also taken the brunt. Like for example, telecom is Bharti is more down for concerns on capex not being in telecom and in an NBFC. So there are a lot of pockets, and I was telling somebody in a lighter vein that 80% of the market is actually at COVID kind of valuations. Now, it can get worse. Nobody knows because you're in a war situation. But historically, if you just fast forward 12, 18, 24 months from now, you will remember this period, with that there were some opportunities. So we are going gradual, we are going slow. And I think the investors have also matured over a period of time. This isn't the first correction. This won't be the last either.
All right. Not the first correction, not the last either, but everyone feels different because participants are different, the drawdowns are different, the stocks that are falling are different, and thereafter, when the stocks rise after that, is also fairly different. So have you deployed any capital in this fall when, you did say that things are looking a lot more attractive, but at the same time, it's so fearful that you don't know whether you should buy today or you will get it a couple of percentage points cheaper tomorrow. And then there is that wish list that you always wanted to buy, and those stocks are now available in your buying zone, but the environment doesn't allow you to. So it's obviously important to manage your mind along with your money when you're looking at a screen like this. Are you deploying money or you're raising cash? How does this go? And in that as well, are you buying more of the same that you already own, or are you looking at some newer ideas which have now become a little more attractive given the correction?
So we are deploying gradually. Personally, I'm all in today. I think whatever little cash I had, I personally put in money because I'm not looking at a few quarters from now. With clients who, as you rightly said, you have to manage more, the behavior as well. So we are going a little slow. And for clients who are a little worried, we are ensuring that there's no decision which is taken in panic. We want things to settle down, and you don't want to right now react just news flow, because things can also turn around very quickly. And sometimes, Mangalam, it is good not to do anything. And for most of the clients, that may hold true. We are actually buying more of what you already have. For example, L&T, it's one of our top 10 holdings. We think, although the Middle East exposure is large, I think eventually they will come through. Also, there'll be a lot of reconstruction and big reorientation of supply chains. You can't be dependent on one port for such large movement of goods, especially petroleum products. You will see, in fact, more supply chain related capex which will happen. Also, L&T mentioned in their con call that 33% of their order book is now private, so which is a sign that a little bit of a pickup in private capex. We've added M&M. We are adding some of the telecom names like Bharti. And I've added largely in BFSI more because, as I said, that's one pocket which is looking extremely juicy as far as valuation is concerned. Some of the new names we have added where the correction has been 50-60% in some of the small mid-cap names, largely related to the consumer durable segment.
Like what?
So we had a little bit of Stovecraft in the portfolio. We've slightly added more. That's a more a near-term thing. We have LG, which is not really a small mid-cap, but I think the summer setting in early. There is a bit of a disruption because of LPG and other stuff, and also some of the commodity prices. But we see that as an opportunity, and the stock has actually done much better vis-a-vis some of the other names. And there's some chemical names among them, like JG Chemical, which is into zinc dioxide, which is what we have added.
All right, Gurmeet, out of time. Thank you very much for joining in, and let's hope Monday brings better tidings for the markets. Slip into a break. On the other side, we'll invite Ankit Jain of Mirae Asset Mutual Fund to talk more about the way forward and how to manage money and expectations. Can't take your eye away from the screen. There is so much pain, so much selling. So let's just go a little deeper into what's happening in the broader markets, individual stocks, indices. Hormus joins in with the analysis that he's done.
Well, this entire war in West Asia has had impact on the markets that we haven't seen at least since the last 6 odd years now, since the COVID period, incidentally in the month of March itself. But for the month as of now, the Nifty is now down 8%, the worst month that it has had since March of 2020 on expected lines, led by the Nifty Bank, which is down 11% now and is also the worst month for the index since March of 2020. And compared to the index and the Nifty Bank, the broader markets have been fairly decent, if you would want to call it that way. The mid-cap index is down 7.5%, the small-cap index is down 6.5% this month so far, and that's turned out to be the worst month that they have had since February of last year. They'll drill it down to specific stocks, and the one name that has been the most impacted due to this West Asia exposure has been Larsen & Toubro. L&T, one of the worst performers on the index this month so far. It's down 20% already in the month of March. It is the worst month it has had since March of 2020, and in this period the stock has lost more than 1 lakh crore in market cap. The market cap of L&T has now slumped below the 5 lakh crore rupee mark in today's trading session, while it was well over 6 lakh crore before the war began. The index heavyweights have been the big contributors to this downside. HDFC Bank is down 8% so far in the month of March. It's turned out to be the worst month it has had since January of 2024, and it has been a forgettable start to the year as well, because it's down all 3 months of this year so far, which is the longest monthly losing streak that it has had since 2023, when it fell for 4 months in a row between July and October. And on similar lines to L&T, this one has also lost more than 1 lakh crore in market cap. If HDFC Bank is down, ICICI Bank has not fared any better. This one is down 9% as well. It's turned out to be the worst month it has had since November of 2021, and mind you, we are just only in the first half of the month, and in the month of March so far it has gained only in one trading session. And in this month so far, ICICI Bank has lost almost 90,000 crore rupees in market cap. Now, the worst performer on the mid-cap index this time around has been Ashok Leyland so far. The stock until February was, of course, trading at record high levels, and in the month of March, the fall that it has had, it has given up all of those gains. In the month of Jan and Feb, the stock was up 18%. It's now down 20% so far in the month of March, and the stock, as a result of this fall, has seen its market cap slip below the mark of 1 lakh crore rupees. And lastly, Sapphire Foods, because of the merger announcements that kept the stock in the spotlight, the worst performer on the Nifty 500, down 21% this month so far. It was down 26% in January as well. So as a result of which, the YTD drop so far is now close to 40%. And from its split adjusted IPO price of 236 rupees, that stock is also down 31% from those levels as well. So now it's down at around 160, the IPO price of around 240. So it's a selling pressure seen across the board. The index is down, the Nifty Bank is down even more. The broader markets, some solace, but nobody has been spared, absolutely no one.
Nobody has been spared, absolutely no one. There you have it. And coincidence that, the last big fall, such big fall that we saw was in March 2020, around the COVID period itself. Ankit Jain, who's the senior fund manager of Mirae Asset Mutual Fund, joins in now. Ankit, the question is that a large part of our current equity investors, over 60-70% of them, have actually entered the market post-COVID itself, and they haven't seen a fall of this proportion. The question is that over the last few months, money going into SIPs was fairly stagnant. It wasn't growing at the pace it was. February, maybe because of lower number of days, etc., the number dipped by a bit. Now, do you think, given the sort of underperformance, there could be some sort of pressures when it comes to redemptions, or maybe slower than expected growth coming in from the DIIs as well, or flows coming in from there?
Yeah, Mangalam, hi. No, you're absolutely right. I mean, if we look into, basically FI flows, has been significantly negative. In last 4 to 5 year cumulative impact has been negative, and clearly DIs has been holding on to the inflow side of it since, right from COVID. Last 2 years now, with current sort of a fall, there are hardly any sort of returns. And we have seen typically, in case if it do extend beyond, let's say, 2.5, 3 years of returns, less than the FD sort of returns, clearly, despite of lot of maturity sinking in,
some sort of a worry starts trickling in. So to that extent, yes, it will be very interesting to see first on the market itself. Whether it is a, near-term overreaction to the event and how it sustains. But besides that, yes, if actually some of these things do sustain, let's say another 6 months, when maybe not much of a return is being there into the market, definitely, there could be some sort of a question mark on the sticky, DI flows as well.
Sorry, as of now, Ankit, have SIPs slowed down? Have they been paused? What is the evidence at Mirae Mutual Fund?
No, I don't think so. If you go by the industry data, it is still, I think, holding up reasonably well.
Okay.
So to that extent, yes, month of March, till now the dent on the market has been significantly high. So maybe the after effect.
We were trying to understand March. We have the backdated data as AMFI releases it. We analyze that. We were trying to understand what's happened in the first fortnight of March.
No, I don't think so. As of now, it is it is actually
holding up.
Okay, yeah, holding up. Yeah.
All right.
Right. On the market front, what's your call now with the kind of correction that we've seen? Sectors, anything in the mid and small cap things? What's the general thinking right now?
So clearly, on the geopolitical side, situation is quite fluid at this point in time. And so to that extent, sentimentally, market is clearly, reacting accordingly. But having said that, we have to see whether this is more of a near-term phenomena, is going to settle down a couple of weeks time frame. If that is being the assumption, then then clearly, some of these things can quickly reverse as well. Because any which way, see, if you look into India market has been down prior to this particular event as well, right? So to that extent, valuations even prior to this has been fairly reasonable. After, let's say, 18, 20 months of very long sort of a time correction, we have seen into the market. And plus good part has been that earnings for last couple of quarter, in fact, has seen quite a bit of an improvement. Almost NSE 500 earnings has been trending at around 15-16% YOY. Yes, some of these assumptions going forward can change in case if this crude oil price and all to sustain $100. But again, the good part has been that India's tolerance threshold from the crude point of view and even overall macro standpoint has actually moved up in last, let's say, after COVID, I will say. So to that extent, if you do work around with an assumption that some of these things do settle down next, let's say, 2 to 4 weeks sort of a time frame, and even if, let's say, crude do remain 80 to 90 odd dollar going forward, then I think things are pretty much manageable. And plus on top of that, I think we are clearly seeing sign of an earnings sort of an uptake. Yes, there could definitely be a near-term production disruption. Across many of the industries because of the rationing of the fuel, side of it, which can disrupt basically near-term production side of it. And plus on top of that, some of the companies which to use crude as a feedstock, raw material, they might also see some sort of a margin pressures. But as I mentioned that depending on to the timeline for this sort of a war, settling down, some of these things can also quickly correct because it is not an issue of demand. Neither it is an issue of supply. It is an issue of because of the conflict. That passage of route is being blocked, right? So I think some of these things can quickly reverse as well. Yeah.
Okay, we'll hope for a reversal. For now, what we can see is a complete sell-on rally kind of a market. Once again, we're back at the day's low. At 2 o'clock, we attempted a bit of a recovery. The Nifty pulled back nearly 100 points from the lows. But again, in the last 15 minutes, that's being sold into. It's a 1,500-point sell-off that you can see on the Sensex right now. Nimesh is now joining in for D Street Chat. And Nimesh, what have you picked up?
Hi, Rima. It's a brutal day of sell-off. After a long time, these are the signs of capitulation now across the market. It's not only the Nifty or the Bank Nifty, but across markets, across sectors. You're seeing that, it looks like a bit of a capitulation day. The mid-cap index, the micro-cap index, the broader market indices are down 2.5%, 3%, and massive impact in individual names as well. So clearly it looks like a capitulation kind of a day. And that's backed by FI selling. I've been saying for the last few days that the intensity of FI selling is pretty strong, and that seems to be there today as well. So barring few buys here and there, there is selling across the board from the FIs, even in today's market. What sector stands out is, and which is more surprising, is the fact that even after such a sell-off, there is selling in auto names, there is selling in banking names as well in today's market from the larger FIs. And to it, the metals have been the new sector which has got added on the sell side from the larger institutions. So that's something. The only silver lining could be that intraday we saw the Nifty PCR falling to 0.7. Normally we've seen close to 0.65, 0.6. The markets tend to bottom out in the short term. So that is something to watch out for. Maybe market looks a little bit oversold as well. But again, that pullback will depend upon what happens globally and what happens to the Middle East war. But today looks like it's a capitulation, and the intensity from FI selling continues across auto names and the banking stocks.
Take that point, Nimesh. Capitulation indeed, and the put call ratio, which intraday fell to 0.7, has now swiftly risen to 0.76 as well. So still far away from the oversold level on the put call ratio yet, though there is a fair amount of fear in the market. Individual stocks, are there developments out there in a market like this?
There are. So the first stock on my list is Bharti Airtel. I mean, in the last couple of days at least, it has tried to buck the trend and slightly in the green as well. And largely because there is FI buying which has resumed. I understand one of the leading long-only fund has been an active buyer in Bharti Airtel in the last couple of days. So that's the first stock. Couple of names where there is selling, and this stands out because of the recent underperformance. M&M as well as Axis Bank. Both these stocks are massively down in this last 1 week, and on top of it, there is selling in today's market. So both M&M and Axis Bank stands out in terms of aggressive delivery-based selling. So watch out for delivery volumes, but largely on the sell side, NFIs continue to sell those names. And a couple of names where small buying, but stood out for me in a weak market. That is Sun Pharma and Voltas. Voltas is down in today's market, but at least some sort of buying has resumed in both Sun Pharma as well as in Voltas in today's market. So from a very small buy perspective, these two names stand out for me in today's market.
Thank you very much for that. Trying to find winners today. LTTS stands out. Very large volumes, 30 lakh shares traded on NSE. Stock is surged 9.5%. I wonder what the news is, because rest of IT is a bit subdued. Then you've got a Liberty Shoes, 8.5%. Acme Solar gaining, resilient. Nucleus Software, 5% up. Chola Finance, Religare up and about. Syngene is seeing buying. Large volume, stock is surged nearly 4%. So these are some pockets where you can see green, but otherwise it's been a brutal sell-off for the markets. Precipitous fall across many individual names. Get into a break. On the other side, we'll get a few BTST calls. Mitesh will join in as always.
Even as we speak, a big surge is what we've seen in L&T Tech Services. Rima pointed out to that. And on the other side, Adani Total Gas, that's the one that should come up for you, down 7%, has been one of the big gainers this week. Despite the 7% cut that we're seeing on Adani Total Gas, the stock is up 17% for this week. Actually, good time to get in the F&O perspective on the market as well. Near 500 points shaved off on the Nifty, 23,150 thereabouts is where we are. And that market sell-off is fairly brutal. The Nifty Bank now down nearly 1,300 points. We have the mid-cap index down 1,500 points. Two charts explain the story of the day very well. One is the India VIX. For most part of the day, when the Nifty opened about 150 points lower, staying around that 200 points lower itself, the VIX was maintained until we started seeing a sell-off. And now that coincided with the VIX spiking, and that's up around 5% after having seen a big jump already. This entire week, the VIX is up 15%. And the other chart of the day is the advanced decline ratio. We opened with, a lesser distance between the red and green lines. And now as we speak, 400 stocks are gaining for 2,600 stocks, which are declining. And those lines are far and wide apart. The other part, the reason why the market is also falling is not because there is a lot of selling, but there is a lot of throwing in of the towel. We have the 23,600 put writers who believe that maybe the market would find support at lower levels, have been caught on the wrong side. They are unwinding those positions, causing further pressure. And then at every lower level where the puts were written, those puts are getting unwound. And that's causing further pressure on the market. So much so that now we aren't seeing as much put writing. Instead, at lower levels, we are seeing call writing. So 23,300 call, 23,400 call. All of them are seeing some open interest positions being added, and call writing has been the easiest trade of this week so far. So let's see whether that continues or not. But the interesting part is, despite the sort of call writing, put unwinding, the put call ratio, while it hit that 0.7 times mark intraday, it's still above 0.76. So not particularly very close to the bottom here as well. The interesting thing here, everyone's hoping, because of the ferocity of selling and the positions on the short side, everyone's at some point hoping for a big recovery that would happen. But then again, it's just a hope, no development or data point, Rima.
Okay, that's the F&O picture. Sorry, that's the F&O picture right now that we can see on your screen. Mitesh Thakkar is now back with us for a few BTST calls. Mitesh, too risky to take a trade which will ride out into the weekend?
I think, weekend means that there's 48 hours for any new kind of news to come into picture. So yes, in that sense, but then the market, the risk is always there. You can't avoid it. For the time being, I have two STBT calls. Marico, I think, is closing with a negative candlestick. So STBT here with a stop at 757.5 for targets of 742. And Max Healthcare is the other one, which is an STBT with a stop at 1,000 for targets of 974.
Right. Thanks a lot for that, Mitesh. Have a good weekend. We also have Anand Tandon, who's a market expert who joins us on the show right now. Anand, things were looking expensive earlier before this geopolitical uncertainty emanated. And India wasn't the best performer either, because we didn't have either the AI plays or, the EV plays, etc., or any of those new tech plays. What do you think has become a little more attractive after the brutal sell-off that we've seen ever since the war has started?
A whole bunch of stocks have become better priced compared to the past. The only question is whether they are still at a level where you want to go out and buy them. And that also depends on your overall market position and view. So, for example, the stocks that people were chasing after the likes of Dixon, they have, you have seen substantial correction in their valuations. And for the moment, at least, unless there are major upsets in, for example, logistics, one would argue that given the kind of business they are in, they are likely to be able to continue to show, if not the same level of growth, reasonably high levels of growth. So, and at less than 50 times earnings, you are not now asking for valuations which are running into hundreds of P's. So there are stocks like that. I had earlier mentioned, for example, much of the media space, whether it is the channels or the even the companies like the exhibitors. So some of those kind of sectors also, but overall, I think the fact of the matter is that only now we are beginning to see people feeling that there is volatility in the market, and therefore I would imagine that you might want to still stay a little on the sidelines and only start investing in bits and pieces, not really put in the whole amount that you would have perhaps kept for yourself.
In bits and pieces, what have you invested in, Anand?
Well, like I said, I think in my last interview a week ago, I had said I expect to see the market fall by 5 to 10%. We've probably seen half of that go. I think if it comes down a little bit more, I would start looking at some of the sectors I mentioned. Clearly, the sectors that are not going to be much impacted, in my view, are still things like pharma, things like specialty chemicals, and so on, especially except those which are dependent on petroleum. Those are the ones which are difficult to replace, and therefore will continue to do some of the EMS companies, etc. And the media companies. Those are the areas, to my mind, which are beginning to look a little more, a little less expensive, and certainly perhaps a little less affected by the war.
EMS companies, that's new, because I remember the last conversation where it was pharma and specialty chemicals which looked attractive to you, and now you're saying EMS, you're adding that to the list.
Well, that's right. Like I said, not necessarily as a recommendation immediately, but certainly they have now fallen off fairly considerably. And I would argue that if we see further downside from here, then they would come into a range where it will make more interesting sense to look at them.
All right. Some of the mid-cap IT pharma stocks are finding a lot of favor right now as we speak as well. Syngene has been well bid all through the course of the day. That's up around 4.5%. Strides Pharma has seen a sudden sharp surge, up around 2%, but in the context of the fall in the market, it looks big and a decent outperformance. First Source is the other one, which is up around 1.5% as well. So Syngene is up all through the day. Strides Pharma, the intraday chart comes up for you. It's a big surge that we've seen. And alongside that, First Source is the one which is sitting with a gain of almost 1.5%, which is actually an implied recovery of nearly 4% from the lows of the day. Anand, hang in there. We'll take a short break, come back, more market talk on the other side.
Welcome back. 3.5 minutes to close. L&T still down 7.5%. Metal names have been the biggest casualty today. Hindalco, Tata Steel, JSW Steel down 4.5% to 5%. Anand, when you said that you like pharma, last time I think you'd spoken about Sun Pharma and Natco Pharma. Any other pharma stocks look attractive to you?
That sector is going to do well for the next after the next 1 year or so. So I don't like to name names because they tend to become like recommendations, and I don't want any regulatory pushback on that. But essentially, I think, if you are looking at companies which have a decent pipeline, especially the diabetes drugs which are coming on, off patent, that itself provides a very large opportunity for one to look at.
All right. Meanwhile, updates keep coming. We had heard from the management of PG Electroplast, we heard from the management of Borosil, and now there is an exchange disclosure on Jindal Stainless as well, where they've said that due to heavy dependence of stainless steel manufacturing on industrial gases such as propane, LPG and natural gas, several of their processes have been impacted across their plants. The stock was down about 5% already, currently now lower further after this clarification that has come by. Last 14 days, ever since the war started, down 10%. Now, as we speak, down 6%. Anand, you have a view on the metals pack? Because, the street was just about to start getting bullish on the ferrous pack after a big surge that we saw in the non-ferrous pack.
Nothing is going to fall in terms of price as far as the underlying commodity is concerned. If anything, it is going to become a lot more difficult to around, and to some extent because of the fact that we already have fairly heavy import duties and protection for the industry. I don't see any reason why they should show any lower numbers. The only challenge that I would imagine is one in terms of whether any of the inputs, especially fuel, etc., become a problem for them to be able to grow their the production. And the other issue is whether there is an overall impact, a negative impact in terms of demand from the user industries. But otherwise, I think they are still fairly protected.
Anand, just counting down to today's trading session. Thank you very much for joining in. The Sensex has crashed nearly 1,500 points. The Nifty lower by 480 points. We're looking at a 2 percentage point fall. Markets extending their decline for the third consecutive session. And while we've seen many weak sessions, there have been a couple of trading sessions when markets have lost 200, 300 points. But today, when you look at the broader markets, the advanced decline ratio, you get that sense of throw in the towel, capitulation kind of a feeling. For the week, the index is down 5.3%, making it the worst weekly performance since June of 2022. For the mid-cap index, it's a fall of 4.5%. In terms of losers, L&T right on top. 7.5% gone. Metal names sold off aggressively, 5-6% lower. Banks have been the weakest link so far this week. The Nifty banking index ending with a cut of about 1,400 points, with names like an Axis Bank, ICICI Bank, HDFC Bank, PSU banks under pressure as well. And autos, the Nifty auto index single-handedly lost more than 10% this week. And for the auto index, it's the worst weekly performance since COVID. And names like Tata Motors Passenger Vehicles, Bajaj Auto, Eicher Motors, all down more than 10% for this week, and from the start of the conflict, 15% lower.
Take that point, Rima. While in isolation it looks like a scary day, but if you look at it in perspective of the decline that we've already seen, it looks even worse, and that exactly is what took place. 23,170 is where the Nifty wraps the week, with the Nifty Bank well below that 54,000 mark. Remember, started the week with the Nifty Bank closing above 56,000 on Monday itself. So that's the extent of decline that we've seen. The only couple of stocks that stood out today and in the last hour was a big surge that we saw in L&T Tech Services, ended with a gain of almost 10%, perhaps the lone major stock which saw that kind of a gain. But by and large, there was weakness across the board with Amber and Jindal Steel, Bharat Forge, Blue Star. A lot of the mid-cap names not doing well. In fact, 3,500, 3,600 BSE-related stocks were down in today's trading session, as against 1,100, which were higher. With that, we wrap up on this edition of Closing Bell, but you don't go anywhere. Our Friday special, Editors Roundtable, comes up next.
war in West Asia has triggered a global market sell-off and pushed oil prices back above $100 per barrel. The bears have completely taken charge of Dalal Street. The market clocked its biggest weekly decline in nearly 4 years and its sharpest monthly drop so far since the COVID sell-off. Autos, PSU banks, large cap private sector banks, realty, they've all been big casualties, with the three indices falling close to double digits so far this month. The Nifty and the Sensex have also seen an 11% correction from their all-time highs, which they hit on 2nd of January at the start of this year. Over the next 30 minutes on Editors Roundtable, we'll break down the turbulence in Dalal Street. Where do we go from here? What should the portfolio approach be? We'll talk about the oil and gas supply disruptions, the market impact. I am Reema Tendulkar. With me are Nimesh Mangalam. And Sonal is also here to talk more about oil and gas. And in the studio here with us is Ashwini Agarwal, founder partner at Demeter Advisors. Guys, it's a Friday the 13th, and it's lived up to its reputation. This was a really scary week.
Absolutely. And a scary day. Today it looked like it was a Black Friday. Like, I mean, massive capitulation across the board, across stocks.
This entire week has been that. You know, we started with Monday, there was a lot of panic and we hit that 23,700 mark, and now 23,700 feels so far away from where we are, right? Tuesday there was a bit of a relief rally, some hope coming by, only to be quashed on Wednesday and Thursday and Friday. You know, it was where the towel was thrown in from all ends. Looking at the Nifty Bank, the mid-cap index, all of them down between 2–2.5%. Isolated, it looks bad. But if you look at it in succession with the kind of decline that we've seen in the previous week, and even now, it looks even worse. Crude held above that $100 per barrel mark. Rupee at a record low on a regular basis. US futures were down 150 to 200 points when we closed on Friday. And all of that because there was no clarity on the geopolitical uncertainty.
Absolutely.
Any sort of hope of a rally is just hope and not a data point. The top losers were no different from what we've seen earlier, right? LNT down nearly 19% since the time the war broke out. Hindalco, and today we actually had the metals pack come in for some fresh selling as well. And mild flight to safety was probably Pharma and FMCG, which did not fall as much as the other indices, but fall nevertheless. So Nifty 5% down this week, Nifty Bank 7% down this week. When was the last time this happened? Nifty was last down to more than 5% a week in June 2022, and Nifty Bank was in May 2020, which was obviously the pandemic week. Auto stocks were the big sellers, right? We saw M&M down 12%, and these are no dinky toy stocks. We're looking at Eicher Motors, Maruti, Bajaj Auto, all of them down between 10 to 11%. Top losers from the broader markets, even more so. PG Electroplast down, 18%, Amber End down 18%, cables and wire makers, all of them down. The only few gainers were either the ones who benefited from getting the gas on priority, or maybe the ones who did not benefit from LPG and benefited from the induction cooktop sellers. So we had TTK Prestige, which did well. We had FACT, which was up 20–25%. But all in all, to just put numbers to it, since the war has broken, we've lost 29 lakh crore in market cap in in the Indian markets, and 1 lakh crore of that was attributed to L&T and the others as well. Indigo, it's down 15–16%. So not looking good. Friday the 13th. Let's hope that there is some peace prevails over the weekend, and thereafter let's see how that happens.
You never know what happens with the weekend. It's one day up, one day down. And we always think of oil as a bigger problem, but this time gas has become a bigger problem. Of course, we'll discuss that in greater detail, but who thought that India is so dependent on gas supplies and this would become such a big issue because there's something happening in the Middle East? Of course, we'll talk about it in greater detail. But Ashwini, first up on the markets, we've been discussing what happened since the time the war has started. This week has been even worse. What do you make? Is the incremental selling getting more worrisome now?
So the point is, the word that was used earlier in the conversation is capitulation. So people are giving up. So hope is being replaced by fear. So the way to think about it is that, at the peak of a crisis, you first run for cover and then you worry about returns. And that's what some investors seem to be doing. Ironically, the best returns are made when you're able to invest in crises like this. So obviously, in the short run, it's very difficult to say what will happen because the events in the Middle East are not forecastable. So on a 1 quarter basis or 6 month basis, it's not possible to say what will happen. But if you ask me, 1 year from now, 2 years from now, there'll be money to be made from these levels. So do we have the stomach to stay invested is the real question.
So basically, you're saying that it's time to be greedy and not be fearful.
Absolutely.
Got it. And I think it makes a lot of sense because he's seen more than 30 years of markets. He's seen so many volatile days in his investment career so far. How do you sum up this particular challenge this time around? Because as Sonal also put it out, this time it's not about crude, it's not about oil, it's all about gas. And India seems to be the most vulnerable across all the all the other markets as far as the Middle East crisis is concerned. So how should one review this?
So it is true that India's salience to the Middle East crisis is far greater than for any other major economy because of our dependence on oil and gas and our dependence upon the Indian diaspora that lives there, as well as the Middle East being a big target for Indian exports. So, you put all these three things together and it's really troubling for India from an economic standpoint. Having said this, the way I always think about life is that, things do come to a normalization. Now, what do we need in the Middle East? Do we need the war to end? I don't know. But we need the Strait of Hormuz to be opened. And my sense is that sooner than later that will happen. Because it's far...
Do you think that's possible without the war getting ended?
I think
is there a solution to that?
I think it's possible. I mean, think about it, that there are many neutral countries like China, India, who need that Strait of Hormuz to be to remain open, at least selectively for some flag bearers.
Sure.
So can some deal be worked out in the coming weeks? I hope so. So that's how I think about it, that it's not a one-size-fits-all. There might be solutions that are available, maybe not through security mechanisms, but maybe selectively for some nations, maybe some other mechanism. We'll have to see how it plays out. Right now, it's all very,
but
very
at what point will what's happening in the Middle East challenge the bullish narrative? Will it be if the war extends for another 2 weeks without the Strait of Hormuz being open for transit? At what point do you start really getting worried? Because as of now, you still believe things will normalize and therefore this is a good time to invest.
So there are two parts to it. I'll play it in two parts. Okay. If the Strait of Hormuz remains closed for another 10 days, it's very likely that oil goes to 180 and your Nifty and Sensex are down another 10% from here.
Wow.
I mean, we should be mentally prepared for that low probability but possible outcome.
Yes.
Sure. Okay. Do I think that this will continue for the next 6 months? I don't think so. But should it continue for the next six months and the Straits of Hormuz remains closed, I think there's a big problem for India. I don't want to look at that as an outcome, because I think some solution will be available. I think that's an extremely low possibility outcome.
But the fact that even if it extends for another 10 days would be dire for Indian markets in terms.
You'll have a momentary problem.
So, in that, say, even if that does not happen, as things stay right now, whenever there is some end to this or some, sort of horizon on the side, what would you say would do well in the markets once again? Will it be the names that have fallen? Will that stage a rebound? Or, there will be new leaders for the next bull market, so to say?
No, I think my sense is that markets are very mature now. And, people look at earnings, people look at the fortunes. Some companies have got hit harder because of what's going on in the Middle East than the others. Everybody's going to look at who benefits the most and where the valuations are the most reasonable. So as I look at things, probably financials, they will lead the rally. They've been very hard hit in recent weeks and they are least affected by what goes on in the Middle East in the short run. Long term, of course, if industry goes down, then NPLs rise and so on and so forth. We are not forecasting that right now.
Just hold on to that financials thought, because Nimesh has, planned something very interesting on that one as well. But before that, since just to complete the loop on the energy thing, Iran has shut the Strait of Hormuz amidst the sort of current uncertainty that there is, and gas supplies are disrupted. What does this mean for the market? What are the numbers? Well, Sonal, you've done some analysis here.
Oh, yes. So, as I said earlier, we speak about how oil is the biggest problem for India, but gas has turned out to be an even bigger problem, and it has repercussions across sectors. So that is exactly what I've put out. And Strait of Hormuz, that's the big word that all of us have been talking about. So let's understand how important this strait is. Now remember, 20% of global crude transit and 25% of global gas transit goes through this particular strait. And if we look at oil prices as well, there has been a big surge, big volatility. We saw levels of $119 per barrel, we came to $83 a barrel, and now we are at around $102 per barrel. So there's been consistent rise in oil prices as well. Now let's talk about some of the sectors which could be impacted because of higher oil prices. The usual casualties. We have OMCs, there's petrochemicals because it's a derivative of crude. We have paint space, airlines, of course. They have seen a big decline because of higher crude oil prices. But the gas supply impact has had a bigger impact across sectors. Now, look at this, 190 MMSCMD, that's the total consumption in terms of gas in India. 50% of this is imported, and out of that, Qatar's contribution is 59%, where major players have declared a force majeure. Now, that has an impact of India for sure. Now, if we talk about LPG, where we have been seeing a lot of conversation, 90% is used by households, out of which 60% is imported. Again, 90% of it is coming in from Strait of Hormuz. So that's a big number. The dependence is huge, and that's why we have been constraining some of the supplies as well. Now, Petronet LNG, that has declared force majeure because Qatar is unable to supply gas to Petronet LNG, and that's the reason why we are seeing that impact across domestic sectors. So let's go sector by sector, because government has now changed their priority in terms of gas allocation to sectors. For 100%, they'll give it to domestic PNG, they'll give it to transportation CNG and LPG production as well. In Sector 2, they'll just give 70% of the gas, which has to be allocated as per 6 months average, to the fertilizer plants, 80% to tea industries, manufacturing, industrial consumers. And they've asked city gas distribution companies, because they have industrial exposure as well, to supply just 80% of the gas that they have. So yes, there have been cuts because there is some gas supply issues that we are seeing. Let's talk about some sectors now which will be impacted. Fertilizer companies, big portion of their raw material is gas for urea production, for other production as well. FACT, RCF, GNFC, they've spoken about some production cuts. City gas distribution companies, for Gujarat Gas, LNG is a big part of their raw materials. That gets impacted. For IGL and MGL, it is little lesser, but yes, the impact is there. And if we go to the other sectors, it's beyond oil and gas that we are seeing an impact. We spoke to restaurants, hotels. There is cut in allocation towards commercial LPG and also PNG. We have been talking about how it has impacted their functioning and their daily business as well. Now, PG Electroplast was one of the big casualty. They said 1 week of production was lost across AC manufacturing plants. Also, LPG is used for their bracing and welding of copper tubes, so there's definitely an impact. We also spoke to Balaji Amines. They spoke about how ammonia, which is a big derivative of natural gas, is not available. So they had to shut down some of the plants, and this has seen an impact across facilities. These are specific companies which have spoken about it. Somani Ceramics is the other one which has spoken about gas cuts. Now there's a table which talks about how gas is used in every sector, maybe at a smaller level, but for steel it is used for reductant for DRI, HBI. In ceramics it's used for clean firing. For glass it is used for melting. In industrial gases it is used as a hydrogen feedstock. So these are some of the stocks which could be impacted because of it. So yes, the impact is multifold. We have not spoken about it so much because oil has been the usual focal point, but gas has had a bigger impact across sectors. It's just not the oil and gas space. And that takes me to the question, Ashwini, how do you approach different sectors now? Everything is dependent on gas.
My point is that if you look at the industrial environment, gas cannot be replaced very easily. And even if supplies from the US were to come in, there is not enough shipping capacity to bring in all the gas that India needs. So one has to believe and hope that the Straits of Hormuz opens up, even selectively for some countries, if that were to happen. If that doesn't happen, then I think industrial capacity across the board will be under pressure for operations. I don't think there are two ways about it. I mean, I wonder if the government of India will consider mandatory work from home to reduce transportation needs and to reallocate gas to areas that need it most. But I think then there will be a big problem for the country. I don't think there are easy solutions at hand. So that's something that's difficult to forecast at this point, but it's a scary situation.
That has happened though in some parts of the I don't know whether it's many parts of the world where they have declared
in some emerging market countries,
but actually,
they have said,
are you holding any of the sectors which got impacted in the portfolio? And if yes, what are you doing? Are you holding on? Are you taking that pain? How are you addressing?
Yeah, I mean, of course, there can be no portfolio that has no impact from what's going on right now. So I'm holding on to what I have and selectively actually putting cash to work. So whatever cash has been there in the portfolio, because I had found the valuations to be a little expensive over the last 1 year. So, you know, slicing it in small slices and putting it in. Obviously, you know, last couple of weeks, those purchases have been very painful. But one hopes that over time that will be fine.
So is it more of the same, or you're getting
mostly
new names?
More of the same.
Okay, we'll try and find out what you've been investing in. But Nimesh, the big casualty this week, apart from, of course, everything sold off, but banks particularly bruising fall.
Yeah, absolutely. And, you know, banks was considered to be a safe haven. The macros were changing for the better. And, you know, things were looking good for the banking sector, right? And suddenly we've seen this Middle East crisis, which is adding a layer of risk, so to speak. from a macro perspective. So look at what's happened in the last few days in the banking sector. The Nifty Bank Index is down 11% in the last 1 month. The PSU Bank Index, which is holding up very firmly, that's down almost 8% in the last 1 month. Having said that, we have to put this into perspective. In the last 1 year, the PSU Bank Index is up more than 50%. So, we've seen quite a bit of rally in the PSU Bank stocks in the last 1 year, and things were actually looking good, quite good as well. And suddenly we're seeing this big hit which is hurting the banking sector. Even the Nifty Bank Index is up almost 14-15% in the last 1 year. So, last 1 month has been painful, but in general, bankings have done well in the last 1 year. The chart will come up on the individual names in the PSU basket. The biggest surprise, the biggest mover in the PSU bank, surprisingly, is Canara Bank. In the last 1 year, the stock is up 64%, followed by SBI, which is up 48%. And compared to what the private banks have done, surprisingly, HDFC Bank has given negative returns, even after underperformance of the first few years, last year as well, right? In the last 1 year, the HDFC Bank is down 3% and Kotak Bank is down 5% from a 1 year perspective. So that's the kind of underperformance we've seen in the private bank names. Valuation-wise, now, compared to history, the PSU Bank Index is now trading at close to 1.8 times price to book versus their average of 0.1 or less than 1. And other way around, where the private banks were trading about 2 times price to book, they have now fallen to close to 1 time price to book or 1.5 times price to book on an average. Ashwini, what's your call? So we had somebody this week, and his big call was that there is a lot of market share shift happening for the PSU banks. And that is the reason why PSU banks will continue to outperform the private banks. Your take on the overall financial sector?
See, I think what has happened is that there was a period of time when risk aversion was being rewarded by the markets. And over the last 3 years, because loan quality has by and large been very good, growth has been rewarded. So the market moves in cycles. If we go back to a cycle where risks for lending rise, then you will see risk aversion and risk management come to the fore again. So I think, this is the time to be actually focusing on which players have the ability to manage their risks well, and that is the area I'd be. And it's going to be a mix of both private and public sector banks. It's going to be very name specific. The other area I would go into is where valuations are not reflecting an improvement in financials. In the underlying financials. For example, in the microfinance business, I think clearly the tide has turned after 2 very difficult years, but valuations are still quite low, and in absolute terms and relatively speaking, they're very, very low. So those are the 2 areas I kind of find interesting. So risk-averse banks and people stocks which are trading at very, very low valuations, and business fundamentals have turned around.
We had
Unfortunately, I don't take any names, but
stuff that you would have bought or something, but with all the disclosures, so that's the street knows.
Yeah. So, for example, State Bank of India, it has historic, and I own the name for due disclosure, that has proven to have a much better risk management among the PSU banks. So that would be the name that I would prefer the most among the PSU space. I would look at it.
The market is rewarded as well, right? The street has rewarded. The stock is up 50% in the last 1 year.
It has, but if you look at their technology platform, you look at the kind of growth they've been able to do, the kind of profit matrices that they've been able to produce, there is no reason to say that it should continue to trade at a discount long term to a private sector bank. So that narrative, I think, has changed.
And the microfinance names?
So microfinance names, I mean, I own Spandana Spurti, for example. The recapitalization has happened, and I think over the next 2 to 3 years, you should see the stock come back to trade at 1.5, 1.8 times price to book. So it's currently trading well below price to book. So, names like that.
Sure. One more argument in favor of the private sector banks. When we spoke to Digant Haria earlier today, and he said, private sector banks, large ones, will be better able to use AI tools, personalized banking. So between private and PSU, with AI coming in, he believes private sector banks will be better able to capture that opportunity in terms of growth. We'll slip into a very short break. We'll come back and continue to decode the markets on Dalal Street. You're watching Editors Roundtable.
Right, welcome back. You're watching us here on Editors Roundtable. We're still in conversation with Ashwini Agarwal. Moments left before we close the show. Ashwini, you've told us that you like BFSI. You've given us a couple of names, etc. as well. You've said that, this is the time to be greedy, not necessarily fearful, and things may look better irrespective of the near-term volatility that we may face. But during these times, there is money that goes to, places of safety as well. Pharma has historically been one of those along with IT, but IT obviously has problems of its own. Do you think pharma is likely to do well from here on?
So I think pharma, I'm quite in favor of pharma stocks, but not the mainstream pharma, because I think generic pharma is, pharmaceutical products are catching on, consumers' attention, and the premium that branded pharma companies earn will probably be on the decline. So the mainstream pharma has a couple of challenges to it. So the names that I prefer are people that have R&D led upside, or are into distributing and retailing generic products, or are into services that cater to companies outside India within the pharma
Specific names
space.
with due disclosures would be?
Like the sigilities?
For example, I own Zota Healthcare, which I believe is a disruptor in the space. Again, I'm taking the names with due disclosure that I own them, and these are not recommendations, and people should do their work before investing and so on and so forth. So that's a name that I own. Then I own a couple of research-led names, for example, Glenmark Pharmaceuticals, where you have new products under development, which can offer a huge upside. So they have to be differentiated in some way. I don't want to own the regular pharma names which are based on branded generics. There I feel a disruption might be underway. It's a long-term disruption, but a disruption nevertheless.
Ashwini, this has been such a great conversation, very helpful. Thank you so much for joining us here on Editors Roundtable. Well, with that, folks, we wrap up what's been a very tough week for the markets, a brutal fall for the benchmark indices. But we hope when we come back on Monday, we bring you better news and updates. Thank you very much for watching the show. Don't go anywhere. More on CNBC TV 18 on the other side of this break.
Good evening. Thanks for joining us on Business 360. The top stories that we're tracking for you this evening. Oil prices hover around the $100 mark after the new Iranian Supreme Leader Mujtaba Khamenei vows to keep the Strait of Hormuz closed. The U.S. issues a 30-day waiver for the purchase of Russian oil currently stranded at sea. U.S. Treasury Secretary calls it a move to stabilize global energy markets. Explosions rock Dubai and other parts of the Gulf. 2 expat workers killed in drone strikes in Oman. Saudi Arabia shoots down multiple drones. 1 French soldier is killed, several wounded in Iraq. President Trump ridicules Iran's leaders as deranged scumbags in his words. Says it was a great honor to kill them. 4 U.S. military personnel dead after a refueling plane crashes in Iraq. Pentagon claims the loss of the aircraft is not due to hostile fire or friendly fire. India's External Affairs Minister Jaishankar speaks to his Iranian counterpart for the 4th time since the war. This comes after Prime Minister Modi spoke with Iran's president, expressing deep concern over the loss of civilian lives. No official word yet on Iran assuring safe passage for Indian ships to sail through the Strait of Hormuz. The Sensex and the Nifty declined 5% this week, marking the worst 5-day fall in 4 years. All sectoral indices closed in the red. 29 lakh crore rupees in market cap wiped out since the start of the Gulf War. The rupee sinks to yet another record low against the dollar. The rupee is weakened by more than 1% in the last 2 weeks. All Asian currencies declined against the dollar. The US launches fresh probes against India and 59 other economies under Section 301 over alleged forced labor trade practices. This comes a day after US initiated another investigation on India, China, and 14 other trading partners as the Trump administration moves to reimpose the tariff struck down by the Supreme Court. Pharma major Bayer is aiming to make India one of the company's top markets by 2030, says the global CEO Bill Anderson. Adds Bayer is investing in consumer health, pharma and crop science divisions in India. That's an exclusive. Adobe CEO Shantanu Narayan is set to step down after 18 years at the helm. He will stay on as chairman of the board. Microsoft CEO Satya Nadella calls Narayan's tenure a legendary run. India records the first heat wave of 2026. Temperature crosses 40 degrees across some parts of Gujarat, western Rajasthan, Vidarbha, Madhya Pradesh and Marathwada. Let's go straight to the top story this evening. Explosions continue to rock the Gulf and Iran as the war in West Asia has now entered day 14. Let's start with the airstrikes that shook Iran's capital, Tehran, as the Israel army launched a new wave of strikes. Tel Aviv has claimed it hit missile production and storage sites. Iranian media has claimed that residential areas have been hit. Meanwhile, explosions were reported across the Gulf as well. Dubai was targeted yet again as a blaze covered the city's industrial area with a thick cloud of smoke. Debris from intercepted drones hit buildings close to the Dubai International Financial Center, causing minor damage. Iran also continued to target ports across the Gulf. Oman's port of Salah was hit by airstrikes that targeted fuel storage facilities overnight, while drones aimed at Oman's industrial complex killed 2 expat workers. In Saudi Arabia, they've shot down multiple drones. Alerts were issued in Bahrain and Kuwait as well. Ships across the Gulf, especially those near Iraqi territorial waters, were also targeted. The attacked ships and boats had loaded fuel cargoes in Iraq late night. Around 16 vessels have come under attack in the Gulf since the start of the West Asia conflict. The U.S. has confirmed that 4 of the 6 crew members on board a U.S. military refueling plane crashed in western Iraq yesterday, and they have now died. The U.S. Central Command has ruled out a hostile or friendly fire as the cause for the crash. Back home in India, External Affairs Minister S. Jaishankar has spoken to his Iranian counterpart for the 4th time since the start of the war. This comes after Prime Minister Modi spoke to Iranian president and expressed concern over the loss of civilian lives. In a statement, the Prime Minister said that the undisturbed transit of goods and energy remains India's top priority. There is no official word yet on Iran assuring safe passage for Indian ships or for ships bound to India via the Strait of Hormuz. Oil prices hovering around the $100 mark after the new Iranian Supreme Leader Mujtaba Khamenei vowed to keep the Strait of Hormuz closed. The U.S. has now issued a 30-day waiver for the purchase of Russian oil currently stranded at sea. This is now not just specific to India, but it's a general waiver. Russia has said it has nearly 100 million barrels of oil currently in transit. The U.S. Treasury Secretary has called it a move to stabilize global energy markets. Meanwhile, U.S. President Donald Trump has declared that the U.S. is, and I quote, totally destroying Iran's ruling regime. In a social media post, he ridiculed Iran's leaders, calling them, and I quote, deranged scumbags. He added that it is his great honor to kill them.
The situation with Iran is moving along very rapidly. It's doing very well. Our military is unsurpassed. There's never been anything like it. Nobody's ever seen anything like it. And we're doing what has to be done. Should have been done during a 47-year period. Could have been done by a lot of different people. They chose not to do it. But they really are a nation of terror and hate. And they're paying a big price right now.
My belief that as soon as it is militarily possible, the U.S. Navy, perhaps with an international coalition, will be escorting vessels through. We have complete control of the skies and are degrading they have no Air Force. The Navy is sunk, literally and figuratively, and the munitions factories, the rebuilding capabilities for the missiles, completely degraded. So as soon as it is possible for to ensure safe passage, we will do it.
Central Dubai is currently seeing a repeated interception of projectiles, and therefore the authorities are warning that people should stay indoors. Let me just show you what really is the situation here. You can see the Burj Khalifa in my backdrop and the suburbs of Dubai as well, the central Dubai area. So first thing that happened this morning was that authorities here in Dubai confirmed that they have intercepted a projectile. Let me just read out to you the message that came in from the authorities here. The competent authorities have confirmed that a minor incident resulting from the fall of shrapnel due to an air interception is being handled on the facade of one of the buildings in central Dubai with no injuries recorded. So that's some semblance of normalcy, because there's no injury, nobody is critical, but repeatedly these projectiles are coming in, and now it looks like that Iranian drones are not just targeting UAE airport, the Dubai airport or American assets. They're also looking at targeting the economic nerve center of Dubai, something that the Gulf authorities across countries here, be it in Bahrain, because alerts were sounded in Bahrain also this morning. So in all of these countries, there is an attempt by Iran to make them the collateral damage for this war.
Well, that is our colleague Arunima there reporting from Dubai. But let's talk about the market action. And it ended low for the third straight session, closing at an 11-month low. The Nifty closing below the 23,200 mark for the first time since April 7th of 2025. The Sensex fell nearly 1,400 points today, and BSE listed companies have now raised market cap of more than 10 lakh crore rupees. So a sea of red. The Nifty Auto Index again taking it on the chin, down 3.5%. Metals down 5%, and of course the Sensex and the Nifty down 2%. In the commodity markets, the rupee also continued to underperform, and for the week, before we get to the commodity markets, let's talk about the market action for the week. We saw the Sensex and the Nifty down 5% each, posting the biggest weekly fall in nearly 4 years. So that's the picture as far as the week is concerned. All indices, look at Nifty Auto, down 10%, 7% lower on Nifty Bank, and 6% cut there on the Sensex, and 5.5% for the Nifty. All sectoral indices closing in the red. Mangalam joins us now to wrap up what has been a brutal week on the Lal Street. Mangalam.
Well, it was clearly Friday the 13th for the market, horror day and a horror week for the bulls. The Nifty Bank, the mid-cap index, all of them fell anywhere between 2.5%, and that's because crude held above that $100 per barrel mark, hitting 102 as well. And today, the rupee continued to be at a record low versus the dollar, and US futures were down nearly 150 to 200 points when the market closed today as well. All of this was because there was no clarity on the geopolitical uncertainty. The top losers today came from the metals pack, and L&T, which has been the top loser ever since the war broke out, continued to be losing, and today lost about 7% and fell below the 5 lakh crore market cap as well. Some flight to safety was seen in a couple of these consumer names like Tata Consumer, HUL, but all in all, it was a bad week. After a big decline in the previous week, this week as well, the Nifty goes with a cut of 5%. The Nifty Bank, a cut of 7%. For the Nifty, is the worst weekly performance since June 2022. For the Nifty Bank, is the worst weekly performance all the way since the COVID month of March 2020 as well. this week. The worst performing sector was the auto sector. M&M down 12%, Ashok Leyland down 12%. Look at Eicher Motors, Maruti, Bajaj Auto. All these are frontline names down anywhere between 10 to 11% as well. And in the broader markets, it was some of these EMS plays. PG Electroplast down 18%. Amber, not too different in business from PG Electroplast, down 18% as well. We had the managements join us, tell us that there could be a chance of them missing their guidance this year because of their raw material situation, the gas situation. Polycab and KEI were down 15-16% as well. Among the gainers were the ones that either who got gas or maybe benefited from that. So fertilizer companies, RCF, FACT, all of them were higher. TTK Prestige was up 16% as well. And from the start of this week to now, one standout gainer on the Nifty has been Coal India. But all in all, a bad week, a bad period so far, because we've lost nearly 29 lakh crore in market cap since the war began. And since the war began, stocks like L&T have lost 19% of their value, Indigo down 14%, oil marketing companies down anywhere between 16 to 17%.
Yes, a brutal week, brutal sell-off, 29 lakh crore rupees wiped out in market cap, as Mangalam was pointing out. Many thanks indeed. In the currency market, the rupee hitting another record low against the dollar. The currency weakened by 26 paise against the greenback. The rupee is now down more than 1% since the start of the war. It was below the 91 mark on the 27th of February, and today the rupee stands at 92.45. Fears of the LPG shortage refuse to subside across the country despite the government's assurances. From Noida to Nagpur to Bhopal and Trichy, consumers are complaining of inordinate delays in procuring refills. Several consumers we spoke to in Noida said hoarders and black marketers are demanding up to 4,000 rupees for a 900 rupee cylinder. Government's LPG rationing has hit food services at educational institutions and office campuses as well. Mumbai civic body, the BMC, also grappling with the rationing. Their canteen served only dry meals yesterday in the second half. However, services resumed in full swing today. But it's not all bad. Management at Amritsar's iconic Golden Temple has assured devotees that there are no cooking gas shortages at the temple and that food services continue without disruption. As per a report, the shrine uses around 25 LPG cylinders every day, serves over 1 lakh devotees daily. Meanwhile, sparks flew in Parliament as opposition parties questioned the government over gas supply fears and the long queues outside LPG agencies across many cities. Finance Minister Nirmala Sitharaman proposed an economic stabilization fund to provide fiscal room.
Higher prices for LPG means we go back to the traditional methods of firewood or chulas, and we can have so many speeches of the Prime Minister talking about the great LPG spread. Look at the exports. Manufacturing growth has fallen. Sir, so the thought today is, sir, we are lions in India. We are tigers in India. Please stop listening to irrelevant and be guided by irrelevant Donald Ducks. Thank you, sir.
Sir, it's important for us to also recognize that we have announced 57,381.84 crores for Economic Stabilization Fund. Sir, it's an irony that even when I'm talking about how the government is preparing for ourselves to face any unexpected events, inclusive of supply chain disruption, inclusive of LPG, they're not willing to hear the reply. They want to have their own agenda. चलाओ, सड़क पर, सीढ़ियों पर बैठकर चाय पियो, मगर LPG के ऊपर चक्कर चलाओ. ये है हमारी ऑपोजिशन.
बहुत परेशान किया भाई. 3 दिन हो गए हम लोगों को चक्कर लगाने.
Uproar, anguish, panic continues as LPG supplies continue to remain in shortage. People are standing in queues for days. They have made their booking as way back as 10 days earlier and still have not got their one precious cylinder so that their households can run properly. In many of the cases, people are trying to resort to buy those cylinders through the black market. They are paying as high as 4,000 rupees per cylinder. पिछले कुछ दिनों गाड़ी आ रही थी नहीं आ रही थी?
पिछले 1-2 दिन नहीं आई थी.
1-2 दिन नहीं आई थी. तो आज कितने सिलेंडर आए हैं?
आज पूरे 450 सिलेंडर हैं.
कितने दिनों से किल्लत है?
किल्लत तो अभी जो 2-4-5 दिन से हुई, ज़्यादा से 3 दिन से नहीं हुई बहन मेरी. जो बात है, बाकी जो बात है, इतनी किल्लत कभी जिंदगी में नहीं देखी जो किल्लत आज की डेट में देखनी पड़ रही है.
कितने में 4,000
में कर लिया हमने बड़ा वाला सिलेंडर ब्लैक में भारत का.
बाकी अब खुला वाला 350 में दे रहे हैं।
तो 4000 का सिलेंडर वैसे कितने में मिलता था?
वैसे 930 का, किताब का मिल रहा है 910 का। 910 का।
कितने दिन में मिला सिलेंडर?
2 दिन में सिलेंडर मिला है भाई।
कितने घंटे खड़े रहे?
कल हम 5 घंटे खड़े रहे थे, आज हम 4 घंटे खड़े हुए थे।
ब्लैक में तो बहुत महंगा मिल रहा है, 2,500-3 हज़ार का मिल रहा है।
और क्या कह रहे हैं कि ब्लैक में तुरंत ले लो?
हाँ, ब्लैक में तुरंत ले लो। ब्लैक में तो पैसा दो तुरंत लो, यही वाला माल चल रहा है।
Well, black marketers are at play at this point in time. The LPG situation continues to be challenging across the country. We'll head into a break, but up next, Adobe CEO Shantanu Narayan is set to step down after 18 years at the helm. That and more when we get back. Now, the US government has launched a fresh trade investigation under Section 301 against 60 economies, including India, over alleged forced labor trade practices. Now, this comes a day after the Trump administration launched a probe into alleged unfair trade practices by India, China, EU and 13 other trading partners. The move is aimed at replacing Trump's so-called reciprocal tariffs, which were ruled illegal by the US Supreme Court. US Ambassador to India Sergio Gore says the White House expects New Delhi and other partners to honour the trade agreements reached with Washington. Speaking at the India Day conclave, Gore said, and I quote, "The US expects countries we have made deals with to honour those deals," end of quote. He also said that US and India are close to signing a critical minerals agreement soon. Remember, India has not yet inked that agreement with the US. The big newsmaker today, multinational pharma giant Bayer is making India one of its top markets by 2030. That's the aspiration. Bayer's global CEO spoke exclusively to CNBC TV 18 and said the company is investing in all three of its verticals in India and expects strong growth from next year.
India is not in the top markets today, but it's certainly our every intention that it will be. And I'm not talking about in, by the way, 2047. Those goals, I'm amazed, and I believe India can do this. I've seen, you know, the progress you've made. I think this can be reality, but we want India to be a top country for us, like by 2030. Not 2047. And so that's why we're investing. We're investing in technology here in Bangalore, but we're investing in manufacturing, R&D, commercial operations, and we're investing in our customers.
Well, that's the Bayer global CEO here in India about their plans. And speaking of global CEOs, Adobe CEO Shantanu Narayan is set to step down after 18 years at the helm. He will stay on as chairman of the board. The company said Narayan will transition from the CEO role after a successor is appointed. Rachna joins us now with more details. Rachna, it's been a big run for Shantanu Narayan, 18 years as a non-founder CEO of a large US tech company.
That is correct. One of Silicon Valley's longest-serving tech leaders is now preparing to step aside. After 18 years as the CEO, Shantanu Narayan will transition out of the top job at Adobe once a successor is named. He will remain the chair of the board, leaving behind a company that he fundamentally transformed. Narayan was born in Hyderabad in 1963. His father ran a plastics business while his mother taught American literature. He studied at Hyderabad Public School, the same institution that later produced other global leaders, including Microsoft Satya Nadella, along with several others. After engineering at Osmania University in Hyderabad, Narayan moved to the United States, earning a master's degree in computer science and later an MBA from UC Berkeley. Early roles at Apple and Silicon Graphics, along with a startup of his own, came before he joined Adobe in 1998. 9 years later, he became the CEO, overseeing one of the most consequential pivots in modern software. Under Narayan, Adobe moved from selling box software licenses to a subscription model built around Creative Cloud. This was a shift that later became the template for the entire SaaS industry. During his tenure, Adobe's workforce grew from about 3,000 employees to more than 30,000, while revenue expanded from under $1 billion to over $25 billion. He also pushed Adobe deeper into enterprise software, anchored by the $1.8 billion acquisition of Omniture in 2009, which built its digital marketing and analytics business. But his later years also saw the deal that got away. Adobe's planned $20 billion acquisition of design platform Figma collapsed in 2023 after regulatory opposition, forcing the company to pay a $1 billion breakup fee. AI is now the next test for Adobe. Narayan has described AI as the start of a golden age of design, with tools like Firefly meant to assist creators rather than replace them. Adobe trained the models on licensed and public domain content to offer what it calls commercially safe AI for enterprise users. Even so, investors remain cautious as Gen AI reshapes the creative economy. Microsoft CEO Satya Nadella called Narayan's tenure a legendary run. The two also share another connection. Both studied at Hyderabad Public School, as I mentioned, but now are investors in Major League Cricket in the United States, backing the Seattle Orcas franchise. Dylan Field, co-founder of Figma, the same company that they failed to acquire, described Narayan as thoughtful, kind and relentless in his pursuit of Adobe's vision. Narayan will remain chairman while Adobe begins the search for its next CEO, with the board expected to look both internally and externally for his successor.
Well, Rachna, many thanks for joining us. And I have had the privilege of interviewing Shantanu Narayan for many, many years. We will, of course, try and bring you excerpts of that conversation. With that, it is time for us to wrap up this edition of Business 360. Stay tuned to CNBC TV 18. We'll be back with more.
Let's talk money.
Thank you for joining us on another edition of Let's Talk Money. I'm your host, Rupee Upadhyay. Absolute topsy-turvy in markets. Now you'll say, what's new? What's new is the fact that most of us have not lived through a full-blown war in the Middle East. It's led to its own share of problems. We've woken up to mornings when crude oil prices surged 25% in a single day, only to then drop 10-15%. Asset classes are getting whipsawed. Markets are turning very, very confusing. And of course, economists are raising big question marks on what all of this means for India's macros. So in this environment where markets are getting more complicated than perhaps ever before, how do we ensure that there is some semblance of sanity and balance in our portfolios? Now, the day the markets tanked big time, you must have heard a lot of experts say that, okay, don't bother about individual stocks, just go and buy a Nifty 50 fund or buy a Nifty 100 fund or buy a mid-cap fund. And that's where the debate around passives comes right back into sharp limelight. Passive funds have anyway been really growing in size and scale and their prominence in the Indian investing landscape. So what do we need to keep in mind as we start integrating these funds in our portfolio? That's what we're going to talk about on the show. And my guests today on the show, of course, look at passives in a very, very, close fashion. Mohit Gang, who is CEO and co-founder of Moneyfront, is one of the early proponents of passives. He's always said, please put some passives in your portfolio. And we also have with us Vandana Trivedi, who is head of the institutional business at Axis Mutual Fund, and she heads the passive business at Axis AMC as well. So Vandana and Mohit, thank you so much for joining in. I was anyway looking for an excuse to do a conversation on passives because I think that's really the way forward, right, for our market. And then this volatility happened. And I kid you not, I said, we have to get both of you on the show because on Monday, earlier this week, almost every single analyst worth their salt was saying, listen, just don't bother, just buy a Nifty fund, just buy a, overall broad market fund right now. So let's start right there. It's not been easy, Vandana, for investors. They're trying to be patient. But every quarter is throwing up one new challenge, one new surprise. So your opening thoughts on how markets just have been.
Okay, markets have been exceedingly choppy. I mean, I think I'm just doing this for a repetition. No questions about it, no doubt about it. However, it's useful to look at markets from a overall holistic 30,000 feet kind of a view and then try and overlay what your thoughts are and what your investment options should be. So what do you think about markets? Markets are uncertain. I do not think any of us know which way markets are headed in the near term. And obviously none of us know, neither Trump knows when he's going to end that war there, which is leading to the more near-term volatility. So yeah, the answer to the question is we do not know what's happening to the markets.
Yeah, no, absolutely. And I think that's the most honest answer that one can give. Mohit, I'm being very honest, and I know that your reply is going to kind of put some sanity in most of the people out there because I'm telling you, it was the whole talk was, pata nahi kya kharidna hai, just buy a Nifty 50 fund right now. That's what the last, I think, 6-7 trading sessions have been about. So let's start right there. It is times of panic. This is time of fear and panic. So what should we remember as investors, 101?
Yeah. Surabhi, look, I think as you rightly said, जब पता नहीं क्या होगा या पता नहीं क्या खरीदना है, then just go and buy the averages out there, buy the index, and just forget about structuring your thoughts, structuring the right sector, right allocation, right market cap, everything, right? Because markets have given you a fantastic dip, right? And time in and time out again, we have seen wars, we have seen pandemics, we have seen all kinds of events, we have seen global financial crisis, right? So investors recall those events that these are all short-lived. And when you know that these are short-lived, it can be 1 month, it can be 3 months. The definition of short-lived can vary. But these are interesting dips and you're not sure what to buy at these dips because you never know which sector will be the winner in the next cycle. So the better thing and the best thing to do in these kind of scenarios is just go and buy the averages, buy the index and stay put.
So therefore that raises the question that are passive funds, and I always do this for the benefit of investors who are still new to passives. Basic difference in an active fund, there's a human being, there's a human fund manager who's actively selecting and picking stocks or other securities. They could be fixed income securities, it could be commodities, but active selection is going on by a human figure. Whereas in passive funds, a passive fund will track an underlying index. It's rules-based investing with no or very minimal human intervention. That's what passive, that's why the name passive. It's not active, it's passive by nature. So now the question to both of you really, that then are passive funds sort of stabilizers in a volatile market? Is that the way to look at it?
Okay, so look, from our perspective, I think we're very clear that passive is like the core kind of your portfolio, basically 40 to 60% of your portfolio, depending on how you're shaped, what's your risk appetite, what's your time horizon and other things. We'll have to keep that in consideration. But 40 to 60% of your portfolio is passive, which gives you the market beta, which helps you sail with the market and just kind of flow with the market. The remaining 30% kind of an allocation is more like a tactical thing where you're chasing that elusive alpha, which is elusive in Indian markets, and I think we can debate more about that. But yes, that is somewhere where you bet your extra money and try and see if you can really capture that alpha, and the remaining 10-20% could be your commodities allocation or could be your some other allocations depending on. But that's how we typically try and layer our portfolios, and we still think passives has to be the core because it's a more long-term strategy, 15-20 year kind of a cycle which we're playing for.
You know, I'm smiling because I'm just remembering my first conversation on passive funds, which probably happened about 10 years ago, where one expert who came on an earlier show at that point in time did it the reverse way, core and satellite. At that time, active funds had to be your core.
Absolutely.
Passives, naya product hai, market mein aaya, let's see how it goes. We'll add a little bit of passive on the side of the plate. And now what Mohit is saying is a complete, reversal in just the approach, the active versus passive, or the active and passive approach. Vandana, how do you look at it?
So I'd like to pitch passive in these uncertain times, in a little more structured way to reason as to why passives, right? What does passives offer to you? To the investor, it offers predictability in the sense that you're not having to figure out which sector will do well, which stock will do well. Predominantly, you're buying market weighted indices, right? So in a market where you're unable to predict what's going to happen to the world, passives is a great way or a great spot to be in, right? It addresses that issue. The second thing is participation. Passives offers you participation in the complete market, in the complete index, whereas active does not offer you that. Active becomes selective. You are not ensured of complete participation in the index in the active space, but passives offers you that. And if you look at, I mean, obviously there have been various crises through which markets have gone through. One would immediately think about COVID, one would think about the GFC. But if we were to zoom back on some of the recent other geopolitical issues that we've seen, one is the Russia-Ukraine war, which unfolded in 22. Then you had the Israel-Hamas conflict. All of Israel-Hamas seems regional, but then has implications from an oil standpoint, etc. Now, in both of these conflicts, there was an intense and immediate drawdown. Basically, the markets wobbled in response to those when the news broke out, right? But the recovery was immediate. Now, an active fund manager may not be able to participate in that recovery. So one is lack of predictability. Second is you're able to participate in the entire market in a scenario when you do not know when and how quickly the recovery is going to unfold. Third, obviously, is cost. An active fund manager is having to generate alpha, not just to beat benchmarks, but also to recover costs. And passives just has to not worry much about costs. Lastly, obviously, you mentioned that point, human versus non-human. There are behavioral biases, clearly, and there could be tactical calls. I mean, I'm not really saying fund managers are committing mistakes, but a human being in the process inherently is vulnerable to these biases, which passives completely eliminates. So in moments like these, where everything around you is uncertain, it is difficult to call the markets. Passives is the great place to execute your asset class view.
I think the one guarantee, and there are no guarantees in life, but at least with passive funds is one guarantee, you will get at least as much return as the index. What the index will do, your fund will do. So that's one headache out of the way. The only reason to take additional headache of picking funds and backing a human fund manager and the right fund manager is to get so-called alpha, the outperformance. The fund has to perform better than the index for us to pay more for it, for us to go through the whole process of fund selection. And on there, it's an eternal ongoing debate, right? The active versus passive debate. Mohit, what are the latest numbers saying? I haven't seen the latest SPIVA scorecard, but that report that SPIVA always puts out always shows massive underperformance of active funds. But I know you look at all kinds of data. So where are we at?
Look, I think it depends on what kind of time frame we are selecting. If we were to take a time frame of, let's say, last 1 to 3 years, then almost 65 to 75% of the funds are underperforming the indices. If we were to look at a slightly longish time frame, let's say around 5 odd years, then perhaps around, I would say, 75, a little lesser than that number, maybe 85 to 90% actually, underperform in a 5-year cycle. If you take a 10-year cycle, which is where the passives were not so popular, then the number is a little smaller in terms of underperformance, and that number is around 70 to 75% of the funds underperforming the indices. If I were to just look at last year data, Surbi, and it's a case in point, 2025, I think there were only 2 active funds in the large cap category which were able to beat the index, which is Nifty 50 index. On a BSE 100 level, I think 35% of the large cap funds did beat BSE 100. And similarly, if you go down the curve, let's say on the mid cap and the small cap side, the number of funds outperforming the index is a little higher. And that's been a repetitive story, barring few aberrative years like 2024 or 23, when the whole market was like going berserk. That's the time when actually actives were doing great across the line, across the segments.
In a bull market, I think most active funds, or a large proportion of active funds, tend to do better. Is that a right projection or generalization?
Shall I?
Yeah, please. Yeah.
I'm not sure about that. So, just one fundamental principle to support why I'm saying I'm not sure about it is that usually the bulk of the market returns is coming in from a few stocks. By few, so, if you look at numbers for the Indian markets, you will see that not more than 100 stocks, the top out of Nifty 500 are actually contributing to more than 90% of the returns, which means that 400 stocks in the portfolio are doing nothing to contributing negatively to returns, right? Which means that there is a kind of a concentration in terms of the contribution of fewer number of stocks to overall market returns, and this is over 10-year returns. This is not near term, right? Which essentially means that that gets captured in market cap weighted indices, which is like Mohit has been alluding to, Nifty 50 indices, Nifty 100 indices, Nifty mid cap, etc. Right? So and that's probably the reason why over longer periods of time you've seen passives actually outperform actives, and over longer periods of time you're actually seeing, I will not call bull and bear markets, because bull and bear markets usually stay persistent for at least a decade or more. But you've seen all kinds of cycles over a 10-year time frame, right? So that may be the reason why passives is outperforming, besides the routine reasons that we're aware of, like cost, no human bias, and all of that, right? To kind of just take forward Mohit's response to this, see, if you were to look at the last again, you look at 1 year, 3 years, 5 years, 10 years. In the large cap space, in the Indian context, I mean, the global context is very familiar to everyone that passives have beat actives. But in the Indian context, passives have been able to beat large cap significantly, consistently over the last last 1 year, like Mohit pointed out, has been pronounced in terms of outperformance of passives. But this is true for 3 years, 5 years, 10 years, etc. Right? Even selectively in the mid cap space especially, again the outperformance is getting pronounced. Again, over the last, say, 3 years, you want to look at the last 10 years, you've seen that passive mid cap indices have actually done better than active mid cap indices. In the small cap space, the active guys have held on. Right? Even over longer periods of time or shorter periods of time. When I say the active guys have held on, what I mean is that the majority of the fund managers have beaten the
index in the small cap space.
But very interestingly, and good for investors, the flexi cap category, right, of funds, which is even this year seen the maximum flows in the active space. Now, that category fund managers have proven time and again that they've done better than the benchmark index, which is the Nifty 500. So the story is the large cap, the mid cap, passives in India seems to have proven outperformance. Other segments, the jury is still out.
Okay, well, I think what this tells us is that as investors, we need to have both. We need the brilliance of active fund managers who are here in India, and we definitely need to ensure ourselves and our portfolios with the right kind of passive funds. Now, which are these right kind of passive funds? That's what we'll discuss after the break.
Let's talk money. Money.
Welcome back. You're with us on Let's Talk Money. And this week we are discussing why passive funds are becoming more and more important to have in your portfolio along with active funds. The markets are confusing, the markets are volatile, and passives allow you a very simple, low-cost way of playing the broad market. Now the question is, that's established on the overall set. But within passives, what should we keep our eye on? That's the point. That's what we're discussing with both Vandana and with Mohit. So Vandana, I know, you're like the mother who has all the children, right? Because you're heading the entire passive space at Axis. But still, I mean, from an investor perspective, if I ask you to, become the advisor to friends and family, sure. I'm sure you get asked this question. Which passive funds should Indian investors must have in their portfolios? Because you have passives on the fixed income side, you have passives on equity. Right. Obviously, you have gold and silver ETFs, which have been in very high demand. So.
Sure. Thanks for this question, Surabhi. I think that, I'm assuming that asset allocation decision has been taken care of because that's the first step. And once you determine what your asset allocation decision is, now you come to equities. Now, within equities, I think that it's very, very important to execute your large cap portfolio via the index route. That would be a no-brainer from my side. So if you, the large cap allocation, large cap equity allocation in your portfolio is best executed via the index funds route, which essentially means that depending on the risk profile, etc., roughly about 40 to 50% of your portfolio is a part of your core portfolio, if we can call it that. Just fill it, shut it, and let the market take its course.
Oh, voila, we have agreement with both our panelists. They're saying the same thing, that the big chunk, the core chunk of your portfolio, which is steady, supposed to be stable, large cap stocks, play that through passive. So got it. That's point number one.
And keep your eyes open for the mid-cap space as well for passives is what I'd say. Data is increasingly in the Indian context supporting passive vehicle for mid-cap allocations. Large cap played the way you want, small cap, played the way you want to, flexi caps again, played the way you want to. So small cap, flexi cap, thematic should form the satellite part of your portfolio. And all of these are, in my opinion, best executed via the active route, provided you have an advisor or you're able to pick up for yourself the right fund managers, right? Bonds have to find a place in investors' portfolio. I know they are tax inefficient. However, they are an yield generating asset, right? First you have returns and then you have taxes on those returns. So target maturity funds are a great way to add to fixed income allocations, again via the passives route. Finally, commodity for various reasons, for hedging purposes, to beat inflation, gold ETFs is a good addition to the portfolio. Depending on your risk profile, you split it up as 10 to 15% of the overall allocation. So that's broadly it. Equity, fixed income, and commodity, gold, fixed income, commodity, and large cap equity done through passives, the rest done through actives.
Okay, all right, great. That's a that's a comprehensive breakup. Now, Mohit, let me add a layer of reality to this. In the real world, say if someone is starting afresh today, making a new portfolio, or let's say has 5, 7, 10 lakh rupees, and they really want to start complete fresh allocation with the right asset allocation and the right products, then how would you create that portfolio for this individual?
Okay, yeah.
So therefore, you have to add gold as well at some point. That's why I made it tricky.
All right. Look, I think it's absolutely clear, Surabhi, that the alpha in Indian markets is shifting down the market cap curve, right? So you have to go down the market cap curve if you really want to get some alpha in your portfolio. On the top end of the market cap curve, it has to be passive. So your first inclusion is a Nifty 50 or a Nifty Next 50 index funds. If you don't want both, then perhaps a Nifty 100. I would prefer both of them individually in a portfolio. That's your large cap allocation. On the mid cap side, it's a combination of active and passive both, right? And a passive can be of two kinds. It could be a plain vanilla Nifty Midcap 150 index, or it could be a factor-based index where you kind of play a factor on midcap index, which could be a momentum or a quality factor. I'll go with the quality factor for the time being in the current market environment to play the midcap index. And again, if you want to keep it very simple, play the plain Jack Nifty Midcap 150 index fund and complement it with one active strategy. So that's your midcap basket. Small cap.
I just want to add a quick explanation for viewers who must be wondering what is this factor that Mohit is talking about. That basically, I mean, these are funds which will play the entire Nifty Midcap 150, but they'll put a filter. They'll filter out stocks based on one or the other criteria. In this case, Mohit has gone with the quality criteria. Just in case you're wondering, what are these factor-based funds? And then after
Small
that?
cap, absolutely clear. Go with active allocations as of now. And it could be 1 or 2 funds. I think 1 fund suffices. But again, depends on the investors. You can have a combination of 2 smaller AUM, small cap funds out there, right? And then you complement it with a flexi cap or a multi cap. And these are all active allocations, definitely. And on the commodity side, there is absolutely no choice. But you have to have, as of now, I think we have repeated that in your shows. We're kind of bullish on gold, but not so much on silver. So we go with a gold fund of funds or a gold ETF, whatever the investor would prefer on that count, right? So my final thought on this one is, and I recall these lines from a famous movie Maqbool, right? It says that संसार में शक्ति का संतुलन बनाए रखना बहुत ज़रूरी है. तो आग को हमेशा पानी का डर रहना चाहिए. That's why the active guys in India need to have some fear in the mind, right? For a very long while, they didn't have that fear. The global scenario is changing. 55% of US assets is passive. 35% of European assets is passive. Almost 30% of Japanese assets is passive. In India, it is just 16 to 18% right now. So you need that fear in mind of active managers to be constantly able to chase that elusive alpha and to do or deliver a little better, because for a long while we are now having this bout of underperformance on certain segments and certain market cap curves where we haven't seen that great outperformance, right?
I want you to repeat the line. I hadn't heard it before, but what a way to put it. Yeah, once again, please, Mohit.
So it's from movie Maqbool. It says that संसार में शक्ति का संतुलन बनाए रखना बहुत जरूरी है. तो आग को हमेशा पानी का डर बना रहना चाहिए.
Wow.
Right?
Okay.
So it can't.
well said. Vandana, last word. Last word with the lady. Your advice to investors, first-time passive investors, what should they keep in mind as they navigate markets which have become very complex and volatile?
Yeah, I think the only thing that investors need to keep in mind is that have faith on the markets, have faith on the India growth story. The markets are just replicating the India growth story. You will have these periods of volatility, the bouts of volatility. Save up some money to invest some more in these periods. Markets have this tendency to wobble at the first instance of a bad news, and it just requires some kind of a semblance of stability or even message of stability to come by for the markets to recover. Yesterday someone said that one US Navy ship was able to transit the Strait of Hormuz without any trouble, and you saw oil prices crash from 117 to I think about a late 80 kind of dollars. So you know,
and then they had an oops moment. They said, no, sorry, wrong information.
So you see the futility of these near-term, unstable periods, right? So you just need to have the faith and keep at it. Do not panic. Do not indulge either in greed or fear, and use passives to build a core part of your investment portfolio.
I think that is the most solid and most clear takeaway from this conversation, that whatever happens, markets will go up and down, but you build the core part of the bulk of your portfolio on passives. That's a great low-cost way of investing for the medium to long term. Thank you so much. Fantastic conversation, Vandana and Mohit.
Thank you.
Thank you for all the clarity that you've provided to our viewers today.
Thank you.
Thank you so much.
Thanks.
All right, well, with that, we take your leave on this edition of Let's Talk Money, but keep it with us and keep telling us what more you would want us to discuss. We'll see you with another theme next week.
Let's talk money.
Hello and welcome to Business 360. This, of course, is one of the key stories that we have been tracking. This is one aspect that is playing out as we speak, the conflict in West Asia. Many Asian nations are reeling from the cascading impact of this conflict. South Korea is one of them. Seoul has revived a 3 decades-old policy it never expected to use, imposing a cap on fuel prices effective today to check the spike in oil. With 70% of its oil coming in from West Asia, the move is aimed at giving relief to consumers. Now, speaking with me, Korean Trade Minister Yo Han-koo details the impact of this conflict, reacts to the US deployment of THAAD from Korea to the Gulf, and speaks about his India visit, including upcoming talks with Commerce Minister Piyush Goyal, which will focus on diversifying and deepening India-Korea ties. Listen in.
I think this global trading system is really undergoing generational shift, and then Korea is really the trading nation, and also India. I see India is very impressive. India has recently concluded a lot of very interesting trade deal with major economies, EU, United States, and many other countries. But when we just zoom in on our bilateral relation, as you mentioned, we have this 16-year-old kind of SEPA framework. And I don't have to repeat how radically our trading environment has changed. And you mentioned $25 billion trade volume. And I think we really underutilizing our great potential because Korea is a manufacturing powerhouse, semiconductor, shipbuilding, battery, automobiles, etc. And I think India is also, really emerging as a new, power in this manufacturing sector. And already many Korean companies have invested in automobile and electronics and steel, etc. And I see there's a really great potential we can tap if we just kind of upgrade our bilateral, trade investment the framework. So I'm really looking forward to sitting down with Minister Goyal and then really brainstorm how we could really seize this great potential that we have.
You talk of this potential. Any number that you'd like to put to it that by the end of 2030, what this should look like to justify the potential between the two countries?
I think the bigger the better, and I think we can do it. We can do it, and especially I see India is very well positioned strategically in this very uncertain and economically as well as geopolitically. It's right now one of the really mantra of many Korean companies is to really how to diversify, because we live in a extremely uncertain and then rapidly kind of a changing world. And right, I mean, so far Korean companies have heavily invested in China, for example, and then Southeast Asian countries. And as I said, there are many Korean companies who have invested in India already, but there are more Korean companies really interested in investing more in India. But they don't know well the India market yet, and they are uncertain how they could navigate this kind of regulatory system in India, and how to kind of find potential partners in India. So I think there's a great room for both government can do to help and also facilitate this kind of great potential existing in our private sector. Yeah.
There's great interest here in India on semiconductor, on AI. Are these some areas where Korean companies are looking at working with Indian partners in India here?
Yeah, absolutely. I think, this AI digital sector, I think we are very complementary. India is really well known for, super these engineers, software, this capability. On the other hand, Korea is really strong in this hardware, especially the semiconductor, HBM, high kind of memory chips. So I think there's a great complementarity between our two countries. And also, for example, automobile sector, we have, Hyundai, Kia, who have invested from long time ago in India. They are planning to expand their production facility in India. In fact, I think I understand that they are number 2 in terms of export figure, as this foreign the manufacturing companies. And I think sooner or later they kind of aim to reach about 1 million production in India. So I think our supply chains are already very well intertwined and interconnected in these key sectors, automobile. And automobile becomes highly digitalized, and AI would be really play an important role in this automotive sector as well. So I think we really need to work together to really create synergy.
Any number that you'd like to put? You talked about investments sitting on the sidelines. Any number in terms of investments that could potentially unravel from Korea towards India in the next few years?
I think, I think, as I said, I think there is a great potential.
Higher the better.
Yeah, the higher the better. But I think at least about $16 billion of investment in this kind of, shipbuilding, automobile, steel, and AI. I mean, this the contents, the software area. Those are some of the, I think, investment figures that I think we can envisage. But I think it could go much bigger, depending on how we lay the strong foundation for this, the trade and investment framework between our two countries.
Let's talk challenges and uncertainties. We're seeing a conflict play out even as we speak in West Asia. I just want to get a sense, when you're looking at it from a trade perspective, what to your mind is the best case scenario and what to your mind is the worst case scenario, the way it could pan out in West Asia?
Yeah, I think this Middle East, especially the Hormuz Strait, is a very critical choke point for many Asian countries. For Korea, we import more than 90% of our energy from overseas market, and about 70% of our crude oil pass through this Hormuz Strait. About 20-something percent of LNG, pass through this Hormuz. So if there's a big kind of contingency in the region, I think the ripple effect could be enormous, not just for Korea, but for many Asian countries. So I think the best case scenario is to really bring peace and stability into this region as soon as possible. But we need to prepare for a lot of different scenarios. And the Korea also, as you mentioned, we recently introduced this price cap on this domestic, this oil, gas, price, and we need some sort of kind of international cooperation. So I think we need to discuss this strategic, the reserve, that how to kind of, to manage this contingency situation with this strategic, the result, if necessary. And there needs to be a really close coordination among these like-minded countries in this difficult time.
One additional impact that the crisis appears to be having is on shipping. Shipping, insurance, those costs have gone up. A lot of markets are beyond reach, have become logistically unfeasible. Just want to get a sense, how are you looking at it in terms of concerns and challenges that you're facing for, again, Korea is a highly export-dominated country. How is that affecting you? And does India come in anywhere as in the matrix where the two countries can perhaps play a hedge towards each other to compensate for the uncertainty?
Yeah, I think that's a good idea. I think Korea and India need to also explore ways in which our two countries can really kind of weather this the storm together. Korea is a trading nation, and in fact, the portion of our export to the Middle East out of the total export is about 3% or so. So just number-wise, it may not be big, but for example, shipping, the price, etc., it start with this hike, price hike in this route first, but then it just kind of contaminate, to other region. So a few days ago, I also had a kind of emergency meeting with our companies, and they were very worried about this, the shipping kind of blockage And so some of these ships are on waters right now, and they don't know where to to unload their containers and etc. So I think we need to work together.
We've seen reports where US, which is a close ally, having to redeploy certain defense systems, THAAD missile defense systems, Patriot missile defense systems. How much concern has that caused in terms of making South Korea vulnerable? Is there concern that has been expressed to the United States, and what can be done to address that?
I'm not a defense minister, so I'm not in a authoritative position to say about these issues. But basically, Korea is still kind of divided nation, and the national security, and this is a key importance for us. This kind of the contingency situation in other region could have any in any time it could have any this impact on the other regions, including the Korean Peninsula. So we are on alert, and hope that the world could just bring this situation to real sustainable peace as soon as possible.
Well, with that, it's time now for a short break. But coming up on the other side, Israel has launched a fresh wave of strikes on Iran and expanded its operations against Hezbollah in Lebanon, while explosions rocked Dubai and other parts of the Gulf. 2 expats killed in drone strikes in Oman. We discuss that and lots more on the other side. Welcome back. Now let's shift our focus to the latest developments in West Asia. Israel has launched a fresh wave of strikes on Iran and expanded its operations against Hezbollah in Lebanon. Explosions also rocked Dubai and other parts of the Gulf. 2 foreign nationals have been killed in drone strikes in Oman, while 1 French soldier died and several others were wounded in drone attacks in Iraq. Saudi forces intercepted a drone targeting Riyadh's diplomatic quarter. Meanwhile, U.S. Central Command is carrying out rescue efforts after it lost a military refueling aircraft in Iraq. Pentagon claimed that enemy fire is not to be blamed. 4 of 6 crew members on board the plane have been confirmed dead. US President Donald Trump ridiculed Iran's leader as deranged scumbags and said that it was a great honor to kill them. Oil prices, meanwhile, are hovering around the $100 mark after Iran's new supreme leader vowed to keep the Strait of Hormuz shut. The US has issued a 30-day waiver for countries to purchase Russian oil and petroleum products stranded at sea. Treasury Secretary Scott Bessent termed it as an attempt to stabilize global energy markets. Meanwhile, India's External Affairs Minister S. Jaishankar has spoken to his Iranian counterpart for the 4th time since the war. Prime Minister Narendra Modi too spoke to Iran's president, expressing deep concern over the loss of civilian lives. However, there is no official word yet on whether ships bound for India will be allowed to sail through the Strait of Hormuz. And well, to help us answer some of these questions, joining us now to discuss this are former Indian diplomat, Ambassador Rajiv Dogra, and Umair Anas, author and professor of international relations from Turkey. I'd like to thank both the gentlemen for taking our time to speak to us. Ambassador Dogra, let me come to you first. There has been diplomatic outreach at the prime ministership level, at the ministerial level as well, to reach out to Iranian counterparts. There's a very clear demand. There needs to be free flow of energy, of goods through the Strait of Hormuz. Now, the MEA has rejected media reports coming in from Iran that there has been a rejection of India's demand. But yet, at the same time, there is also no nod that has been granted by Iran for allowing safe passage of Indian vessels. Diplomatically, what will it cost India to secure safe passage through Hormuz?
Well, to start with, I think we should go by whatever MEA has said officially. But at a practical level, we also have to see the situation, which seems to change day by day, and not just by Iran's actions, but also by what Israel and America are doing in terms of continuation of the war, or their actions in terms of bombardment of Iranian cities, which invite retaliation from Iran. And one of the measures of retaliation is the Straits of Hormuz. The second measure is the effect on the Gulf states, where India gets directly affected, not just in terms of its NRI population, and not just in terms of its trade with the Gulf states, but also in terms of long-term effect that India would have naturally, along with other countries, if the situation continues to be uncertain as it is today. And today, the fact is that America has ignored the fundamental rule of war, that geography matters almost as much as technology. America may have all the weapons of the modern day world, but it is not close to Strait of Hormuz. Iran sits on top of Strait of Hormuz, and that is why it has decided that it will do what it wishes with regard to passage of ships through the Strait of Hormuz.
Ambassador, from the conversations that at least fell out of between the 2 foreign ministers of India as well as Iran, what has emerged through reports is that the Iran foreign minister has asked for international blocs like the BRICS to condemn the attack by Israel as well as the US. The question I want to ask is that appears to be the cost that Iran is asking for to be paid to secure passage. Can India afford to pay at the expense of its relationship with the US, with Donald Trump?
Well, that's a billion-dollar question because India is caught in the middle, quite frankly. India does not want to upset its relationship with America, nor does it want to upset its relationship with the Gulf states. But at the same time, there's a civilizational link with Iran. And the fact is that in times to come, it is quite possible that Iran may prevail and ultimately an unstable president like Trump may agree to whatever Iran demands in terms of even reparations, which is one of the demands of Iran. So where does that place India? You can't just put all your apples in the American basket and ignore a civilization like Iran, where people are very India friendly. So I think it's a tough choice for India. India has already co-sponsored a resolution in UN, which was voted yesterday, regarding, which virtually condemns Iran on its attacks on Gulf states. But Iran, on the other hand, says that we are not attacking Gulf states, we are attacking the American assets there. So it's a catch-22 situation that India finds itself in.
Right, so catch-22 situation. On that note, let's also get Mr. Anas in on this conversation. Mr. Anas, coming to you, Mujtaba Khamenei has taken over the reins in Tehran. He has the backing, the full backing and the full support of the IRGC. They're both known to be very hardline. At this point, even if Trump decides to withdraw, basis, say, the oil prices, midterm elections, whatever may be the reasons and motivations, what incentive is there for Iran or the IRGC to stop what they're doing at the Strait of Hormuz? For them, the benefit would lie, analysts suggest, towards continuing this reign of fear of blockading the Strait of Hormuz.
Nothing less than written guarantees for Iran's right to have a civilian nuclear program, as well as guarantees that Israelis and Americans will not attack Iran again. These are two main demands which Iranians have made it very clear to stop or to enter any dialogue for next ceasefire. The reason is that now Iranians have become extremely mistrustful for any diplomatic process, because this attack has been carried out right in the middle of a almost successful, almost deliverable peace process or dialogue on nuclear crisis. According to which, as many Western diplomats have also pointed out, that this deal, which was supposed to be delivered, was much better than the 2015 deal, because Iranians had agreed for almost every demand which Trump had made to Iranians. So now I don't think that Iranians have left any incentives to enter any kind of ceasefire unless there are some written guarantees. At the same time, my understanding is that Iranians would like other powers to engage in any future dialogues, including maybe it is India, China and Russia, or Turkey, any other power. But Americans and there may not be any direct dialogue between Americans and Iranians, as per my understanding.
That's in fact what Ambassador Dogra had been referring to about this being a catch-22 for India. But we're running out of time. One quick question to you, that given the fact that there is no incentive for Iran to stop what they're doing with the blockade on Hormuz, what do you make of the impact this will have on the global energy supply, on oil prices? That's the next big question that many are asking. If Iran were to continue, which it is likely to, what is the impact, what is the fallout that you see on global energy supply?
I think that Iranians are sending a clear message to the world community, and especially the countries which are dependent on energy import, that they need to do some actions to stop Americans and Israelis from these kind of attacks. I mean, my understanding is that they want India also to convince or to talk to Israelis to stop these kind of attacks on Iran. Otherwise, Iranians are, they don't have any kind of incentives, and they are going to aggressively follow whatever the objectives are left for them, including the revenge which
I'll just have to come in there for want of time. But I'd like to thank both of our panelists, including Ambassador Dogra, as well as Professor Anas, for taking out time and speaking to us. But with that, it's a wrap on this special show. Thank you so much for watching. News and updates will continue on the other side.
The world is getting harder to navigate. A conflict in West Asia that's keeping energy markets on the edge, a tariff war that is redrawing global trade, and growing pressure on both food systems and healthcare innovation. Now, right in the middle of all of this sits Bayer, a 160-year-old life sciences giant spanning crop science, pharmaceutical, and consumer health. A company that invented aspirin, dominates the seed and crop protection markets, and is currently in the middle of one of the most ambitious corporate restructurings anywhere in the world. Joining us shortly to discuss how Bayer is navigating this volatility, where the turnaround stands, and what India means to the company's next chapter is Bill Anderson, CEO at Bayer AG. Welcome to India. I was hearing all about your trip from your team. You've been in Varanasi, you've been in Delhi, you're in Bangalore, and I believe you're going back to Jaipur. What's been the highlight so far?
Oh, well, thanks, Ritu. That's a really hard question because everywhere I've been, I've seen so many amazing things. I think probably the highlight so far is when we were in Varanasi, we went to some farms outside of the city where we have our Better Life farming centers. And we've got like 1,500 of these now in India. These are farm stores that offer farmers not just choices of seeds and crop protection products, but also things like access to credit, offers them things like now we have some that are equipped with drones for pesticide applications, so the farmers don't have to go in the fields and be exposed to it. And so there, it was amazing because I met so many of these young entrepreneurs that are running these centers. And I met 3 young ladies who were all in their 20s who are running these stores now. And they said when they started the effort, people in their villages looked at them like, what are you doing? What do you know about how to do this? And now they're very successful, and they're really kind of pillars of their communities.
Let me shift focus to where the world's attention is right now, and that is very much, unfortunately, so in the Gulf region. With what's going on there and this geopolitical uncertainty that has become the nature of the game these days, how is your operational environment at Bayer getting impacted? How is it reshaping how you look at work today?
Yeah, well, first let me say, obviously, we're concerned about the events there, and we certainly pray for peace and hope for peace. We've started also making sure that we have about 500 people in that region, making sure, hey, everyone's looked after, everyone's doing fine. And then they're focused on making sure that farmers, that patients have access to the essential products that we provide. We have a mission as a company at Bayer, health for all, hunger for none. And we're in the business of providing essential products to make food and medicines. And so that's something that, it doesn't have sides. It doesn't have politics. It doesn't know borders in that sense. And so it's times like this where about 88,000 people at Bayer, 5,000 of them in India, are working full-time to make sure that we can keep those essential products flowing.
The other sort of key global event that the world's been focused on for the last couple of years has been tariffs. At Bayer, for instance, how are you getting impacted by where these conversations are growing, the best and worst case scenario that you're building for your business?
Yeah, it's a mixed picture for us. So on the one hand, we are producing in the major countries we operate in, whether that's India, US, China, EU, we're producing. And for example, seeds, take seeds. We're the world's largest provider of seeds. And seeds, they actually kind of make sense. They need to be produced in the environment they're going to be grown. So seeds for Europe are grown in Europe. Seeds for America are grown in America. Seeds for India are produced in India. So those are not much affected by tariffs. Then we have other products where it's much more efficient for us to have a single source for the world. And there we count on open borders and free trade. And so we're having to adapt some. We we're constantly making the case with governments around the world. Let's keep the trade barriers low.
Yeah.
This has been a big benefit to the economies of the world and people, and we had to work to defend that.
Take, for instance, Bayer is perhaps the only, if not the primary, manufacturer for things like glyphosate. In a market like the US, one of the largest markets in the world, does this trade barrier sort of give you an advantage over some of your peers, would you say?
Well, I think there is a certain degree to which people are starting to look, governments are looking at, hey, how dependent are we on other sources, foreign sources, for essential products?
Yeah.
And that probably makes sense. You know, major countries, India included, ought to be thinking about, how do we make sure that we've got a level of economic independence? And so it's true that we're the only producer of glyphosate in the United States, and it's a very important product. And that's gotten attention recently. But I think I think we are going to see more of this, of companies making sourcing decisions to make sure that major countries have that kind of independence.
India is both a manufacturing hub for you. It is also a huge domestic market for you. So in your vision of the larger scheme of things, how are you positioning India in Bayer's global supply chain, especially as this world order, as this trade world order is getting reorganized?
Yeah, well, India, I mean, part of the reason I'm here and spending a whole week is because, well, this is not an average country, okay? It's a massive country with huge diversity in terms of peoples, in terms of economies, and it's a very dynamic economy. The growth we've seen in recent years has been tremendous. I mean, we're here today in Bangalore because we're opening an innovation hub, and this innovation hub, it's not back office, and it's not just for India. Although we are supporting our rapidly expanding Indian operations from this hub, the work we're doing here is supporting the 88,000 people we have around the world, and I've seen some amazing results here. Whether it's we're one of the largest providers of imaging solutions, so we've got imaging R&D here in this building. We've got people working on novel applications for pharmaceutical R&D, for crop science, genetics, all here in Bangalore. So I think we're just going to see a lot more of that in the years ahead.
Interestingly, because you have this data science and analytics center that you have in Hyderabad. I read you have a GCC in Mumbai, a global business center, a digital hub, the R&D which you talked about here in Bangalore. So you're well beyond the back office as far as the India market is concerned. But are you prepared to make India a true, genuine decision maker in the overall scheme of things for Bayer, rather than just be this GCC?
Yeah, well, I'll explain in a slightly roundabout way my answer to that question. So we've been implementing at Bayer a really novel approach to management for about the last 2.5 years. We call it dynamic shared ownership. And we've taken out 2/3 of the managers across the company. By the way, they're mostly still working for the company, but they're not in management jobs. So the whole principle here is you've got to put decision-making power with the people doing the work. Large companies, they have 10 or 12 layers of management, and they think empowerment means that the CEO doesn't make all the decisions, that maybe the CEO delegates down 1 level or 2 levels. That's empowerment. The people at the bottom, they don't even notice that. Empowerment means the person doing the work makes the decisions. And so we're taking radical steps to achieve that. So we've got now people, for example, used to be managing, say, 6 people on average. The average manager at Bayer was managing 6 people. That number today is more like 16, and it's going up. And what that means is, for example, I talked to a person a couple weeks ago who's managing 107 people. Okay. So 107 people, 1 layer, and then this manager. If you're managing 107 people, you're actually not managing them. You're not controlling them. You are there to make sure that they've got the mechanisms they need to coordinate with each other, to make decisions about, hey, which products should we prioritize, which efforts should we resource. So and when you do this, you get radical speed. I mean, it's amazing. And in fact, I was just talking to a gentleman at lunch here who's responsible in setting up a field test facility for Bayer in the outskirts of Bangalore. So this is for crop science. And he said they want to set up a new testing station. That's sort of like, some land, some equipment, buildings, things. Normally, that would take 2 to 3 years. They decided we're going to do that in 3 90-day cycles.
Okay.
And they did it. They started in February last year. They opened it in September. So it actually took 8 months.
Yeah.
And this is what we're doing across Bayer. So you asked me, are we willing to put decision making in India?
Yes.
It's happening. It's not like I'm thinking, I think I'll put some decision making in India. We've created a model that's putting the decision making where the resources are, and we're significantly expanding our talent in India, and we're putting the decision making with it.
how critical, the market is for you as we speak? I mean, is it in your top 5 markets? What's the pecking order? What's your outlook on the kind of growth potential you see here? You've been here for 130 years. You have 13,000 employees. Crop science is the largest business. But what next? What's the growth engine?
Yeah. So we have 3 divisions: consumer health, crop science, and pharmaceuticals. Maybe I could just mention briefly. So in consumer health, we know that, for example, we have the leading nutrition supplement brand, Superdyne, and we have the leading headache brand, Ceridon.
Yeah.
And we know that these are household names. You know these products?
Yes, of course. I've used them.
Okay, right. However, not everybody has access to these products. And in the past, we would have said, people that have high incomes, we want to make sure they have access to our products. No, we want everyone to have access. By the way, even though these are the best known brands, they're also some of the lowest priced products. All right? And we are going to do what it takes to get these products available to everyone in India. In crop science, I gave the example of these better life farming. Here what we're doing, we're working with local entrepreneurs in now over 1,000 villages. We're going to have tens or hundreds of thousands of villages in the next few years. We're covering 30 million smallholder farmers in India today. Again, we're going past the idea of just selling seeds or selling crop protection. We want to give them a full solution. We've trained 10,000, they're called drone Didis. Okay, these are mostly young women who've been trained as drone pilots, and they can cover a smallholder farm. Typical here would be about a hectare. They can cover a hectare in 30 minutes with a drone that would take 1 to 2 days for a person with a manual sprayer. But these drones are affordable. And think about it this way: not every farmer is going to have a drone. They don't need it. If they've got the drone pilot, they can access it. They can go to their Better Life Farming Center and ask, hey, I've got an outbreak of a certain insect. I need someone to come. And they can be there that afternoon and do the treatment in half an hour and be done. So this is how we move people from subsistence to thriving.
Well, let me come back to the question then, which is all great to hear, but you're present pretty much all over the world. Where in the pecking order does India stand, and where do you see the potential over the, say, next decade or so?
Yeah, I would say today, India is not in the top markets today, but it's certainly our every intention that it will be. And I'm not talking about by the way, 2047, those goals, I'm amazed, and I believe India can do this.
Yeah, well, to get to having India as one of your top markets by 2030, where are some of these investments across your divisions, if I were to ask you?
Sure.
Consumer health is one of the more younger businesses here, perhaps. Is that growing faster than the others, or what will get you to the top market by 2030?
They're actually growing at similar levels, and we think they're all capable of faster growth. I want to answer your question, but the honest answer is we're investing in all 3 divisions. We're actually not investing more in one than another. We're going in all of them. And in pharmaceuticals, for example, you may know this, when people are exposed to intense heat, they are more vulnerable to cardiovascular distress and to kidney disease. And so we have a therapy that's in India today. It's expanding rapidly, and we've now brought new clinical data in heart failure, so we're investing there. And so whether it's consumer health, pharmaceuticals, or crop science, a lot of potential, but a lot of work to do.
A lot of work to do, and I'll pick up on that and zoom out a bit. I was reading your annual report. Your statement there said 2025 has been a pivotal year, 5 key approvals worldwide, but 2026 is going to be better. Although I would say the analysts were a bit disappointed with the kind of earnings outlook you had, maybe a tad below what they were expecting. But what's in store as far as 2026 is concerned? What should we expect from Bayer?
Yeah, so 2026 is a really important year for us because it's the last year of kind of a major patent cliff in pharmaceuticals. That's putting pressure on our earnings. That's, I think, what you're referring to. In crop science, it's kind of the last year before we have a whole series of blockbusters that are going to launch. And we're preparing the ground for that. So this year, and this is a year where we said we've had some litigation challenges in the U.S.
Yeah.
You may be familiar.
Yeah.
We have some really important things going on in that. We announced a major settlement with the plaintiffs a few weeks ago. We're working to see that through. We also have the U.S. Supreme Court is reviewing our case, and they're hearing our case. So that's a big outcome. So we have a lot. 2026 is a year that's got a lot of kind of pivotal events, but we're looking forward to strong growth beginning in 2027 and going forward. And that's not a wish or a hope. I mean, we believe these are pretty concrete things that are going to happen.
2027 is when the market gets to see the outcome of this, rather tough restructuring you've been undertaking, because that's what, 14,000 jobs that have been impacted. Your debt is still at 30 billion euros or so. The litigation overhang, of course, while perhaps you're moving in the right direction, that overhang remains. So is 2027 going to be the year?
It is.
Okay, all right. It's good to hear that. Let me also ask you, since you've come on board, and even before that, there have been calls repeatedly to perhaps look at breaking up the business in 3 different divisions, and you resisted that so far. Does that call still remain, or has the calculus changed for you?
Yeah, I would say I see it in a pretty consistent way. I would think about it this way. A pure play business is easy to understand. It's easy for investors to understand. It's easy for employees to understand. We're not a pure play business. We have these 3 divisions. They're quite different, one from another. And the trend, certainly in the world over the last couple decades, has been for companies like that to split up. Now, there are exceptions to that. There are some really outstanding companies that have very different businesses. Take Amazon. Amazon, they're making movies. They're a distributor. They're doing cloud computing and other things.
They're not 163 years old, though.
They're not. And so this is the thing. If you look at businesses that are excellent, that have multiple divisions, they have a powerful kind of modus operandi. They have a method, they have a plan, they have a vision, and they execute. And sadly, I would say in the past, Bayer didn't always live up to that. And we are determined to live up to that now. But as I tell our people all the time, hey, we have to earn the right to name our own destiny. And the way we earn that is disciplined execution, taking our new system that puts the power in the hands of the people doing the work, and converting that into dramatic results.
So the answer is still no to breaking up the business?
The answer is not today, but hold us accountable for delivering great results.
That's not saying no. That's not saying no.
Right. That's right.
What is the role artificial intelligence is playing? Because, pretty much every company that exists here, 160 years old or 16 days old, is purely talking about the use of AI and the benefits they're getting from it. We don't know how much of it is actually playing out. But what is a real concrete benefit you've seen of deploying AI? What is the extent to which you're using it? Is it really compressing drug discovery timelines? I mean, are there real benefits you're starting to see there?
Yeah, first off, let's not get over exuberant about taking a 15-year product development timeline for a medicine and making that 3 years. That's not going to happen. Because, for example, if you have a new heart failure medicine, and you need to see data in 12,000 people over a 2 to 3 year time frame, that trial is going to take 5 years to run from start to finish. Okay, and AI is not going to, it might trim marginally off of that, but it's not going to. In a situation like that, it's still going to take years. So it's not that changes. But you get, for example, better shots on goal. So, for example, we're using AI massively for molecular design, both computational chemistry, computational biology. That's for all new medicines, all new crop protection products. Crop protection products, we're getting ready to launch the first new active ingredient of a herbicide that was designed entirely, virtually, as it were, before it was synthesized and actually tested. Because you can make a billion or a trillion, literally, combinations in silico and sort of put them through a synthesized test before you go into the chemistry wet lab and start synthesizing molecules. So that stuff's going on. That's been going on.
Okay, finally, let me ask you, Bill, for the company that has given the world aspirin and many such iconic brands, what's the next big thing that you're working on?
Oh, I'm gonna give you two.
Okay.
So really quickly, one that's really important for India: direct seeded rice. This is a rice seed that can be grown with much less labor. It doesn't have to be transplanted. It doesn't need flooding. So it uses more than 50% reduction in water requirement, less chemical use, and it has a dramatically lower level of methane production.
Okay.
And so bringing that to the world, this is a big deal for farmers, for farm economics, for consumers who get the benefit of the lower costs, and for the environment. That's a beautiful one. Parkinson's disease.
Yeah.
I know that's an important topic here. We're in the first phase 3 studies of a pluripotent stem cell for Parkinson's disease. And the phase 1 results were very encouraging. Phase 3 now, we could be bringing something that could be a whole new level of solution for people with Parkinson's disease.
Well, amen to that, and we wish you speedy luck with it. But no GLP drugs, on your radar, since that seems to be something that every major pharmaceutical company is talking about.
Yeah, in soccer, when little children are playing soccer, everyone runs around the ball. Right? It's like a mob around the ball.
GLP is the ball that everyone's running around.
Yeah. You know what? Those drugs are amazing. Those are fantastic drugs.
Yeah.
Got them already. The world's got them. We're working on what the world needs next.
Yeah. Well, thanks very much, Bill. It's been an absolute pleasure speaking with you. Thank you so much for your time.
Thanks for your time.
So that was Bill Anderson, the global CEO of Bayer, a 160-year-old company, a very 21st century moment, and a CEO with a lot riding on getting it right. That's all from all of us. Goodbye from our team here, and thank you for watching.
Good evening. Thanks for joining us on Business 360. The top stories that we're tracking for you this evening. Oil prices hover around the $100 mark after the new Iranian Supreme Leader Mujtaba Khamenei vows to keep the Strait of Hormuz closed. The U.S. issues a 30-day waiver for the purchase of Russian oil currently stranded at sea. U.S. Treasury Secretary calls it a move to stabilize global energy markets. Explosions rock Dubai and other parts of the Gulf. 2 expat workers killed in drone strikes in Oman. Saudi Arabia shoots down multiple drones. 1 French soldier is killed, several wounded in Iraq. President Trump ridicules Iran's leaders as deranged scumbags in his words. Says it was a great honor to kill them. 4 U.S. military personnel dead after a refueling plane crashes in Iraq. Pentagon claims the loss of the aircraft is not due to hostile fire or friendly fire. India's External Affairs Minister Jaishankar speaks to his Iranian counterpart for the 4th time since the war. This comes after Prime Minister Modi spoke with Iran's president, expressing deep concern over the loss of civilian lives. No official word yet on Iran assuring safe passage for Indian ships to sail through the Strait of Hormuz. The Sensex and the Nifty declined 5% this week, marking the worst 5-day fall in 4 years. All sectoral indices closed in the red. 29 lakh crore rupees in market cap wiped out since the start of the Gulf War. The rupee sinks to yet another record low against the dollar. The rupee is weakened by more than 1% in the last 2 weeks. All Asian currencies declined against the dollar. The US launches fresh probes against India and 59 other economies under Section 301 over alleged forced labor trade practices. This comes a day after US initiated another investigation on India, China and 14 other trading partners as the Trump administration moves to reimpose the tariff struck down by the Supreme Court. Pharma major Bayer is aiming to make India one of the company's top markets by 2030, says the global CEO Bill Anderson. Adds Bayer is investing in consumer health, pharma and crop science divisions in India. That's an exclusive. Adobe CEO Shantanu Narayan is set to step down after 18 years at the helm. He will stay on as chairman of the board. Microsoft CEO Satya Nadella calls Narayan's tenure a legendary run. India records the first heat wave of 2026. Temperature crosses 40 degrees across some parts of Gujarat, western Rajasthan, Vidarbha, Madhya Pradesh and Marathwada. Let's go straight to the top story this evening. Explosions continue to rock the Gulf and Iran as the war in West Asia has now entered day 14. Let's start with the airstrikes that shook Iran's capital, Tehran, as the Israel army launched a new wave of strikes. Tel Aviv has claimed it hit missile production and storage sites. Iranian media has claimed that residential areas have been hit. Meanwhile, explosions were reported across the Gulf as well. Dubai was targeted yet again as a blaze covered the city's industrial area with a thick cloud of smoke. Debris from intercepted drones hit buildings close to the Dubai International Financial Center, causing minor damage. Iran also continued to target ports across the Gulf. Oman's port of Salah was hit by airstrikes that targeted fuel storage facilities overnight, while drones aimed at Oman's industrial complex killed 2 expat workers. In Saudi Arabia, they've shot down multiple drones. Alerts were issued in Bahrain and Kuwait as well. Ships across the Gulf, especially those near Iraqi territorial waters, were also targeted. The attacked ships and boats had loaded fuel cargoes in Iraq late night. Around 16 vessels have come under attack in the Gulf since the start of the West Asia conflict. The U.S. has confirmed that 4 of the 6 crew members on board a U.S. military refueling plane crashed in western Iraq yesterday, and they have now died. The U.S. Central Command has ruled out a hostile or friendly fire as the cause for the crash. Back home in India, External Affairs Minister S. Jaishankar has spoken to his Iranian counterpart for the 4th time since the start of the war. This comes after Prime Minister Modi spoke to Iranian president and expressed concern over the loss of civilian lives. In a statement, the Prime Minister said that the undisturbed transit of goods and energy remains India's top priority. There is no official word yet on Iran assuring safe passage for Indian ships or for ships bound to India via the Strait of Hormuz. Oil prices hovering around the $100 mark after the new Iranian Supreme Leader Mujtaba Khamenei vowed to keep the Strait of Hormuz closed. The U.S. has now issued a 30-day waiver for the purchase of Russian oil currently stranded at sea. This is now not just specific to India, but it's a general waiver. Russia has said it has nearly 100 million barrels of oil currently in transit. The U.S. Treasury Secretary has called it a move to stabilize global energy markets. Meanwhile, U.S. President Donald Trump has declared that the U.S. is, and I quote, totally destroying Iran's ruling regime. In a social media post, he ridiculed Iran's leaders, calling them, and I quote, deranged scumbags. He added that it is his great honor to kill them.
The situation with Iran is moving along very rapidly. It's doing very well. Our military is unsurpassed. There's never been anything like it. Nobody's ever seen anything like it. And we're doing what has to be done. Should have been done during a 47-year period. Could have been done by a lot of different people. They chose not to do it. But they really are a nation of terror and hate. And they're paying a big price right now.
My belief that as soon as it is militarily possible, the U.S. Navy, perhaps with an international coalition, will be escorting vessels through. We have complete control of the skies and are degrading they have no Air Force. The Navy is sunk, literally and figuratively, and the munitions factories, the rebuilding capabilities for the missiles, completely degraded. So as soon as it is possible for to ensure safe passage, we will do it.
Central Dubai is currently seeing a repeated interception of projectiles, and therefore the authorities are warning that people should stay indoors. Let me just show you what really is the situation here. You can see the Burj Khalifa in my backdrop and the suburbs of Dubai as well, the central Dubai area. So first thing that happened this morning was that authorities here in Dubai confirmed that they have intercepted a projectile. Let me just read out to you the message that came in from the authorities here. The competent authorities have confirmed that a minor incident resulting from the fall of shrapnel due to an air interception is being handled on the facade of one of the buildings in central Dubai with no injuries recorded. So that's some semblance of normalcy, because there's no injury, nobody is critical, but repeatedly these projectiles are coming in, and now it looks like that Iranian drones are not just targeting UAE airport, the Dubai airport or American assets. They're also looking at targeting the economic nerve center of Dubai, something that the Gulf authorities across countries here, be it in Bahrain, because alerts were sounded in Bahrain also this morning. So in all of these countries, there is an attempt by Iran to make them the collateral damage for this war.
Well, that is our colleague Arunima there reporting from Dubai. But let's talk about the market action. And it ended low for the third straight session, closing at an 11-month low. The Nifty closing below the 23,200 mark for the first time since April 7th of 2025. The Sensex fell nearly 1,400 points today, and BSE listed companies have now raised market cap of more than 10 lakh crore rupees. So a sea of red. The Nifty Auto Index again taking it on the chin, down 3.5%. Metals down 5%, and of course the Sensex and the Nifty down 2%. In the commodity markets, the rupee also continued to underperform, and for the week, before we get to the commodity markets, let's talk about the market action for the week. We saw the Sensex and the Nifty down 5% each, posting the biggest weekly fall in nearly 4 years. So that's the picture as far as the week is concerned. All indices, look at Nifty Auto, down 10%, 7% lower on Nifty Bank, and 6% cut there on the Sensex, and 5.5% for the Nifty. All sectoral indices closing in the red. Mangalam joins us now to wrap up what has been a brutal week on the Lal Street. Mangalam.
Well, it was clearly Friday the 13th for the market, horror day and a horror week for the bulls. The Nifty Bank, the mid-cap index, all of them fell anywhere between 2.5%, and that's because crude held above that $100 per barrel mark, hitting 102 as well. And today, the rupee continued to be at a record low versus the dollar, and US futures were down nearly 150 to 200 points when the market closed today as well. All of this was because there was no clarity on the geopolitical uncertainty. The top losers today came from the metals pack, and L&T, which has been the top loser ever since the war broke out, continued to be losing, and today lost about 7% and fell below the 5 lakh crore market cap as well. Some flight to safety was seen in a couple of these consumer names like Tata Consumer, HUL, but all in all, it was a bad week. After a big decline in the previous week, this week as well, the Nifty goes with a cut of 5%. The Nifty Bank, a cut of 7%. For the Nifty, is the worst weekly performance since June 2022. For the Nifty Bank, it's the worst weekly performance all the way since the COVID month of March 2020 as well. this week. The worst performing sector was the auto sector. M&M down 12%, Ashok Leyland down 12%. Look at Eicher Motors, Maruti, Bajaj Auto. All these are frontline names down anywhere between 10 to 11% as well. And in the broader markets, it was some of these EMS plays. PG Electroplast down 18%. Amber, not too different in business from PG Electroplast, down 18% as well. We had the managements join us, tell us that there could be a chance of them missing their guidance this year because of their raw material situation, the gas situation. Polycab and KEI were down 15-16% as well. Among the gainers were the ones that either who got gas or maybe benefited from that. So fertilizer companies, RCF, FACT, all of them were higher. TTK Prestige was up 16% as well. And from the start of this week to now, one standout gainer on the Nifty has been Coal India. But all in all, a bad week, a bad period so far, because we've lost nearly 29 lakh crore in market cap since the war began. And since the war began, stocks like L&T have lost 19% of their value, Indigo down 14%, oil marketing companies down anywhere between 16 to 17%.
Yes, a brutal week, brutal sell-off, 29 lakh crore rupees wiped out in market cap, as Mangalam was pointing out. Many thanks indeed. In the currency market, the rupee hitting another record low against the dollar. The currency weakened by 26 paise against the greenback. The rupee is now down more than 1% since the start of the war. It was below the 91 mark on the 27th of February, and today the rupee stands at 92.45. Fears of the LPG shortage refuse to subside across the country despite the government's assurances. From Noida to Nagpur to Bhopal and Trichy, consumers are complaining of inordinate delays in procuring refills. Several consumers we spoke to in Noida said hoarders and black marketers are demanding up to 4,000 rupees for a 900 rupee cylinder. Government's LPG rationing has hit food services at educational institutions and office campuses as well. Mumbai civic body, the BMC, also grappling with the rationing. Their canteen served only dry meals yesterday in the second half. However, services resumed in full swing today. But it's not all bad. Management at Amritsar's iconic Golden Temple has assured devotees that there are no cooking gas shortages at the temple and that food services continue without disruption. As per a report, the shrine uses around 25 LPG cylinders every day, serves over 1 lakh devotees daily. Meanwhile, sparks flew in Parliament as opposition parties questioned the government over gas supply fears and the long queues outside LPG agencies across many cities. Finance Minister Nirmala Sitharaman proposed an economic stabilization fund to provide fiscal room.
Higher prices for LPG means we go back to the traditional methods, and we can have so many speeches of the Prime Minister talking about the great LPG spread. Look at the exports. Manufacturing growth has fallen. Sir, we are lions in India. We are tigers in India. Relevant and be guided.
When I'm talking about how the government is preparing for ourselves to face any unexpected events, inclusive of supply chain LPG, they're not willing to hear the reply. They want to have their own agenda. Chala chakkar chalao. Ye hai hum.
बहुत परेशान किया भाई, 3 दिन हो गए हम लोगों को चक्कर लगाने।
नहीं आ रही थी,
पिछले 1-2 दिन नहीं आई थी। कभी जिंदगी में नहीं देखी जो किल्लत आज की डेट में देखनी पड़ रही है।
कितने में ले? कितने में?
4,000 में कर लिया हमने बड़ा वाला सिलेंडर ब्लैक में भारत का।
मिलता था?
वैसे 930 का। किताब का मिल रहा है 910 का।
910 का।
कितने दिन में मिला सिलेंडर?
2 दिन में सिलेंडर मिला है।
कितने घंटे खड़े रहे?
कल हम 5 घंटे खड़े रहे थे, आज हम 4 घंटे खड़े हुए थे।
ब्लैक में तो बहुत महंगा मिल रहा है, 2,500-3 हज़ार का मिल रहा है।
और क्या कह रहे हैं कि ब्लैक में तुरंत ले लो?
हाँ, ब्लैक में तुरंत ले लो। ब्लैक में तो पैसा दो तुरंत लो, यही वाला माल चल रहा है।
Well, black marketers are at play at this point in time. The LPG situation continues to be challenging across the country. We'll head into a break, but up next, Adobe CEO Shantanu Narayan is set to step down after 18 years at the helm. That and more when we get back. Now, the US government has launched a fresh trade investigation under Section 301 against 60 economies, including India, over alleged forced labor trade practices. Now, this comes a day after the Trump administration launched a probe into alleged unfair trade practices by India, China, EU and 13 other trading partners. The move is aimed at replacing Trump's so-called reciprocal tariffs, which were ruled illegal by the US Supreme Court. US Ambassador to India Sergio Gore says the White House expects New Delhi and other partners to honour the trade agreements reached with Washington. Speaking at the India Day conclave, Gore said, and I quote, "The US expects countries we have made deals with to honour those deals," end of quote. He also said that US and India are close to signing a critical minerals agreement soon. Remember, India has not yet inked that agreement with the US. The big news maker today, multinational pharma giant Bayer is making India one of its top markets by 2030. That's the aspiration. Bayer's global CEO spoke exclusively to CNBC TV 18 and said the company is investing in all three of its verticals in India and expects strong growth from next year.
India is not in the top markets today, but it's certainly our every intention that it will be. And I'm not talking about in, by the way, 2047, those goals, I'm amazed, and I believe India can do this. I've seen, you know, the progress you've made. I think this can be reality, but we want India to be a top country for us by 2030.
Okay.
Not 2047.
Okay.
And so that's why we're investing. We're investing in technology here in Bangalore, but we're investing in manufacturing, R&D, commercial operations, and we're investing in our customers.
Well, that's the Bayer global CEO here in India about their plans. And speaking of global CEOs, Adobe CEO Shantanu Narayan is set to step down after 18 years at the helm. He will stay on as chairman of the board. The company said Narayan will transition from the CEO role after a successor is appointed. Rachna joins us now with more details. Rachna, it's been a big run for Shantanu Narayan, 18 years as a non-founder CEO of a large US tech company.
That is correct. One of Silicon Valley's longest-serving tech leaders is now preparing to step aside. After 18 years as the CEO, Shantanu Narayan will transition out of the top job at Adobe once a successor is named. He will remain the chair of the board, leaving behind a company that he fundamentally transformed. Narayan was born in Hyderabad in 1963. His father ran a plastics business while his mother taught American literature. He studied at Hyderabad Public School, the same institution that later produced other global leaders, including Microsoft Satya Nadella, along with several others. After engineering at Osmania University in Hyderabad, Narayan moved to the United States, earning a master's degree in computer science and later an MBA from UC Berkeley. Early roles at Apple and Silicon Graphics, along with a startup of his own, came before he joined Adobe in 1998. 9 years later, he became the CEO, overseeing one of the most consequential pivots in modern software. Under Narayan, Adobe moved from selling box software licenses to a subscription model built around Creative Cloud. This was a shift that later became the template for the entire SaaS industry. During his tenure, Adobe's workforce grew from about 3,000 employees to more than 30,000, while revenue expanded from under $1 billion to over $25 billion. He also pushed Adobe deeper into enterprise software, anchored by the $1.8 billion acquisition of Omniture in 2009, which built its digital marketing and analytics business. But his later years also saw the deal that got away. Adobe's planned $20 billion acquisition of design platform Figma collapsed in 2023 after regulatory opposition, forcing the company to pay a $1 billion breakup fee. AI is now the next test for Adobe. Narayan has described AI as the start of a golden age of design, with tools like Firefly meant to assist creators rather than replace them. Adobe trained the models on licensed and public domain content to offer what it calls commercially safe AI for enterprise users. Even so, investors remain cautious as Gen AI reshapes the creative economy. Microsoft CEO Satya Nadella called Narayan's tenure a legendary run. The two also share another connection. Both studied at Hyderabad Public School, as I mentioned, but now are investors in Major League Cricket in the United States, backing the Seattle Orcas franchise. Dylan Field, co-founder of Figma, the same company that they failed to acquire, described Narayan as thoughtful, kind and relentless in his pursuit of Adobe's vision. Narayan will remain chairman while Adobe begins the search for its next CEO, with the board expected to look both internally and externally for his successor.
Well, Rachna, many thanks for joining us. And I have had the privilege of interviewing Shantanu Narayan for many, many years. We will, of course, try and bring you excerpts of that conversation. With that, it is time for us to wrap up this edition of Business 360. Stay tuned to CNBC TV 18. We'll be back very small. Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. PhonePe continues to dominate India's UPI ecosystem among third-party apps, says NPCI's data. Google and Paytm retained the second and third spot. PhonePe processed 9.28 billion transactions, holding 45.5% share of the total UPI transaction volumes.
Consumer health platform Mosaic Wellness raises 200 crore rupees from 361 asset. Spring Marketing Capital gets a partial exit. Fresh capital will be used to accelerate investments across emerging opportunities.
D2C baby products brand R for Rabbit nearly doubles its scale over the past 2 years from 128 crores in FY23 to 250 crores in FY25, reports a marginal loss of 14 lakh crore rupees for the fiscal.
The United States launches fresh probes against India and 59 other economies under Section 301 over alleged forced labor trade practices. This comes a day after the US initiated another investigation on India, China and 14 other trading partners as the Trump administration moves to reimpose the tariffs struck down by the Supreme Court.
Adobe CEO Shantanu Narayan is set to step down after 18 years at the helm. He will stay on as chairman of the board chair. Microsoft CEO Satya Nadella calls Narayan's tenure a legendary run.
Those were the headlines that we're tracking for you this evening. But on what's brewing today, India's consumer credit boom is creating a new financial challenge, rising household debt. And that is opening up an entirely new category in fintech, debt resolution. Startup Freed is looking to build exactly that. The Gurugram-based platform has raised 60 crore rupees in fresh funding, with the round led by Avishkar Capital and participation from existing investors, including Soren Investments, Piper Serica and Sattva Ventures. Founded in 2020, Freed helps financially stressed borrowers negotiate settlements, restructure payments, and regain financial stability through a tech-led platform. So how big is this opportunity for debt relief in India, and how does Freed plan to scale this category? Joining me now to discuss this further, Ritesh Srivastava, founder and CEO of Freed, and Shashwat Rai, partner Avishkar Capital, as well as my colleague Shruti. Gentlemen, thank you so much for joining us on the show today. You know, Ritesh, let me come to you first. Debt relief is a large and well-established category in markets like the US, right? So what makes you sort of believe India is now ready for a structured debt resolution platform like Freed? And what do you have on offer? Take us through the kind of impact you've already made.
Sure. So thank you first for having me here. Pleasure. Well, let me first come to the point, why now, right? I mean, the last 5 years that we have seen consumer debt literally explode in India. I mean, we have gone almost 5x on the personal loan outstanding. Indian household debt to GDP ratio, which is about 41% right now, you'd be amazed to know that almost 55% of that is in non-housing debt, which typically is a high interest rate, low tenure, and increases the debt, servicing ratio burden on the individuals. And contrary to what I'm seeing in India versus what I saw in the US, right, where there is a heavy allocation of household debt into home loans, right, which is a good debt because you're building an asset.
Okay.
While there is a very small percentage going into unsecured, which is credit cards and personal loans. In India, it just the reverse. So the timing, if there was a better timing to launch it, I believe it is now that we are seeing rapid growth in consumption and consumer loans. So I believe we are rightly positioned to cater to this stress loans market right now.
All right. Ritesh, this is Shruti quickly stepping in. You've just raised 60 crore rupees in fresh capital. Tell us, where will this money be deployed? Will it be technology, partnerships with lenders, or scaling customer acquisition?
Well, pretty much all. I mean, see, what we are seeing is debt penetrating to the tier 2, tier 3. So there is a cities as well. So there is a need to actually verticalize the platform, make it more approachable, accessible, bring a strong layer of tech that we are already, that we want to beef up through this, freshly raised capital. And of course, build a strong education awareness pillar on the platform itself, because we believe a lot of this debt trap can be avoided through prevention measures, right? So education is at the core of what we are building. So these are three vectors on which we, plan to utilize the capital.
All right, so three vectors where you're using this capital. But Shashwat, let me bring you into the conversation, What about Freed's model sort of convinced you to lead the 60 crore rupee investment round? And how does it sort of fit into Avishkar Capital's broader impact investing thesis?
Thanks a lot for the invitation. Avishkar Capital has always been a pioneer in supporting financial inclusion. While this one presented a very unique opportunity because this is a new category altogether, which is financial re-inclusion. There is a very significant segment of population which has been impacted by, over leverage, and this provides first of its kind opportunity to stressed borrowers to actually become part of the financial inclusion, the credit ecosystem once again. And this is a borrower first approach, which is truly different compared to most of the other ecosystem opportunities emerging around collections. And because it's a debt relief platform, naturally, when you are providing relief to customers, over time, the virality goes to a different level. Your customer acquisition costs come down very dramatically. So from an overall impact standpoint, this has a very, very significant qualitative and quantitative impact on the lives of a very large segment of Indian population. These are the kind of models that Avishkar Capital has always been very excited to support. And I'm very excited to partner with Freed through this investment.
All right. So, Shashwat, do you believe debt resolution will become a formal layer of India's financial infrastructure, similar to what we see in developed markets?
Yeah, absolutely. I think the early signs are already there. Freed today is working with almost all the marquee names in the retail unsecured lending ecosystem, which is almost like a formal acceptance from the practitioners, which has already happened. And we believe that as this category becomes more and more prominent, there will be a lot of regulatory kind of movements as well to formalize this even further. And that will, take this market to a different tangent altogether. So we are very excited about this category from the impact as well as the market size standpoint and the kind of unique approach that the model is now employing in supporting hundreds of thousands of customers which are getting onboarded on the platform.
Sure. Ritesh, we're running out of time, so if you could quickly tell us, you've already counseled over 2 million customers and sort of managed more than 120,000 active accounts, right? What does your business model look like, and how do you sort of monetize the debt resolution process?
Since it's stressed borrowers that you're dealing with, right? So the entire fee structure is based on making it affordable and making it performance-led, right? So if we don't perform, we don't charge the fees. So we are very clear about the model at Freed that whatever we do, if there is no net tangible benefit to the borrower, we won't charge. So whatever debt we enroll, as we keep resolving the debt with the lender, bringing that relief to the borrower, then there is a small percentage of fee that we charge to the borrower.
Okay. Ritesh, you've scaled rapidly in the last few years with thousands of active accounts and significant debt under management. Can you share where revenues stand today, how fast they're growing, and what the path to profitability looks like for Freed?
Perfect. So, we have been growing. This current financial year, when we end March with, we'll be almost at a 19 to 20% compounded monthly growth rate. That's on the top line, right? And the nature of this business is very annuity-led because the cohorts that you onboard today, the debt that you onboard today, will continue to perform over the next 24 months as those debts keep resolving, right? And you charging your fees. So it's just a very annuity-led business model and a lot of front-loaded costs, right? And what we plan to enroll over the next 18 months is $1 billion in debt. And that should see us at a scale of almost, close to about, I would say about close to 150 crores in top line over the next 18 months.
Shashwat, in 30 seconds, the big themes that you're bullish on for this year.
So there are a lot of interesting opportunities emerging in the intersection of impact and tech space. All the sectors, be it climate, ecosystem, financial inclusion, agriculture, geospatial technologies. There are a lot of very high impact sectors which are impacting the masses and have a very significant role of technology in the build out of these business models. And we are actually, if you look at our 4-5 last investments, impact technology has been central to the kind of themes that we are chasing. And we'll continue to do so over the next year or so as we complete the portfolio construction of this fund.
Well, on that note, it's time for us to wrap up our conversation. Many thanks, Ritesh and Shashwat, for joining us today on Startup Street.
Thank you so much for the invite.
Well, with that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
bid to boost foreign direct investment into India, the government has tweaked Press Note 3, which essentially governs investments from countries that share a land border with India, including China. Now, if you remember, Press Note 3 was introduced in April of 2020 when India and the world was reeling under the first wave of COVID-19. It made government approval mandatory for investments into private companies from India's neighbours. Essentially, we're talking about China. The amendment to the FDI policy was aimed at preventing opportunistic takeover of Indian companies during the economic slowdown caused by the pandemic. Now, earlier this week, the government has relaxed these restrictions for specific sectors like capital goods, electronic components, polysilicon, and rare earth magnets. Investment requests will now be processed and decided within 60 days. That is what the government says. It is also allowed automatic approval if the beneficial ownership of the investor is less than 10% of the total shareholding. Joining me now to discuss the changes to Press Note 3 and its implications, Amardeep Singh Bhatia, the Secretary at the Department for Promotion of Industry and Internal Trade, DPIIT. Mr. Bhatia, always a pleasure. Many thanks for joining us here on CNBC TV 18. I want to start by asking you, these restrictions were brought in via Press Note 3 in 2020, as we pointed out, as a way of protecting Indian industry from opportunistic Chinese investments. Why the decision to bring in these modifications, to bring in these relaxations now?
So the situation which was existing in 2020, when these were brought in, were very different from the situation which is existing now. At that point of time, when the provisions were brought in, when the regulations were brought in, the valuations, not only in India, but valuations across the globe were going down. And there was apprehension that there will be opportunistic takeovers, which may take place on account of these lower valuations. That was the reason why this was brought in. Now things are different. Our stock markets are quite buoyant, as you all know also. So that situation doesn't exist now.
Mr. Bhatia, let me then understand from you, I would imagine that requests have come in from different stakeholders within government, outside of government as well, pushing the government, urging the government to make these changes. Can you help explain to us where has the need to make these modifications come in from? Where were the requests coming in from?
Really, if you look, the requests had come in from the global funds, from the VC funds, the PE funds, who are located in countries outside the LBCs. Those global funds which had a certain amount of ownership from LBC entities. So the requests were that if there can be easing out on account of small, non-controlling, non-strategic interests, which is there in these global funds, so that the entry route is easier, there is less of uncertainty. That was the prime motive for bringing in this change, and that was the main request which was coming in.
Yes, VCs and PEs have been making that pitch to the government, and that is what you've taken note of. But let me understand from you, sir, on the back of Press Note 3, can you lay out for us the quantum of investments that has perhaps been stuck, the number of requests, the number of proposals that are still pending clearance? Is there an estimate?
So it's not the number of proposals which are pending, which should be looked at. It's the impact which it had in terms of the uncertainty among the global fund investors on account of the time it may take, or on account of whether it'll be approved or rejected. So there are a likely large number of investors who may not have applied on account of this PN3 route. So we are expecting that impediment will not be there as far as investors are concerned.
Okay, so you anticipate that this is going to do away with the uncertainty that had clouded investor sentiment. So what then, sir, is the expectation in terms of FDI on account of this modification to Press Note 3?
FDI depends on a number of factors. This is also one of the factors. but going by the sentiment which is expressed by the Ps and VCs, the EIFs which are present in India, there's a lot of positive sentiment on account of this decision of the government. And I expect a large jump in investments coming in from this channel. Of course, it'll be very difficult to quantify how much will be coming in on account of this. There are a number of other factors also which impact FDI flows.
Let's talk about the turnaround time, sir. And as you pointed out, this was a concern for the PE/VC community. Many others that we've been speaking to also suggested that in some cases this was taking as long as a year, perhaps even longer, to get approvals in place. The government is now committed to a 60-day time frame. How do you go from a year plus to 60 days?
Has been improvement over the last 4 to 5 years since the PN3 notification had come out, even within the government. The time taken for approval, the average time taken and the median time taken for approvals has gone down. And this has happened on account of constant monitoring by the various arms of the government, both within DPIIT and outside DPIIT. So we have changed the process as far as the approvals for PN3 proposals in the specified sectors are concerned, subject to the other conditions which have been laid down. And this change procedure, which is the two-layered process, which ensures that if the first layer doesn't take a decision within that time laid down, it goes to the next layer. That hopefully will ensure at the 60-day time limit is adhered to.
Mr. Singh, DPIIT and the concerned ministry are now no longer part of the approval process. In fact, it's the MEA and the MHA that will weigh in on the approval process. Now, this seems to suggest that the government is going to be reviewing or viewing these investments through the lens of geopolitics and the lens of security. Wouldn't that be a fair assessment?
No, not really. You see, the FDI approval regime had changed. And as all of you know, more than 90% of sectors are open in the automatic route. The ones where government approval is required, the approval is to be given by the line ministry concerned, the concerned administrative ministry, and not by DPIIT. DPIIT coordinates, ensure that things are moving in the right direction, in the right frame, and also within the time frames laid down. But as far as PN3 is concerned, PN3 process was a specific separate process which was laid down. And that process should not be compared with the rest of the FDI process.
Let's talk about the sectors that you believe are likely to benefit from this move. And let's be clear, sir, this is about investments from China that we're talking about, even though we talk about land border countries, but it is Chinese investment essentially that has been provided with this relaxation. Now, which sectors do you believe that we're likely to see investments coming into? Do you expect to widen the scope of interest across different sectors with this modification?
Lost you in between, Shireen. I was not able to hear you.
No, I was just asking you about the sectors that you believe are likely to benefit from this relaxation. And again, as I was pointing out, let's be clear, this is really about Chinese FDI. We're not inviting FDI from Pakistan or Bangladesh or anywhere else. This is about Chinese FDI. So where do you believe Chinese FDI is most likely to find its way?
There is a lot of interest shown by companies in various sectors, especially in the electronic sector. We have an incentive scheme also in the electronic sector. We also have incentive schemes, the PLI schemes working in other sectors. There's a lot of interest shown by Indian entities to collaborate, to partner, to access technology, to access process technology as well as other technology to manufacture in India. So in the manufacturing sector, in electronics, in capital goods, as has been mentioned in the press release also. We expect a lot of interest.
So the earlier sensitivity, Mr. Singh, that we had with respect to Chinese investments, with this decision, with this modification, is it clear that Chinese investments into India are no longer frowned upon?
We have eased out investments into specific sectors where we have eased out the process, brought in a fast-track process, not exactly eased out, brought in a faster process for these specified sectors where we feel manufacturing should grow in India. So that's one clarification. Second is we have eased out the process with regard to entities which are located in non-LBC countries and where beneficial ownership is non-strategic and is not of a controlling nature.
Right. Mr. Singh, do you expect Chinese investment to come into critical sectors like rare earth magnets? I mean, that is a focus area for the government. That's a priority for the government. But do you expect or do you even welcome Chinese investment into areas like that?
I think we should leave it to the businesses to find out. We have provided a way. Let the businesses find out what is best for them. Let's wait and see.
So there is no sensitivity on the government's part to allow Chinese FDI into sectors like rare earth magnets and so on and so forth?
In rare earth magnets, we want manufacturing to take place in India. We want our supply chains to be secured also. So if manufacturing takes place in India through partnerships, through joint ventures, it should be beneficial to the Indian economy.
Some pending, large pending investments, Vivo Dixon, for instance, which has been pending for a significantly long period of time. Now, do you anticipate those pending proposals being fast-tracked on account of this change?
Let me not go into individual cases. I won't have the details of that case also available with me straight away, so it'll be difficult for me to comment on that.
So the message that the government is sending out, sir, to put it very clearly and precisely, is that Chinese investment, Chinese FDI is now welcome in India.
Message we are sending out is that we are easing doing business in India, and wherever there are difficulties which businesses point out to us, wherever it is helping us in bringing more manufacturing into India, wherever investment is coming into desirable sectors, we will such investments coming.
Mr. Singh, always a pleasure. Appreciate you joining us here on CNBC TV 18. Thanks very much for your time, and thank you very much for explaining to us the rationale behind the change to Press Note 3 and the impact and implications of it. We will take a break. There's a lot more coming up. Don't go anywhere. We're back in a moment.
EY Entrepreneur of the Year, India, celebrating shapers of India's future.
The EY Entrepreneur of the Year is the world's most prestigious business award for entrepreneurs. As the first and only truly global business award of its kind, EY Entrepreneur of the Year encourages entrepreneurial activity among those with potential and recognizes the contribution of people who inspire others with their vision, leadership, and achievement. the 27th edition of EY Entrepreneur of the Year 2025 India Awards celebrated the shapers of India's future. Selected from over 300 nominations, these trailblazing finalists are fueling India's economic growth and prosperity through transformative ideas and purposeful leadership. And the India winner will represent the country at the EY World Entrepreneur of the Year Awards in Monte Carlo in May this year.
Good evening, ladies and gentlemen, and welcome to the 27th edition of the EY Entrepreneur of the Year Awards India 2025. These are the world's biggest awards, celebrated in 94 countries and territories, a unique global program to recognize entrepreneurial achievement. And the theme this year is Shapers of India's Future. And that's what all our incredible entrepreneurs are today. With that, we now kick off this glittering evening, and I would like to invite to the stage the Chairman and CEO of EY India and President of CII for 2025-26, Mr. Rajiv Memani.
It's a real privilege to welcome you to the 27th EY Entrepreneur of the Year Awards. I feel those 27 years within me. So thank you for being with us this evening. I know all of you are really busy, but I really appreciate your coming here and your presence. And through these awards, we feel very grateful and privileged to celebrate India's most outstanding entrepreneurs. And this is the only Global Entrepreneur Awards program which culminates with the World Entrepreneur of the Year Awards in Monte Carlo. And we feel proud that India has produced 4 global winners, the highest that any country in the history of the program. So a big round of applause for our entrepreneurs. This is the testament to the quality and depth of entrepreneurship in India. And as we gather here today, it's worth reflecting also on the last 12 months. I think this is an area, this has been a period of big transition and very transformative for our country. I think we have seen an accelerated pace of reforms, which is enhancing India's competitiveness. We are seeing a much deeper integration with the global economy, with the various bilateral agreements that we are doing. And AI and technology revolution is going to reshape the business in a very, very profound way. Taken together, I think these things are the foundation of a very structural transformation of our economy and businesses. But friends, our 2025 finalists represent the very best of Indian entrepreneurship. A big round of applause for all of them, please. And once again, thank you very much for being here. Thank you.
And now it is my absolute privilege to welcome on stage our chief guest this evening, the Honorable Minister for Commerce and Industry, Government of India, Shri Piyush Goyal.
Congratulations to all the finalists, to all the winners of the Entrepreneur of the Year Award. Each one of you truly deserves to be recognized. What you have achieved, many of you in a short period of time, is phenomenal. That is what defines New India. That is the future of India. And you are all role models who will, I'm sure, in the years to come, mentor and encourage many more entrepreneurs, many more startups, as they move up in their journey to explore uncharted territories. The fact of life is today, India is becoming a very important player when it comes to technology, when it comes to talent and skill required to engage with technology at scale. And across the world, Indian talent is respected, is wanted, and is giving very, very profound results. Our entrepreneurs are winners of today. Those who may not have been recognized as Entrepreneurs of the Year this time around will certainly aspire to be here receiving the award next year or the year after. But this journey of growth will continue relentlessly, and each one of you will help us power this growth. My best wishes to all of you. Thank you very much, ladies and gentlemen.
Ladies and gentlemen, we now have a special treat in store for all of you. An exclusive panel discussion featuring as panelists icons of Indian industry. And to moderate this discussion, we have the very sharp, the very incisive Managing Editor, CNBC TV 18, Ms. Shireen Bhan. Over to you, Shireen.
It's wonderful to be back here at the EY Entrepreneur of the Year Awards. And let's start with what everybody's been talking about and what has captured headlines and imagination the past few weeks, and that is AI. And I want to start by understanding from you what you make of this AI trade or the AI reverse trade that's impacting the Indian stock markets. Do you believe it's overdone? Do you believe the markets have overplayed the fears at this point in time? Or do you believe the worst is yet to come?
I think AI is for real. We can debate on the time and the speed of change and disruption. And that's where the debate is. But I want to turn this subject a little further. Is we talk about AI, it will change. Artificial intelligence will change how we live. But we're going to come to a stage where what is going to be even more important is what I call as wisdom. There is, as so far, no concept of AW, which is artificial wisdom. Therefore, human beings finally will have a role because wisdom will remain HW, even as AI takes more and more of our lives.
Mr. Jindal, you're now partnering with Chinese companies to try and bring technology to India to power your electric mobility ambitions. So how should we deal with China at this point in time? Collaborators, competitors, what should the approach be?
So there are two ways. One is that we have to learn from China because, my belief is that China is a country which is as large as India, given the population very similar to India. If we try to learn from Japan or try to learn from Germany, which are relatively smaller countries, we will not be able to really do what we need to do as an economy. We need to learn the way China has expanded. If you look at their bullet train program, I mean, we are, for the last 10, 12 years, we are building the bullet train, which is right in front of my office. I think we are still 4 or 5 years away from that first time that bullet train will move. And it happens to be Prime Minister's pet program, the bullet train, right? So it's a very high-profile program, but still we can't execute that program. And you go to China, you see like thousands and thousands of kilometers of bullet train running across cities. So we have to learn from a country like China, which is building the economy at a fraction of the cost of let's say, us. Because we are taking technology from smaller countries and more expensive countries. We have to learn from China. Now, how can we collaborate with China? That's a question which is not for me to decide. It's the government has to decide that. But if we have to expand and take our economy to a different level, we have to build bridges with China. We have to take our relationship with China to a different level.
With it, I want to understand from you, and this is again an issue that the startup ecosystem has demonstrated, speed and innovation. How do you marry the two? And more importantly, in an AI era where both are going to be critical, what is the mantra for success there that you've been able to demonstrate within Misho?
So the speed and innovation always go together. You can't innovate being slow because someone else takes over. So this is the time when all of us who have the right talent, which we have invested in. So I would tell you, like, even before AI became what it is, even 4 years ago, we had one of the largest AI teams in the country. We today have our own in-house trained, like 200 models they will be like small language models. Not a lot of them are large language because you have certain latency when people are using your product.
Yeah.
But we have trained all of them in-house. So we have that talent to basically do it, and we'll keep investing behind it. But you're right, like speed and innovation is very, very important. A lot of things are changing every single day. Like we have to keep refreshing our roadmap every quarter. We think technology is here, let's build it. And you realize like everything has changed.
Yeah.
And that's what it is. I think we have to be very agile. We can't be very rigid. And I think that's what's happening. So I would say like big place where R&D will get solved will be the startup ecosystem.
Well, that, in fact, is the perfect segue to thank Uday Kotak, Sajjan Jindal and Vidit Atre. Ladies and gentlemen, a big round of applause.
EY Entrepreneur of the Year, India, celebrating shapers of India's future. EY Entrepreneur of the Year, India, celebrating shapers of India's future.
We have these stalwarts here on stage as we begin our awards for the evening. We now come to the first award for this evening, and this one is the Special Jury Award. I'd like to request on stage Jury Chair Mr. Sajjan Jindal to please read the citation and announce the winner of the Special Jury Award.
A past EY Entrepreneur of the Year and World Entrepreneur of the Year winner and a past jury chair of this very prestigious program. Uday has shaped India's financial landscape with vision and integrity. He is the architect of one of India's foremost financial institutions, which is among India's largest private sector banks. In recognition of his exceptional contributions to India's economic and institutional strength, he was recently conferred the Padma Bhushan. Ladies and gentlemen, it's our privilege to honor Mr. Uday Kotak.
Let's all continue to be committed to the Indian adventure, to build India. And I genuinely feel our aspiration has to be the top two, Piyush. And let's raise the bar. So that is one. Second, I do feel that the time has come for India to move from a pace which is evolutionary to a pace which is revolutionary. We have to move at great speed because time is against many other nations while India is still young. India has the opportunity now with this young generation to catch speed. And I take this opportunity to congratulate all the winners here. And at heart, I'm always an entrepreneur and will be delighted to see Indian entrepreneurship flourish. Thank you very much, and thank you all.
And with that, ladies and gentlemen, as we come up to the first category of this evening, the category is Startup. I'd like to invite jury member Ms. Shweta Jalan to kindly grace the stage and announce the winner.
The winner of this category set out to bring order to a fragmented and opaque industry after spotting deep inefficiencies. Their cash-efficient and asset-light model earned them the status of the unicorn in 2025. Please join me in welcoming a startup duo, Pranav Goyal and Uttam Diga of Portal.
The next category recognizes and rewards entrepreneurs who cracked the great Indian consumer. And the category is Consumer Product and Retail. I'd like to invite jury member Mr. Harsh Mariwala to please grace the stage and announce the winner.
Under his leadership, his company expanded from its roots as a commercial cooling specialist into the residential market to build a strong presence in room air conditioners and later expand into adjacent categories. Backed by sustained R&D investment, category-dominating products, and 7 manufacturing facilities across India, the company has driven strong organic growth, expanded internationally to 49 countries, and built a reputation for innovation, quality, and customer trust. Please welcome on stage Veer S. Advani of Blue Star.
Congratulations! The next award honors entrepreneurs who have been pillars of Indian economy. The category is manufacturing.
So over 3 decades ago, the winner began with a focused industrial venture and steadily expanded into a broader integrated manufacturing ecosystem. Measured and practical, this Make in India champion is shaping India's manufacturing backbone. Ladies and gentlemen, please join me in congratulating Jasbir Singh of Amber Enterprises.
To a category of entrepreneurs who provide their customer with something intangible yet valuable, a service that impacts our lives. Yes, you've guessed it right, the category is services. May I request and invite jury member Mr. Nilesh Gupta to the stage to read the citation and announce the winner.
When banks globally were falling like 9 pins during the global financial crisis of 2008, this first-generation entrepreneur found an opportunity in providing wealth management services to India's growing population and has emerged as one of the country's top wealth and alternative asset management firm. A round of applause for the winner of the EOY Services Award, Karan Bhagat of 361 Wealth Asset Management.
And now moving on, the category is life sciences and healthcare.
This entrepreneur created a strong moat by steadily deepening capabilities in high-value and complex molecules, creating fully integrated end-to-end CRDMO services for global clients. He steered his company to a successful IPO in 2025, which was oversubscribed 63 times, and is now leading the company's push towards digital transformation. Please join me in welcoming our winner, Ajay Bhardwaj of Anthem Biosciences.
Our next award is a tribute to the turnaround men and women, the people who transform businesses, often launching them into an even higher orbit. The category is business transformation. And I'd like to request our jury member, Mr. Saurabh Agarwal, to read the citation and announce the winner.
The second-generation entrepreneur has not merely grown a business, he has transformed India's manufacturing landscape. By aligning with Make in India, investing deeply in R&D and design, and forging global partnerships, he has built the backbone behind manufacturing of some of the world's leading smartphone and consumer electronics brands. Ladies and gentlemen, let's put our hands together for Mr. Sunil Vachani of Dixon Technology.
Now, ladies and gentlemen, being an entrepreneurial CEO is a truly difficult job. You're expected to be a visionary on Monday, operational on Tuesday, and inspirational every single day in between. So with that, may I invite jury member Mr. Ravi Lamba to please grace the stage and announce the winner in this category.
Amid rapid disruption, intense competition, he chose disciplined execution and guided the business with clarity and resilience. 13 years as MD and CEO, and now as Vice Chairman, he is shaping the group strategy and future-proofing his organization, which has stood the test of time. Today, as intelligent systems and AI work silently to protect conversations and filter unwanted noise, his legacy feels fitting. Ladies and gentlemen, I would like to ask you please to join me in a round of big applause for Gopal Vittal of Bharti Airtel.
Energy and infrastructure are really vast topics, and I don't know much about them, but real estate, that we all know or have heard about. With that, I request our jury member, Mr. Dilip Sangvi, to kindly grace the stage to read the citation and announce the winner in this very vast category.
This second-generation entrepreneur succeeded his father and led the group's transformation into one of the industry's foremost players, scaling revenues more than 60-fold from 236 crore in 2010 to over 13,000 crore in FY25. Please put your hands together for the winner, Abhishek Lodha of the Lodha Group.
Now, ladies and gentlemen, the big one, the award we have all been waiting for. The entrepreneur who stands in a league apart, who will be honored with the highest award of the evening and will also represent India at the EY World Entrepreneur of the Year Awards to be held in Monte Carlo this year. So hold on to your breath, but not to your applause, as we reveal the winner of the EY Entrepreneur of the Year 2025. And to put us all out of our suspense, I would like to request our jury chair, Mr. Sajjan Jindal, to read the citation and announce the winner of the EY Entrepreneur of the Year Award 2025.
Weaving a fabric of unity that connects an entire ecosystem of partners and millions of customers, he helped transform how a nation finds food, orders groceries, and reimagines everyday conveniences. Through shifting market dynamics and hard questions, he kept building for the long term.